around 2.70%.
Okay, point taken. Now, let me talk about other income, because that very, very strong growth in Q4, you believe there are one-offs. What explains it?
See, other income, if you see Q4 and then if you see the YOY basis, March 24 to 25, our non-interest income has increased by nearly 46% on a YOY basis. This has improvement is there because of the recovery in the return of accounts throughout the year, which is much better than which was last year. 61% is the YOY growth on that. As regards from the treasury income side, interest on the treasury income, there the income has tripled over the YOY basis. So these are the two key fundamental reasons for which the improvement in the non-interest income is there. We are focusing on the non-interest income very strategically so that the overall income improves and the pressure on the NIMs which is coming through the net interest margins and the net interest income gets reduced.
So, on the credit cost front, slippages in agri and MSME have both doubled on a QOQ basis. Is this just seasonality, or is it a cause of concern? And what's the outlook like for FY26?
So major portion of our slippage is coming from the MSME and agriculture. If you see in the agriculture side, I can substantiate that there were certain changes in some of the state SLBC formula, wherein as per the IRAC guidelines of RBI, there were certain slippages in the agriculture side. But if you see on the YOY basis side, our credit cost has in fact come down on a YOY basis. It is now pegged at 1.38% as against 1.56% last year. So we have reduced our credit cost by nearly 20 basis points. If you see the overall number, the number is flat at around 7,500 crores of fresh slippage, which has happened. The slippage ratio, in fact, is 1.38, which I was telling. So the slippage is at around 7,500 crore, which is the same as per the last year. But this year we had one large ticket corporate slippage of around 1,000 crore of a PSU. Had not been there, the slippage ratio would have been much better. So, but nonetheless, in this financial year FY26, we are very much confident that the slippage in this year will be much lower than the number which was this year, and we'll be able to protect not only the slippage ratio would improve, but also even the credit cost.
But why is that so, sir? What gives you the confidence for FY26 versus what went wrong in FY25? Just give us that understanding.
So as I explained earlier, 1,000 crore was one single PSU which was there, right?
Okay.
So had that not been there, our slippage, fresh slippage would have been only 6,500 crores as against 7,500 crores. That is one point. Second point is that if you see our SMA numbers 5 crores and above, the SMA number which was last year 7,100 crore in March 24, it has come down to 4,900 crores in March 25. There also to the total standard book of the bank, our this above 5 crore SMA is only 0.92%. So the credit call, otherwise the book asset quality is okay, fine with us, and the lumpiness in the SMA book is also because of few accounts which are of this one state PSUs. There also in all those 4 accounts we have state government guarantees, and we do not see any delinquency coming in that. So this year we are very confident that the slippage whatever happened this year FY25, it will be much lower than this number.
Point taken. So give us the growth guidance and the credit cost guidance for FY26.
Yeah. So as far as the growth guidance is concerned, deposits, we are giving a guidance of around 11 to 12%. And for the credit side, we are giving a guidance of around 13 to 14%. And on the credit side, credit cost side, you have seen that the credit cost of the bank has come down in this financial year, definitely, and overall provision also has come down, in fact, on a YOY basis by nearly 1,000 crores. For FY26, again, the credit cost, we should be down by another 10 to 15 basis point in FY26.
Point taken. So my last question again is going back to non-interest income. A large chunk of the non-interest income seems sustainable, but you've got around 700 odd crore of treasury income as well within that. So give us color. What is the recovery pipeline looking like for FY26? So what will that number look like? And second, with regard to other income, is that where is the normalized steady state number looking like? Are all the other line items outside of treasury sustainable? Even treasury, is it sustainable or not?
see, last year we had done a total gross cash recovery of 7,800 crores. This year our gross cash recovery is around 9,500 crores. FY26, we are internal management target. We have kept ourselves for a gross cash recovery of 11,000 crores in FY26. So that is the kind of number we have kept ourselves. So it will be incremental delta would be at around 1,500 crores in the gross cash recovery. As regards to the non-interest income is concerned, there also we are expecting a better numbers. There has been, as a strategy, we have built up our treasury book over the last 5-6 months when the interest rates were higher. Now in the falling interest rate scenario, when the repo rate is coming down, so we are anticipating that we will book some profits out of that book in the treasury book and earn some income, some non-interest income out of that head. Another important point in the improvement in the non-interest income is also the penal interest which was taken earlier as per the RBI circular are now coming in the penal charges. So there also there has been a bolster in the non-interest income because of the shifting from the penal interest to the penal charges. So that number is overall sustainable. As I said, that we will be doing good in the recovery numbers in this financial year also, and some gains will be there in the treasury also. Overall, keeping in mind both the things, our non-interest income will be remaining buoyant in FY26.
Sir, FY26 full year ROA, what's the kind of number that one can expect with all of these levers that you have? Is it 1.1%, 1.2%? What's the bullish case?
Yeah, so if you see our ROA as a growth trajectory, we have improved our ROA on a YOY basis. Our ROA was 0.70% only in March 24, which is now on an annualized basis at 0.90%. If you see the quarterly glide path which is there in the ROA, we have touched the ROA of 0.98% in March 25. So that is the kind of number. In this financial year for the glide path, I would say that we would like to touch the ROA at 1% by FY26. And to touch that number, as I said already, we will be growing our top line numbers, our bottom line numbers, our operating profit and net profit, and also obviously our non-interest income and the key fundamental ratios which are there with respect to gross and net NPA, our credit cost and slippage ratio. All these things put together will help us to give a ROA of around 1% in FY26.
Okay, so some key numbers that you should watch out for with regard to Bank of India. One is that ROA number that was just spoken about, and also the global NIM, which is seen at 2.7%, the net interest margin. The quarter gone by, there was erosion, and you heard from the management why that took place and how it's expected to stabilize at 2.7%. The stock is doing particularly well. In fact, the Nifty Bank is down about 0.4%. So this is a bit of an outperformer in that pack. And the benchmark is actually off the low point of the day, still trading with cuts of about 0.7% though at 24,747. It has recovered from the low point of the day, as I said. IT as a pack is down about 1.3%. This is par for the course based on yesterday's move, where it ended 6.7% higher. So some of that steam from the rally is being taken out. In fact, let's look at the sectoral picture to tell you what's moving and what's not. Defense once again in focus as a pack is gaining as much as 3% in trade. The PSU banking pack, and you saw one of the components there, Bank of India, doing particularly well, up about 1.8% or so. You have the pharma index that is bouncing back from yesterday's underperformance, where it ended just about flat, and you have a few of those components that are doing particularly well, up about 1.6% or so. Energy as a pack is just about holding on, but you have IT that is the worst performer, down about 1% or thereabouts, and you have realty as a pack that is also not doing too well at this point, down about 0.7%. If you pull up the contributors on the Nifty 50, you will see that the heavyweights that pulled quite a bit of ground yesterday are actually leading the declines and contributing to most of the declines at this point. Infi, HDFC Bank, ICICI Bank, as well as Bharti Airtel, which by the way posts its numbers today in focus. There are in fact a couple more Nifty 50 companies that post their numbers today. Among them, Hero MotoCorp as well as Tata Motors should be kept on your radar. And if I'm not mistaken, Cipla as well is going to be posting its numbers later today. We've got all of that and more lined up over the course of the day, but starting with Know Your Company, that's up next. Do stay tuned. This is NDTV Profit.
It's out of there.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to KYC. This is that show where we try and get you actionable insights on each individual company daily. Today we're going to cover Home First. It's an interesting company because one, it's in the housing finance space, domestic facing, and some of these housing financiers are growing at a very fast clip. So you want to first off check whether that kind of growth clip is sustainable or not, and that's the first piece what I'd want to know about this company. Can the growth clip sustain? 33% is what they've grown over the last 3 years. Can that kind of a number sustain? Maybe over the next 3 to 5 years is really the question. What helps them stand out? Because credit costs haven't gone up substantially despite that AUM inch up. So you want to understand what helps them stand out, or whether this is only a cycle with regard to credit costs. Can the cost to income fall? Is there scope for that? It's fallen over the last 3 years. Is there scope for further improvement on the cost to income front, which could well aid the return on assets number? What happens when private equity funds choose to exit? Now, mind you, there's a ton of private equity investors within the company. What happens when they decide, well, we want to exit? It could well pressure the counter, and therefore investors need to be mindful of how the private equity investors are choosing to exit. Now, one other piece with very much linked to the return on assets is the top line and spreads. The spread is generally the difference between the lending versus the borrowing rate for an NBFC. This one is seeing a shrink with regard to spreads. So is maintaining spreads a challenge? One thing is margins, the other thing is spreads. Spreads is on an ongoing basis and therefore is not impacted by the capital structure. I will explain this in greater detail, but is maintaining spreads a challenge? And last up is with regard to geographic expansion. They're currently in a limited geography, just about 13 states. as they grow, is there an intent to increase their geographic presence, and therefore does that pose a risk to asset quality? We'll talk about all of this and more, but first off, we'll look at one, what this company does exactly, and we'll try and break it down. And second, we'll look at all the metrics which we always speak about. So let me first start off with about the company. The company was incorporated on the 3rd of February 2010 in Bengaluru. It listed itself on exchanges in 2021. Between those two, converted itself into a public limited company in March of 2018. So that's how the journey has been. Listed in 2021, currently operates to 361 touch points, 155 branches, 13 states and union territories, larger focus on tier 2 and tier 3 cities. That's how they are spread. There you go, tier 2, tier 3 city focus. So that's how they are spread. Now in terms of milestones and journey, again, we'll reboot. Commenced operations in 2010 after National Housing Bank registration that they got. They thereafter secured minority stakes from Bessemer Venture Partners and Tata Capital Growth Fund in each of the years, 2011 and 2013. Thereafter, they turned profitable only in 2014. They established a foothold in the affordable housing finance space. True North acquired a majority stake for over 600 crore with Aether Mauritius, which is a GIC affiliate, joining as a co-investor in the promoter group. They are still within that promoter group, and they still on a combined basis own 13% of Home First Finance. Warburg thereafter came in, acquired a 25% stake at 700 crore, and this was largely, of course, all of this was pre-IPO, so something to keep in mind. They signed co-lending partnerships with Union Bank of India in December 2021. They also launched their IPO in 2021. It was a 1154 crore IPO and subscribed 26 times, so plenty of interest. It also opened at a premium of 20% to the issue price. In 2021-22, they signed partnerships, Central Bank of India as well as Union Bank of India. Both of those partnerships coming through, they expanded reach thereafter because they signed these partnerships. The AUM crossed 10,000 crore in May of 2024. That's the other milestone. They raised 280 crore from IFC for green affordable housing finance also in 2024. Thereafter, successfully 1,250 crore rupees raised through a QIP in April. They've boosted their capital, and the AUM is currently sitting at 12,700 crore. That's how the journey largely has been. Now, affordable housing finance, it's a fast growing sector, doesn't need too much introduction, so I won't delve into that. But what we will delve into is the metrics, which we always do. Let's first start off with what are the metrics we look for. One, we'll look at the income statement. We'll thereafter look at the balance sheet, the operational metrics, and the asset quality. We'll also look at shareholding, valuation, street cred, street coverage, and in the middle of all of this, we'll look at the return ratios as well. So we will delve into how return ratios are also doing, even though that's not the metric we've looked at. Let's look at the income statement to start off. The net interest income has gone up by 29% over the last 3 years. That's the CAGR it's given in terms of the 3-year CAGR. You can look at the numbers, both FY24 and 25, which are on your screen. So healthy kind of growth that we've seen on the NII front. We've seen a bit of margin compression, but we will talk about that as part of operational metrics. The growth between FY24 and 25 hasn't been very sharp, and there are reasons for that. We will delve into that as well. Provisions, we've just about seen around a 5% 3-year CAGR on the provisions number, so no real concern per se there. And profit after tax has seen a 27% growth when you're looking at the last 3 years. In the last year or so, look at the kind of growth that it's clocked, 25% plus again. So very, very strong growth on the profitability metric as well. Let's look at the journey over the last 3 quarters now. And it's been fairly steady, as you can see. The provisions number is what I want to really highlight. No real inch up. It's been fairly steady. Profit after tax also nearly there. We've seen profit after tax for Q4 FY25 just inch up a marginal bit, and you can see that sequential inch up. It's a very healthy inch up. It's the first time where they've clocked profitability of 100 crore plus, which is in Q4 FY25. So making good progress in that sense. So a clear thumbs up with regard to this metric, just because some of the numbers really impressive in terms of growth. Now let's talk about the balance sheet, because that's the other piece. We've seen good AUM growth, 33%. We did speak about that over the last 3 years. Sustainability of this is the question. Borrowing number is at 41% when you're looking at it in terms of growth, and your capital adequacy continues to remain quite healthy at 33%. So no concerns here. Let's list out the key takeaways from the balance sheet as well, if we can. And the key takeaways from the balance sheet in particular are the healthy AUM growth that we've seen, strong capital adequacy that we're seeing. They have a guidance that their leverage ratio will be maintained at no more than 1:5. So they will not skew the balance sheet, or they will not add borrowing disproportionately. Every time it reaches 1:5, they will do an equity raise in about, not absolutely 1:5. And they've recently undertaken an equity raise of 1,250 crore on the balance sheet. So those are some takeaways for you with regard to balance sheet metrics. Let's look at asset quality now. And thumbs up on the balance sheet. Sorry, let's look at operational metrics now. When you're looking at the operational metrics, we'll see that margins have slowly crept downwards. So from the 6.4% number, they've come down to 5.2% at this point. Spreads also have seen a similar kind of trajectory, but the difference is lower. Now, in terms of where margins is concerned, very important to understand this. The margin number is linked to the net interest income number. The net interest income number is linked to the interest expenditure number. The interest expenditure number is linked to the borrowing that the company does to do onward lending. Whenever a capital raise comes in, an equity capital raise comes in, you have to borrow less in that particular year, right? Or in the subsequent year as well, because you have adequate capital. If you do not do an equity raise, then you have to do a debt raise to ensure that growth comes in. Now, whenever there is an equity raise, the equity that comes in as capital then goes out and earns you interest income. But there is no interest expenditure linked to this interest income. And therefore, you will see interest expense remain flat, but interest income go up, which means your margins will see a bit of a lift. And that will only be temporary. Your normalized margin will very quickly be reached as that capital gets completely utilized, and you have to thereafter raise debt to ensure that your 1:5 leverage starts to kick in. For the moment, this margin movement is largely because they haven't done an equity raise from FY23 to FY25. FY25 is when they've done the equity raise. So you might likely also start to see a bit of an inch up in terms of margins temporarily. Thereafter, it may be a year or two till the next equity raise that you will see a gradual fall with regard to margins. So that's how the margin trajectory will go. We will quiz them as to what the goal is with regard to margins, but the better number is the spread number. The spread is the absolute difference between what you are lending at versus what you are borrowing at. And therefore, that spread number is what is relevant. When we look at the spread number, we'll realize that that has also fallen, and that's where likely the concern is. The ROA number though is fairly steady. At 3.5%, ROA is very healthy. It's come off a little bit from that 3.9%, but that's also because of what I just explained in terms of interest expenditure. The ROA, which is the profitability, is linked to the interest expenditure, and as the interest expenditure has gone up, right, because they have not done any equity raise over the last 2 to 3 years, because the interest expenditure has gone up, you've seen an ROA dilution, and therefore you will see that also as a very, very normalized piece. It's within the realms of the way Home First does is business, and therefore no concerns at all. What you want to though look at is borrowing cost. Between FY23 and FY25, we've seen the repo rate go up and the borrowing cost has inched up. Is there scope for this to come back off? And what is the impact on spreads and margins? That's what you want to really look at, and thereafter assess the impact of that on your ROA and profitability. I hope that this kind of sums up in a nutshell all that's reflecting on your screen. The other piece is the OPEX to assets. OPEX to assets has come gradually down, as you can see. It's a healthy gradual taper. Can this taper continue going forward? It will be the question, because that will also impact your ROA number and your profitability. As your OPEX grows not as fast as income grows, right? If your OPEX is not going to inch up as fast, then you really, then you will see an impact of that on profitability. So you'll see better profitability on the back of that. That's on the operational metrics. Now let's look at asset quality very quickly. It's largely steady, but it's above the 1% threshold in terms of NPAs. So in that sense, it's a neutral. We've seen other housing financiers clock a lower NPA ratio absolute, but no concerns per se on the asset quality front. Let me just clarify that. Where shareholding is concerned, there are large PE investors which are involved. You look at the promoter holding. Within that promoter holding, there are very large PE investors. There's a True North. There's a GIC, which we spoke about, but there are also others. Even within the DII basket and even within the public basket, there are plenty of investors which are there, which hold chunky holdings, who will eventually want to exit. How does this exit happen will be the question, but for the moment, you're seeing one, marquee investors, which is a positive, but two, you might see them at some point of time sell as their funds expire. Not that they want to sell, but because their funds will expire and they'll require the money to pay out back to the investors. That will actually impact both the shareholding pattern as well as liquidity in the stock, which could impact the stock price performance. So we've given this a neutral therefore. Last couple of pieces. One, you have valuations. When you're looking at the valuation picture, and let's pull it out very, very quickly. There you go. Your price to book, and I've tried to sum this up. Maybe you can take a screenshot of this. What you can actually see is the price to book for Home First versus the 3-year average is at a slight premium. It does an ROA of 3.5%. Let's ignore Canfin for the moment. Let's compare absolute comparables. Aptus 4.24, 4.49, slight discount to 3-year average, and you look at the ROA 7.7%, but this ROA is not sustainable because they have a very, very high amount of equity. They still need to leverage the balance sheet. So again, not the right comparable. Let's look at Aadhar, right? 4.36 price to book, 4 times is the 3-year average price to book, and 4.3% ROA. So the ROA is better, the price to book is largely in line, and the 3-year average, this one is trading at a far sharper premium. Last one is an Avas. And Avas is trading at 3.9 times, 4.2 times is the average, so it's trading at a discount, and 3.2 times, so sharply lower in terms of ROA. So this is your available universe, right? I'm not saying that some of them don't look expensive, but you compare it to a Canfin Homes where your ROA is 2.25%. Your discount to 5-year average is quite sharp, right? And maybe Canfin looks far more attractive in relative terms versus some of the others, and therefore you might want to analyze this a little bit more. But for the moment, we're going to give the valuations which are extremely steep at 4.4 times. Extremely steep, probably the most expensive among all housing financiers. You want to give this a thumbs down, plus it's trading at a premium to 3-year average. So you might want to be cautious with regard to where valuations is concerned. Let's look at Street Cred. Now, in terms of the returns that the stock has given, it's been decent. 2% up last 1 month may not have been very impressive, but you look at the last year or so, and it's been a decent performance from a stock price perspective, 47% up over the last 1 year. So very strong performance. We'll give this a thumbs up as well. And you look at street coverage. When you're looking at the street coverage, 22 buys, 1 hold, 1 sell, 17% upside. Nothing to complain about per se. We'll give this a thumbs up as well. So that's how it all stacks up. Now, the rating parameters, thumbs up on income statement, balance sheet, operational metrics, asset quality. Also, shareholding pattern, you might want to be a little cautious. Valuations, definitely cautious. Street cred, thumbs up. Street coverage, thumbs up. It sums up a 6 out of 8 on our KYC ratings. Not bad at all. But let's quickly go on. Let's listen in to what the management had to say. We spoke with Manoj Viswanathan, who is the Managing Director and CEO of the company earlier. Listening.
This year we ended the year at 12,700 crores of income, and we have set a target for ourselves for FY27. That is a kind of a round number of 20,000 is what we have set for ourselves as far as FY27 is concerned. And then a slightly longer term, that is FY30, our target is around between 35 to 40,000. Depending on how tailwinds are, how the economy is going, etc. So that is broadly our plan. 20,000 in the next 2 years, FY27, and between 35 to 40,000 crores by FY30.
Should a 25% odd growth clip be something which is the absolute base that we can expect in terms of growth for Home First?
So yeah, next 2 years we are looking at a 25 to 30% AUM growth. We have been, what we had mentioned was that we can grow at about 30%. That is what we mentioned when we listed the company in FY21. And we have been growing at between 30 to 35% in the last 4 years. Now what we are seeing is that the base is obviously elevated. So we are saying that 25 to 30% should be a sustainable growth over the next 3 to 5 years. And for the next 2 years, at least the target is 20,000. So that translates to somewhere between 26, 27 or, around 27 to 30% in that range. That is the growth for the next 2 years.
Tell us, there are 3-4 players in this space, in this affordable housing finance, or the smaller both ticket size as well as smaller size in absolute terms on the balance sheet. There are 3-4 players. What sets you apart? What makes you unique? And how does that help you stand out?
So as far as the balance sheet is concerned, I think one thing that sets us apart is the share of housing in the book. So we have 85% of our loans devoted to individual housing loans, which is the highest share amongst the peers that we are talking about. So that is something as far as the balance sheet that sets us apart. In terms of the business model, business process, I think what sets us apart is our you can say dedication, devotion to technology, using technology to facilitate things from day one. So we have been one of the early adopters of the Salesforce platform, centralized underwriting model, AI based or AI ML based underwriting. So these are things that have, that are things that we have kind of built over the years, and which have also led to some financial metrics or results, like, low operating expenses. So if you see our operating expense to assets, it is the lowest amongst the peers that you're talking about. And that is directly a result of our approach to the business, that is using technology, designing the process in such a way that the cost is optimized.
Point taken. And how does that help you going forward? You've given us some bit of color on how it's helping you currently, which is to optimize OPEX. OPEX now at OPEX to assets roughly at 2.7% for viewer perspective in Q4. But how does that help you in terms of numbers going forward? So say maybe a couple of years from now, is there scope for further contraction of this when you get to that 20,000 crore mark in terms of AUM?
It is possible. So by design, the design is that, the cost should keep getting reduced. And but how much it will reduce from here on, can't really, put a number to it. But of course, because of the way we are designed, the OPEX should keep going down. So our estimate is that every year it should, or every 2 years it should be able to, we should be able to reduce it by about 5 to 10 basis points. So 2.7, so maybe, get it down to about 2.6 in the next couple of years. Because I mean, the reason I'm saying that is that we are already very, very well optimized on cost, and our OPEX to assets is amongst the lowest, compared to all these peers you're talking about. So we would rather focus on growth at this point of time rather than trying to optimize the cost any further.
And how does the spread move in this reducing interest rate environment? Give us an understanding of that. Do you expect yields to follow?
Yields continue to remain under pressure, but I think most of the players in this segment, affordable housing segment, understand that there is a certain minimum margin that we have to maintain to keep the business profitable, and so obviously that acts as a moderator. So I think, generally speaking, most of the players are looking to maintain a 5% plus kind of a spread on an individual loan. So hopefully that should moderate the yield pressure going forward. Unless something really draconian happens and the operating expenses are really dramatically reduced across the board for all the players. Then some of that benefit could get passed on to customers and the spread could compress further. But otherwise, I would say that a 5% spread is something that most of the industry players in this segment they accept it as a reasonable spread that needs to be maintained.
Right. You have a fairly good visibility on the glide path with regard to AUM. You've done a 1,250 crore fundraise. How long does that last you for? At what level of AUM will you again look for an equity raise? And how many years ahead are we seeing no equity dilution for?
So we are clearly on track to hit till FY29. So the 1,250 crore raise should keep us, it will basically now, it's a function of leverage, right? So we were already hitting a 5 times leverage, so hence we raised the capital. So it will be again another at least 4 years before we start hitting that 5 times leverage number. So maybe FY29 is when we can start thinking about the next capital raise, but we should be good till then.
And before I talk about credit cost, tell us about both the interest expense part of it, because that will start to climb in relative terms, and your ROAs. So therefore, what is the band of ROA that you'd like to operate in, and does it get better? Does it get slightly trimmed down, given that you'll have this capital of equity and debt which will play on the P&L as well?
So we have always articulated that ROA is probably not the right metric because the ROAs tend to fluctuate depending upon the leverage. So when the leverage comes down, like now it would, because we have just raised the capital, the ROAs tend to expand because the NIMs tend to expand because the debt on the balance sheet is proportionately lesser, because of the capital raise. So the NIM tends to expand and the ROA also tends to expand a little bit. So the ROA would, in our mind, the ROA would fluctuate between 3 to 4 depending upon the leverage. So in the years when the capital has just been raised, so the ROA would be closer to 4. And as we kind of head towards the higher leverage of about 5 times, the ROA would tend towards 3. So which is why we are more we anchor ourselves more to the ROE number. And our aim is that we want to, we actually exited with an ROE of 17% last quarter. And our aim is that between capital raises, we should be able to deliver a 16 to 16.5% average ROE for the shareholders. So immediately after capital raise, ROE is likely to shrink to about 13 to 14%. And then again, it will climb back up to about 17 to 17.5%. So on an average, between capital raises, our aim is to deliver a 16 or 16.5% ROE.
Understood. And therefore, so if ROA is not the right metric, is ROE the right metric? What's the right metric? Because both of those will fluctuate. So just trying to get perspective on that.
Yeah, both will fluctuate, but ROE being the final number in terms of return to the shareholder, we kind of want to anchor to that number. So the idea is that average ROE between capital raises, I would say, would be the right metric to track.
Right, so that was the conversation, of course, with the management of Home First Finance. Interesting company. Hope you found this breakdown interesting as well. Completely out of time on this edition from myself and everyone who puts the show together. Packed team, all of them. Thanks so much for watching and stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay
Hello and welcome to Markets at 12. I am Puneet Zaveri. Let's first take how the markets are doing today because we've seen a very interesting session today. We saw roughly 900 point up move yesterday in the Nifty. We started yesterday at 24,100, ended almost very close to 25,000, somewhere around the 24,900 mark, and that was a big boost to the overall market as well. We've seen a 200 point correction, and what was interesting is roughly at 8 a.m. today, we've seen the implied open being in the red by roughly about 100 points. That was almost flat at market opening, and we've seen the market open slightly downward, but then trend upwards as well. Now again, we are seeing that selling pressure again. So from a day's high of about 24,973, we have seen roughly 250 odd points being given up by the markets. And while that was anticipated, the ride has been quite entertaining to say the least. Let's first look at some of the key contributors on the Nifty as well, and then we'll pull up the Nifty heat map as well, because while we're seeing some key moves by HDFC Bank and Infosys on the downside, and we will talk about IT in a bit. Let's also look at the heat map for the Nifty, because we have seen some strong moves coming in on the Nifty as well. Specifically, apart from these other stocks, let's pull that up as well. Seeing some moves today in the market, largely a reddish green. We are seeing some top moves. Infosys definitely on the negative side, and let's pull up Nifty IT and the key contributors for Nifty IT as well, because we have seen Macquarie come out with a very interesting note today. They have mentioned that the US-China trade deal could actually positively impact the market, but overall, we've seen UBS, Jefferies, as well as CLSA come out with a note saying that this does not, in terms of quarter 4 earnings, that was largely negative for the IT sector, and we're seeing that pressure today across the IT space, except for something like a Tech Mahindra, and that's largely positive because of valuations. But overall, we have seen the Nifty IT being in the red today, backed by fundamentals of Q4 earnings. They are anticipating Q1 also to be very soft, so that will again be a key issue. But overall, that sector was up in trade yesterday. Let's look at the mid cap and the small cap index, see how it is performing, because we've seen the small cap index actually outperform the benchmarks. Mid cap has now turned into the green. From a low of about 20,285, it's up 200 points, up almost 120 points on the small cap as well, was already in the green today. So it's maintained its green trajectory. It's now very close to the day's high of about 15,819. And finally, the Nifty 500 as well. Let's pull that up, because we're seeing a whole host of stocks that are in terms of news flow. We're seeing a lot of promoter buying and selling in a lot of stocks in terms of earnings as well that are key. Tanla is definitely one of them. It's a very interesting play that the promoter has decided to come on and buy a very big stake, or roughly about a 1.3% stake that the promoter has bought. Seeing the defense names also being very positive, Bharat Dynamics being one of them. Schaeffler also, continuing its positive momentum post its earnings. On the negative side, though, we did come out with earnings from UPL. Aether Industries, the chemical company, is down in trade, and that's also because we've seen a promoter stake sale there. So those two stocks, so Tanla stock promoter buying today, Aether is seeing a 6.77% stake sold by the promoter, Mr. Purnima Desai. I also want to pull up something like a KFintech that was expected to see a block deal from its promoter, General Atlantic, as well. It was scheduled for today. That seemed to have gone through, down 3.88%. Let's also pull up a Paytm, also similar moves we've seen. Antfin was expected to sell 2.6 crore shares, that's roughly 4%, and we saw that also in the morning. It did hit a low of about 830 rupees per share. Since then has recovered. Let's also look at a couple of other stocks based on news flow. That's one, Light Blenders, I wanted to check, because they had mentioned they could be looking at a fundraise actually at this particular point of time. Stock up over 4.7%, and we've seen most of the liquor stocks and the alcohol companies do very well in trade, something like Allied Blenders. And finally, a couple of them which is buzzing on results. So let's try pull up seeing what JM Financial is doing, because we saw an up move in the morning early in the trade today, continuing its momentum, 4.38%. And Aether Energy also we can pull up quickly as one of the last stocks. Company came out with its earnings as well as conference call yesterday as well. Another stock that's in focus on the back of earnings is Tata Steel. Now the company reported a decent set of numbers, but let's look at my colleague Sajit was in conversation with Mr. T.V. Narendran, the CEO as well as the MD of Tata Steel. Let's listen into that conversation.
To begin with, sir, a good set of numbers that came in. Revenues up nearly 4.8%, and you had a net profit which has doubled on a year-to-year basis. Can you take us through the realization picture during the quarter in Q4?
Yeah, thank you, Sajid, for having me on the show. Yeah, Q4 was more about cost takeouts. Revenues were quite flat. The revenues improved significantly in Q4 compared to Q3. But I think we've been doing a lot of work on cost takeouts both in India and in Europe, and some of that played out. And that's a benefit that you see in the numbers for Q4. But overall, the market situation is getting a bit better. In India, the safeguard duties have helped. And in Europe as well, the spreads have improved a bit because the raw material prices have come off, and steel prices are reasonably stable. So we're looking at this trajectory continuing going forward.
Mm-hmm. Sir, during the year you brought in the Kalinganagar new furnace into play, and if you look at the India volumes, it was around 21 million tons, which is higher by 5%. Do you see further jump in volumes in terms of deliveries coming in FY26?
Yeah, in FY26 we are guiding that the volume will be about 1.5 million tons higher. Kalinganagar itself will be about 2 million tons higher, but we have a blast furnace relining coming up in Jamshedpur, which will take out some of the volumes at an overall level. So that's why our guidance is 1.5 million tons more, basically in India in FY26 over FY25.
And how do you look at the European market, especially the Netherlands market, where you have seen some kind of cost efficiency gains coming in, and also give us a sense of how UK is looking now?
Yeah, so in Europe, you won't see too much of volume growth because we're pretty much peaked on the volumes, maybe a little bit more in Netherlands than you saw this year, because a big jump came in this year compared to last year, where the volumes are significantly higher. Overall, we see the Netherlands numbers continuing to get better because of the transformation actions that we are taking, and there is an improvement in spreads in Europe thanks to some of the quotas imposed by the EU in response to the tariff measures being taken. As far as UK is concerned, we continue to take out costs. We've taken out about 230 million pounds of fixed costs during the last year. We'll take out another 200 million pounds of fixed costs this year. So the markets are not great in UK because UK doesn't have the quotas that Europe has. We're seeing the pressure from the market, but on a cost side, we're taking out a lot. So we're expecting the EBITDA numbers in Netherlands to improve this year compared to last year. And in UK as well, we hope to get into positive EBITDA territory during the year.
Okay, so you may not be positive, but in terms of EBITDA, you will be positive in FY26.
Absolutely.
What's happening to the entire revamp which is coming up in the UK? Have you started the work? What kind of investments is going to come in from you?
Yeah. So as we announced last year, it's a 1.25 billion pound project, out of which we're getting a 500 million grant from the UK government. The balance 750 million pounds will be put in by us. So over the last 6 months, we were working on the planning permissions, which we've got. I think by end of June, we will have all the permissions that we seek. We hope to start construction and do the groundbreaking and start construction in July. We've already placed a lot of orders for the equipment supply, and we are on track to get it up and running by FY27.
Sir, how do you look at the entire market as a whole, domestic market and globally? We're seeing a lot of disruption which is coming in with respect to tariff between US, China. Now it's gone for a pause for 90 days. How do you see the entire market dynamics changing? Is it from a pricing point of view and from a volume point of view?
So steel is a global industry. Not only does steel, about 400 million tons of steel go across borders, about 2 billion tons of raw materials for making steel goes across borders. So we are very geopolitically plugged in. Also, all our customers are global industries, automobile, packaging, appliances, so on and so forth, construction, etc. So whatever happens in the world has a big impact on us. So the tariff situation was not very helpful because most of our customers are part of global value chains and uncertainty doesn't help. But now that we are seeing some sort of stabilization on that, settling down of tariffs, signing of bilateral trade deals, I think we expect that the fragility that the market was encountering over the last few months will not be there going forward. So we are positive about it because tariffs also would have had inflationary pressures, which would have put pressure on interest rates, which doesn't help us again because we are a capital-intensive industry. So overall, I see the situation improving in the last maybe 2-3 weeks than we felt in the first week of April.
There are two trade deals that are in focus. One is the India-UK trade deal, and the other one is UK-US trade deal. How does this benefit you in any way?
Well, for us, India-UK does not have much of an impact on steel. The UK-US, we sell about 80 to 100,000 tons of steel from the UK to the US. So that had a little bit of doubt about it, but that's gone off with this. It's not yet a formal trade deal. I think it's some sort of an agreement between the UK and the US, and that's beneficial to us. Again, more importantly, bringing down the import duties on automobile exports from UK to US is helpful for us indirectly because we sell to the auto industry in the UK as well. So overall, like I said, lower tariffs or stability in tariffs is good for our business.
Sir, in FY25, you did a capex of nearly 16,000 crores. Is there a guidance that you have for FY26 and 27?
It will be in that range. It will be about 15,000 crore plus. It will be 15,200, 15,300 crores.
And where are you going to put in that capex in?
80% of that will be in India, because we will be completing the Kalinganagar expansion. We have a electric arc furnace coming up in Ludhiana, which should also get ready during the year. And then the other sustenance capex in India, also the investments that we are making in mining, because mining, particularly iron ore mining, continues to grow to feed our growing steel business.
What would be the total capacity once the entire capex is through in India?
In India, will be about 25 million tons. with the Kalinganagar expansion included. And then after that, next year, it'll move to 26 million because we'll have the Ludhiana plant up next year. I mean, by the end of this financial year.
In one of the statements, you had mentioned that you're investing nearly $2.5 billion in T-Steel as a measure to infuse capital into some of the step-down subsidiaries. Can you give us a detail about where all this investment is going through?
No, I think that was maybe miscommunicated or misrepresented. Basically, what we're doing is onshoring some of the offshore debt that we have.
Okay.
So we're putting in money as equity and bringing back the debt. So there's no increase in leverage because of that. It is just a rebalancing of the way we have our debts, and we want to get more and more debt into India because that's where the cash flows are. It helps us from that point of view.
And so, where is the debt going to be replacing? Which are the companies where you're going to replace some? Is it some of the European operations that you will definitely see some of the debt replacement?
No, not. It's more in the holding. The T-Steel Holding is a company in Singapore through which we had made a lot of the investments. So we are just basically replacing the debt lying there with equity that we're putting in from here and carrying debt in the Indian balance sheet.
How do you see the debt picture playing out? Because your net debt was somewhere around 82,600 crores at the end of FY25. What is the kind of timeline and trajectory that you have to bring down this?
So even if you look at the last 6 months, end of September, we were at 88,000 crores net debt. So we brought it down to 82,000 crores in the last 6 months, and we'll continue to bring it down during this year. I don't want to give you a specific number, but clearly we are today at a net debt to EBITDA of about 3.2, and we've always said that we want to be close to 2.5 or better. So we want to move towards that. I'm not saying we'll reach that this year, but let's wait and see. We are working towards that.
You had mentioned in various calls that you're looking at a savings of roughly around 11,500 crores, 4,000 crores coming from India, 3,000 from UK, and 4,500 crores coming from Netherlands. Where are we on that? Are we on track to meet that kind of savings which you had articulated?
Yeah, a lot of actions in all geographies are going on. Like I said, we've already taken out 230 million pounds of fixed costs in UK. Last year, we'll take out another 200 million pounds. So that itself is more than 2,000 crores, right, out of the 3,000 crores. In Netherlands, we announced a 500 million euro transformation plan. So that's where the 4,000 crores is coming from. And we have multiple initiatives to support that. And India also, we have a lot of cost takeouts planned because we continue to drive efficiency and excellence across all our operations. So I think it's big numbers, but we are quite confident we are there.
You had articulated for FY26. Will that happen in FY26 or it may spill over to next financial year as well?
No, I think it's for FY26. I don't want to give up in April or May. I think we have the next 11 months. We will certainly chase those numbers and deliver it.
My final question to you, sir. Your adjusted EBITDA per ton was around 8,121, a marginal decline versus year on year. How do you see the EBITDA per ton, moving from here? Means, do you see prices to remain at the same level, or there is some firmness which will come in?
So if you look at our Q4 numbers itself, the EBITDA per ton is much better. This 8,100 is more reflective of the full year, right? So as the European business moves from negative EBITDA to positive EBITDA, it will no longer be a drag on the India business. If you look at our consolidated numbers, the consolidated EBITDA is lower than the standalone EBITDA, right? Europe has had negative EBITDA, actually because of UK. Last year, in FY24, it was because of Netherlands and UK. In FY25, it is only because of UK. Hopefully, in FY26, we should have a consolidated positive EBITDA from Europe. And we are looking forward, certainly, to UK also breaking even on its own.
Mr. Narendran, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
Thank you, Sajid. Thank you.
US President Donald Trump has pharmaceutical industry in his crosshairs. He's been threatening pharma tariffs for quite a few days now, and last evening announced through an executive order that pharma prices in the United States will be brought down drastically. Now, just a couple of lines of context. In the United States, high drug prices is a huge political issue. It is a problem that the citizens of that country face. And if you do a peer-to-peer comparison on specific drugs, yes, people in the United States pay several times more than other people around the world for those drugs. Now, what Donald Trump is saying is that he's going to have a most favored nation kind of a situation where people in the US will pay the same rate as the lowest rate paid globally for that particular drug. We've seen that impact on Indian pharmaceutical stocks in the last couple of days, a bit of a pullback on Tuesday's trade, but concern there that especially companies that have a bulk of their revenue coming in from exports to the United States will be impacted. Now, what exactly is the extent of impact? To speak on this, I'm joined now by Chairperson of the Biocon Group, Kiran Mazumdar-Shaw. Kiran, thank you so much for speaking with us. Always a pleasure to have you on. How did you decode what President Trump was trying to say?
If you recall, Tamanna, reference pricing was something that was discussed and introduced during President Trump's first term. And this has always been a concern for the Trump administration. And of course, I think even, the HHS Secretary, Robert Kennedy, echoed President Trump's concerns about the disparity in pricing between various developed markets and the US. He especially called out Europe. He also referenced Australia. He gave a couple of examples of how products that cost X in US are priced at almost like 90% discount or 80% discount in Europe and Australia. And he wants to equalize this, as he calls it. So I think the target is Big Pharma. I think Big Pharma has, basically subsidized or cross-subsidized US pricing with the European pricing. But having said that, I think President Trump also called out the middleman, and he basically meant the PBMs and the wholesalers who also basically keep drug pricing up. So despite the discounting that happens on drugs, patients have to pay a lot more. And I think he's trying to attack this in a two-pronged way. So it does not, of course, impact, generics or biosimilars by any stretch of imagination, because these are the products that are being sold to the US at a lowest cost. So there, I don't think reference pricing counts. But I think what he is really concerned about are the innovator drug pricing policies, where he asks them as to why is it that companies supply the same product from the same plant at two different prices, one for Europe and a much higher price for US. So I think you have to look at it in that context. So I'm not really concerned about it impacting Indian pharmaceutical companies in any way.
No, but why not, ma'am? Because there are several Indian pharmaceutical companies who are also providing innovative drugs. It's not only generics. So
yeah, but those are basically APIs, okay? And APIs will not fall under the reference pricing, category. Generally, you look at reference pricing for drug products. So I just believe that the real challenge is going to be for the Big Pharma as a whole. And if you saw some of the comments and reactions from Big Pharma, you can see what it means for them. I mean, Roche themselves said that they will have to rethink investing in manufacturing in the US if drug pricing is going to hit their profitability. So I think these are concerns that Big Pharma has, and you heard the president and RFK saying that the pharma lobby is so strong in the US that they've allowed this to happen for too long. So I think there's a real concern about differential pricing, and he clearly called out the developed world, and he said, I'm not going to include the developing world in this because they need better pricing in the developing world. So he's not looking at reference pricing in the developing world, but he's looking at developed world reference pricing.
So that reference pricing, and ma'am, this is just for us to understand. Reference pricing would indicate that whatever price that drug is sold in India, he's saying equalize it with the United States. He doesn't want to do that.
No,
That's fine.
but he's not calling out India. He's saying, I'm not going to include developing world reference pricing. I'm only looking at developed world reference pricing. Is he clearly articulated that? Tamanna, you should listen to his his broadcast.
If I can just complete the point I was making. So that's the reference pricing bit of it. But when you refer to big pharma, why would companies like, say, Sun Pharma, Biocon not be clubbed in the view of the Trump administration as big pharma at all?
Because we supply biosimilars and generics. And these products come under the Affordable Care Act. And he has clearly talked about bringing affordability into the US healthcare system. And I think Robert Kennedy kept emphasizing that. Secondly, our product pricing is really almost uniform, whether it's in Europe or US. So there's no that kind of differential between the markets we serve.
Okay. Directionally, if you look at what Trump is saying and where he's trying to take this conversation across sectors, would you see in the future a need to increase manufacturing in the United States?
I think you have to have an optimal infrastructure of manufacturing to be close to the patients. I think it doesn't make sense for US to bring back commodity manufacturing such as generics into the US. So I don't think they're really concerned about that. But they are concerned about, the high value manufacturing of pharmaceuticals, which is really the innovator products, which has largely shifted to Europe and even China. And I think that's what they want to bring back to the US. So and as a company, we have basically invested in creating a manufacturing footprint in the US to bring more efficiencies in terms of our market strength in the US. So if you look at what we've done in the recent past, we've acquired a solid dosage facility in New Jersey. Syngene has recently acquired a biologics facility in Baltimore. And we also recently announced a very big insulin partnership with Civica to manufacture certain insulin analogs in the US. And I think we will invest, in these very measured but calibrated ways to make sure that we play very strongly in that market.
I'm going to come back to this point, and I'm reiterating it because this is a core concern of analysts and on the street today. You have referred to generics and biosimilars in one category from the POV of how the Trump administration is looking at it. But is there complete clarity that the Trump administration will not look at higher priced biosimilars in the same bucket as the drugs that they need to target and bring down prices for?
I'm absolutely sure of that. I think what you need to also understand is there's a difference between tariffs and pricing. Okay. Now, what we have to look out for is there going to be any tariffs levied on pharmaceutical products from India? And there, I believe that, again, we will probably have a soft landing like the UK had, because I think it hurts them to increase generic pricing. Because I think, the whole 80% of their prescriptions by volume are generics, and that's what is keeping their costs down. So to levy, a tariff on generics doesn't really help them very much. But I think levying to discuss price reduction is really the way they're looking at the pharmaceutical industry.
So let me come to the tariff question as well, because we're yet to hear the last word on tariffs. And there's a lot of back and forth. Now the US-China deal is done. But, Trump has said that he's going to revisit the tariff question on pharmaceuticals specifically, which was left out in round one. What is the best and worst case scenario that you see?
My guess is that they feel that they get a lot more benefit in drug price negotiations and reductions because that's really the bulk of their drug costs in the US. It doesn't really help them to levy tariffs on pharmaceutical products because there's a much more effective way of getting drug pricing down. So that's my take on that. Of course, there are many other segments that they will try to levy a tariff on because they're very concerned about automobiles, they're very concerned about agriculture and many other such products. But I don't really believe that the pharmaceutical industry really will give them a huge benefit of levying tariffs. So I think they are really focusing on drug pricing to reduce the bill of healthcare. And I think that's the right approach they've taken.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Hello and welcome to Profit Buzzers. This is Anushri Vakharia and with me is Hiral Dadia. Hiral, it's been a day of correction, I'm assuming, after the strong rally that we had seen yesterday. It was a double whopper, a news flow of events yesterday, but today, in terms of where the Nifty 50 is concerned, we are looking at cuts of about cuts of around 0.84% in the benchmark indices is what we are seeing. In fact, let's pull out the contribution table to see where we are seeing more pressure coming in from HDFC Bank in pauses, ICICI Bank under pressure in trade today. Do note that yesterday it was the day of IT. A lot of these IT counters were buzzing on the back of what had happened over in the global side as well. But on the other side, some counters which are bucking the trend is something like Bharat Electronics contributing positively. This is on the defense back. It has continued to remain in focus after the India-Pakistan ceasefire and improving prospects of what the order pipeline for the business could be. Other stocks in focus includes the likes of Bajaj Finance, Your Financial Services, something like Adani Ports. In fact, let's see how the contribution table is looking at where the sectoral indices, where the the action is over here. Nifty Defense continues to be in focus. The index up over 4% in trade today. We have Nifty PSU Bank also 1.7% up in trade, but it's Nifty IT which is seeing correction today's trade after the kind of strong up moves that we had seen yesterday. Nifty IT down about 1.6%, and Nifty FMCG also seeing cuts of around 0.8%. But let's also see how Nifty Bank is faring. The Nifty Bank, if you are looking at, if you can pull that out. So Nifty Bank, we are seeing cuts again over here of around 0.5%. So this is overall what's happening on the benchmark indices. But let's also take a look across the broader markets. Let's see how that is faring. So let's talk about Nifty Midcap 150.5% up in trade, doing fairly better than how the benchmark indices are. But if we talk about the Nifty Small Cap 250, let's pull out Nifty Small Cap 250 up over 0.8% in trade today. So this is overall the kind of moves that we are looking at. Let's pull out BSE 500 also to see some of the buzzing stocks in focus over here. If we pull out a BSE 500, we are seeing Tanla Platform rallies, Bharat Dynamics in focus, seeing gains of over 7 to 9%, but it's something like UPL, Chambal Fertilizers and Ather which are seeing some bit of pressure, seeing cuts of around 4% in trade today. So this is overall the picture that we are seeing for the broader and the benchmark indices. But let's talk about markets, and let's welcome in our guest for today. That's Raghavendra Kedia, founder of Prosperity Advisors. Raghavendra, now yesterday we had seen strong up moves in the market, a strong rally boosted by a couple of events that had taken place on the domestic and on the global side. It's a fairly it's a day of correction. We are looking at cuts of around 0.4%. I want to get your perspective on the overall markets. What's your view?
Good afternoon, Anushri. Broadly, we believe that there is a significant time correction in the market, and that Nifty will hover around levels of 24,800, 25,000 on the higher side and 23,000 on the lower side. So we believe a seesaw movement in the market might continue. We are largely on the higher side of the market on the range, and so some profit booking is expected. And we believe that a 4 to 5% correction in broader market indices, say Nifty 50 and the Bank Nifty, is highly possible. And we believe that traders can look at current levels to book profit. So broadly, it's a range-bound market with a negative bias from current levels.
Right, so range-bound market from current levels, that is what is on the cards. But moving on, Ather Energy, that's a stock that is in focus, and this is a newly listed electric two-wheeler company that has seen their revenues going up, but the losses are also coming in. They've narrowed, but the stock is taking a beating, down to the tune of almost 1.5%. Puneet joins us with the details. Puneet, what is it that is not working for Ather, because the stock has been under pressure?
Well, definitely, we were expecting that the company will report losses similar to its previous quarter. The previous quarter earnings were mentioned in the company's RHP during its time of IPO. And the key aspect to look at was what was the key commentary as well. So while the revenues were roughly about 29% in this particular quarter, we have seen an EBITDA loss of 172 crores. While that is lower on a year-on-year basis versus 239 crores, it has inched up quarter on quarter versus 141 crores in the previous one. In terms of net loss as well, they've reported a net loss of 234 crores, and that's again slightly inched up from the previous quarter of 198 crores, and that's because of higher marketing expenses for its new scooter, the Rista, which is being launched, as well as increased cost for adding distribution centers in the non-South markets, because they roughly get 61% of the company's sales from the South Indian market. So that they are trying to diversify in West as well as North India, and those costs getting added in this particular quarter. What's important is the conference call, and there are 5 key highlights that I just want to talk about. First one's, of course, that they are adding stores in the non-South market. They've added 143 stores in this particular year, and that's taking the total to 351 stores. Now, while that is much lower than its peers, which are operating at 800 to 900 stores, the growth has been there for the company. So it's a very big positive. They've also said that now they have the capacity to add roughly 2 stores a day, which can essentially add roughly 800 stores over the next year itself. one thing to watch for. The second key aspect, management is expecting that it will be the new Rista launch will be in North India now as well as West India, and that will help the product over the next 1.5 years, and they see that this could be a strong growth area and it won't have any kind of effect before in terms of product stagnation essentially. They've also said that this would signify strong growth in FY26. Third key aspect, they don't have a discount-led model that will help in resale value, and profitability can happen at a lower volume in terms of break even compared to its peers. Fourth key aspect is that in terms of subsidy reduction from April 1st of this year, we've seen subsidies to go down to 5,000 versus 10,000 rupees per scooter earlier. That will only have a 3% revenue impact, so that's a positive. And finally, they mentioned that the management is seeing a strong upgrade play essentially in electric two-wheelers, scooters. They are seeing that this is people are now having the second purchase of two-wheelers that's electric. That's essentially an electric scooter, and Ather is getting advantage of that aspect and addressing specific needs as well. So while not too much to write about in terms of numbers, I think the commentary as well as the management's focus essentially to improve the sales through Rista is something to watch out for going forward in FY26. But valuation currently expensive at 6 times price to EV to sales compared to Ola as well. So that will be, I think that's the reason we're not seeing much reaction to the management commentary. But overall, decent set of comments coming in the conference call from Ather Energy.
Right, those are interesting points to note. Raghavendra, how are you looking at Ather Energy if you have to look at and compare it with other two-wheeler EV makers as well? Because from a market share perspective, it's the fourth in terms of order. Valuations, yes, expensive, but the segment is also very different. How would you deal with it?
Good afternoon, Hiral. Broadly, on the valuation perspective, we continue to find Ather Energy very expensive. And there has been the primary reason we believe that these valuations are trading at some premium levels is because on the street there has been a big fancy about anything which has the word EV, electric vehicle into it. And actually that is the reason Ather Energy is also trading at some premium valuations. So we believe there is a good scope of price correction from current levels. We have seen that the IPO of Ather Energy was pretty much lackluster, but that is fine. In terms of how the company performs in the next 2 to 3 quarters will be closely watched. So it's a wait and watch approach right now at Ather Energy. And in terms of valuation, if the stocks corrects to levels of 260 to 70, that is around 10% price correction. That would be a better entry point. But again, we would review the numbers, how their earnings grow. They have grown in terms of sales, but that has a low base effect. So again, with very cautiously, we would approach Ather Energy. It's head-on competition with Bajaj Auto, TVS Motors, and massive Chinese imports on the EV space coming into India. So it's a wait and watch approach at Ather Energy. A price correction would be a better entry level.
Okay, a wait and watch is the approach that we are looking for. Ather Energy and more valuations more comfortable at the price range of 260 to 270. But another stock in focus is something like a Raymond, which is seeing robust growth in the realty space, says Amit Agarwal, the group CFO, Raymond Limited and Raymond Lifestyle Limited. Listen in as he talks about Raymond Realties and lifestyle business prospects.
If you look at the performance of our real estate business, it has come out very, very strong. We have delivered more than 2,300 crores of sales, 500 crores of EBITDA. And if you see the JDAs, we have been able to put together another close to 7,000 crore of JDAs in this quarter. So overall, our JDA numbers reaches to 15,000 crores. So the portfolio which Raymond Realty has is around 40,000 crores, which will get executed over the next 5 to 7, 8 years. I think that way Raymond Realty is on a very, very strong wicket.
Let's talk about Raymond Lifestyle first, because the quarter is showing pain. Now, take us through that. Is this a demand depression that you're seeing? Do you see that continuing? What has not worked for Raymond Lifestyle this quarter?
Sure. So look, Raymond Lifestyle, if we all know, in India for last 18 months or so, the consumption has been weak across sectors. And that has been clearly reflected in the Raymond Lifestyle performance for the entire year. And especially in this quarter, we were impacted by the ransomware, which impacted our operations almost to the tune of 24, 25 days. And which is almost like a 1/3 of the quarter was really impacted. But we were able to recover back a lot of sales. and we expect some of the sales to be recovered back in the 25-26. Second, the good aspect is that we are seeing a slight recovery in the demand as we saw the secondaries in the various sectors, be it the wedding and so on, have seen a little recovery. However, our dealers, franchisees were a bit anxious to buy the products at this juncture, and they were feeling let the inventories come down and then they would start buying.
Now, do note that the real estate business of the company, that's Raymond Realty, the demerger data set, the demerger record data set for tomorrow, that's May 14. But do note, coming back to Raghavendra on Raymond, what is your outlook on this company's business prospects now? If you're looking at Raymond Lifestyle, Raymond Realty, your overall outlook on the different segments of the business.
So we would like both Raymond Lifestyle and Raymond Realty post the demerger. We believe that there will be a significant value unlocking in the entire stock, where the realty business could see its multiples being compared to Godrej Properties or Lodha Developers or some immediate peers, especially in the metropolitan space. And again, on the lifestyle business, we would see the stocks have textile stocks, which have actually showroom kind of a retail business in terms of consumer space interaction. The lifestyle business would also significantly see multiples going up when you compare it to a Welspun or a Trident. So basically, we would wait for the stocks to get demerged, and then the SOTP, some of the parts valuation would unlock, and that would be a better play to play the entire stock. But looking at the specific earnings right now, it's very impressive. So this is something that definitely we could have on radar. And if the stocks correct significantly to levels of around 1400, then playing on the demerger, we could actually look at Raymond's at levels of 1400 for a good entry in terms of the special situation of the demerger value unlocking in the weeks ahead.
So that's with regards to where Raymond goes. But another stock that is buzzing on the back of earnings is Care Ratings, JM Financial and IIFL. Three stocks that are in focus. Care 13.5% up move. Let's pull up a JM Financial as well as IIFL as well and see what these counters are doing in trade. JM Financial has cooled off but seeing good amount of strength in today's session. And IIFL. Harsh is standing by to tell us more. Harsh, what has worked for all of these names on the back of earnings or news from the financial space?
Well, hi. Thanks for this. So, first off, I want to talk about Care Ratings. Very strong set of numbers, especially on the bottom line. I'll quickly pull them out. 22% revenue growth, EBITDA up 63%. Why was the EBITDA up? One, it was aided by a lower other business expenditure. And that kind of aided the number with regard to where EBITDA is concerned. Margins up 1100 bips on a YOY basis and PAT up 77% on a YOY basis. So very strong numbers. PAT is now at 43 crore versus the 24 crore number same time last year. In terms of segments, the ratings business is up 25%. Other businesses also seeing a decentish kind of EBIT. They've turned profitable from a loss. Let me just put it at that. And in terms of other expenses, they fell 15%. Other income was up 47% on the back of treasury gains. And there was strong growth, of course. So all of those factors aided the numbers for something like a Care Ratings. Now, let me also look at JM Financial. Now, JM Financial, very different set of numbers. Flat on the top line. But when you're looking at the provisions number, the credit costs have come off very, very sharply. And that's what's aided the profit after tax number. I'll quickly read them out. Total income was up 20% YOY. But in terms of the merchant banking business, which is the investment banking business, the revenues were muted and that contributes significantly to profitability as well. And therefore, profits in that segment, in that vertical has taken a hit. Outside of that, you saw provisions at just 7 crore versus the 256 crore number same time last year. It's also down 94% sequentially, and therefore you're seeing the profit after tax jump. It was a loss of nearly 700 crore same time last year. Currently sits at a profit of 235 crore. So that's the other plus. Something to keep in mind again where JM Financial is concerned. Last off, I want to also talk about IIFL. We've had an HSBC note signaling a 42% upside. They've upgraded the stock. Gold and microfinance recovering is what they are banking on. Credit costs likely to decline. They're expecting ROE of 13 to 15%. Management has guided for 15 to 16% ROE. Capital raising is something that you'll want to keep your eye out on. It's in the pipeline, but they're expecting capital raising to be largely capital accretive or book value accretive, because they believe that capital will be raised at a higher book value or at a higher value than the current book value. They've increased their target multiple from 1.1 to 1.5, which is what has led to the re-rating in the counter for them. And they've also said that the 2-year forward price to book prior to this was 1.8 times, and therefore warrants that kind of a price to book, a very solid upside that they see here as well.
Thank you, Harsh, for getting us the interesting names. Raghavendra, between the three of them, any topics and any commentary?
So broadly, we like the entire space in terms of the brokerage financial services company. JM Financial has done a significant job in terms of maintaining their growth in terms of the bottom line, in terms of their net profit that is going up. So our top pick across JM Financial, IIFL Finance and Care Rating would be JM Financial at levels of 110. We believe that once the revenue also sees an uptick and maintaining a similar profit growth in terms of their margins expansion, there could be a significant re-rating in the stock and even levels of around 145. So that is a 30% upside from current levels for an investment horizon of 12 months is possible in JM Financial. But broadly, we are overweight on the NBFC space, we are overweight on the financial space, and we do like Care Ratings and IIFL Finance. In the bucket of all these three names, JM Financial will be on top of the list, and it's an entry buy at current levels also.
Strong view that we are seeing for JM Financial, and overall a positive stance on the NBFC space is what we are looking at. But a bunch of other stocks in focus, and they're reacting on the back of block deals. In fact, let's pull up something like Swiggy. Swiggy seeing some smart moves in trade today, so about now down about for 1.7%. If you look at something like KFin Tech, that is another stock in focus, and Tanla Platforms as well. KFin Tech down about 5%, Tanla Platforms however up over 9.5%. But to talk more about these block deals, it's still Harsh is with us. Harsh, talk to us about what is happening for these counters.
Let me first start off with a Swiggy, because immense investor interest. So one is 83% of the share capital exits lock-in today. It's been 6 months post the listing, and therefore they exit lock-in. There are various shareholders within this who are now entitled to sell their stake, and they've entered at various price points, but majorly all of them have entered below the current market price, and therefore the current market price looking lucrative enough for them to sell. Some of them, and we've listed all of those on your screen as we speak, some of them actually sold in the IPO as well, and the IPO price was 390, and therefore this current market price, the stock trades at a considerable discount to that, and therefore some may be reluctant to sell this, but others may not, and therefore we've seen a 1% equity traded in 4 blocks today. And therefore the stock is in focus. But that's on Swiggy. Let me talk about KFin Tech. Block deal by promoter. General Atlantic is the promoter, owned roughly a 33% stake in the company at the end of March quarter. They are set to sell, or they have sold at a floor price of 1,025 per share. The offer was around 1.2 crore shares, which represents around a 7% stake. So even post this, they continue to own over 25% stake in the business. That's how General Atlantic and KFin Tech play out. Now, last one is in terms of a Tanla Platforms, and again a very interesting one, because you have the promoter Dasari Uday Kumar Reddy, who's bought 18.62 lakh shares, 1.4% of the share capital. Small Cap World Fund Inc. was one of the sellers, 1.21%, and American Funds Insurance was the other one. They've sold around 0.2%, and they've sold it at 470 rupees a piece. Stock again in focus, because very interesting that the promoter is buying.
Okay, well, thank you for that, Harsh. Now, coming to you, Raghavendra, some interesting names that we've seen. Harsh talked about something like a Tanla Platforms, wherein there was a significant promoter buying which has taken place. Any of these stocks which are in your radar, something from Swiggy, KFin, Paytm or Tanla platforms?
So, Anushri, they have different reasons why we like or dislike. But before we discuss broadly any exit from the promoter group, we rather take it as a negative cue and disappointing like a yellow flag, where some promoters are actually pulling off their money from the company. Broadly, we do like Paytm 197 communication at current levels. We believe that worst is over for the stock. There is a possibility that Paytm could be a takeover candidate across the big names which would like to expand their fintech business in India. So that is one positive undercurrent that could play into Paytm in the months ahead. But broadly, in terms of the RBI punishments or penalties, I think the company stock has come above and over to that and doing extremely well. From a bottom of around 320, stock has more than doubled, and it's a slow and steady up move from that level. So Paytm tops this list. Moving to Swiggy, we do believe that the stock has seen significant growth in the revenue, but what is concerning is the company is still making significant losses. So until those losses stop, company makes into a break even or profitability, that would be very ambitious. But till those times in the next 3 to 4 quarters, we would actually wait and see how Swiggy performs in terms of their revenue going up, but profits also increasing. So until Swiggy continues to make loss, it's an avoid on Swiggy. KFintech and Tanla have some kind of dilutions. In specific to the offer for sale, it could be a special situation where there could be some opportunity considering the huge price correction. But apart from that, in the entire list of stocks where promoters are exiting or there is a significant change of hands in terms of bulk deals and shareholding, we do believe 197 communication, Paytm tops our list as a significant upside is possible even from current levels. From 850, we believe stock can move into 4 digits in the quarters ahead.
Interesting one. So a Paytm becomes a top pick and takeover candidate as well. But let's quickly pull up a Z Entertainment on the screens as well. And if we can have those lines which were flashing at the bottom of your screens with regards to where Aditya Birla's plea has been rejected. The arbitral tribunal has rejected all claims of Aditya Birla Finance against Z Entertainment. And that stock seeing smart gains in today's day of trade, 3.5-4% upside coming in on that one. Raghavendra, very quickly, your view with regards to Z Entertainment, taking into consideration all the concerns around it that you've already seen, and if you have to tie it up with the business side of it.
So broadly, there has been significant news in terms of the takeovers and the cases behind beyond that. But still, even this news is a positive news. We would actually see profitability, revenues, and valuations kind of stabilizing. So Z Entertainment is an avoid at current levels. In spite of this positive news, we would continue to wait and watch and see how the company does on earnings at levels of 120.
120 is what you should be watching out for, and that's where the stock is trading at as well currently. But in a significant update in the pharma industry, US President Donald Trump has proclaimed to cut the prices of prescription drugs and pharmaceuticals in the US by 30 to 80%. Now, this could spell trouble for Indian pharma companies, especially those that have substantial exposure to the US markets. And moreover, I beg your pardon, this could also compel manufacturers to raise prices in other countries. To help you decode the implication of this announcement and more, let's take a look at this report by my colleague Varsha.
India, the world's pharmacy, churning out nearly half the generic drugs that fill America's prescriptions. But the new US tariffs could put that in jeopardy.
The United States will no longer subsidize the health care of foreign countries, which is what we were doing. We're subsidizing others' health care. Countries where they paid a small fraction of what for the same drug that what we pay many, many times more for.
Trump has announced a new executive order to significantly reduce prescription drug prices in US. Now the plan aims for a potential reduction of prescription drug prices to 30 to 80%. Now the pricing is based on most favored nations policy principle. Now Trump will link US drug costs to lowest prices paid by other countries. Now this will provide immediate relief from high medication cost in US according to Trump, which will ensure a fairness for American citizens.
US President Donald Trump is pushing what he calls major tariffs on imported pharmaceuticals, aiming to bring drug manufacturing back home. The problem? The US relies on India for affordable generics, and the tariffs could mean higher prices or even shortages.
And now the order would primarily affect drug administered in doctor's office, and this will apply to medications covered under Medicare Part B, which includes your expensive treatments like cancer medications. And he claims to save trillions of dollars, and this could force pharma companies to raise prices in other countries.
India's $28 billion pharma export industry is feeling the heat. With the US buying a third of India's drugs, companies face a tough choice: absorb the costs or pass them on.
When we think about Indian companies, we are largely going to be affected by how the generic pricing environment changes out there. In my mind, I feel that the domestic pharmaceutical companies, they have created very strong competitiveness. I keep saying that both in terms of their chemistry skills or in terms of their cost competitiveness.
India's hoping trade talks can win exemptions, leaning on its role as a global generics powerhouse. Without a deal, the ripple effects could reshape drug supply chains worldwide.
India has proposed zero tariffs on certain sectors. This comes with certain import limits also set on these certain sectors. The three sectors that are currently being explored for a zero tariff plan are steel, auto components, as well as pharmaceuticals.
The US and India are totally complementary to each other. We are a perfect fit where there's hardly anything, save and except one or two products, where we compete with each other. Otherwise, we are totally two complementary economies.
India's pharma giants are scrambling to diversify, eyeing markets in Europe and Asia. But with the US market so critical, these tariffs could be a bitter pill to swallow.
A bitter pill to swallow in terms of pharma majors. Raghvendra, how are you looking this entire episode that's playing out for the pharma industry? Because you're talking about trade tariffs. Apart from that, you're talking about prices that could be cut as well. So clearly an impact that could be coming in from a margin perspective and on a profitability side as well. Your read of the scenario, and who do you think would be the worst hit?
So Hiral, in terms of pharma, we are looking at the glass being half full as an opportunity, where we are looking at few silver linings for the pharma sector. First being the strength in US dollar versus the Indian rupee, which could lead to a significant margin expansion, where most of the pharma companies are exporting and earning in dollars. The second strength we see, or catalyst we see, is China plus one theory adopted by a lot of companies. So they would actually try to source their requirements from anybody but China, and Indian large cap pharma companies could be benefiting out of this China plus one overall approach. Plus, we believe that in terms of the tariff negotiations, pharma sector could be on top of the list, which could be least impacted. And there is a narrative also coming up where a zero tariff change could be possible specific to the pharma sector exporting into US. So if that happens, sector is significantly beaten down. And we believe large cap names in the pharma sector, Sun Pharma, Dr. Reddy, Cipla, these can be looked upon as great buying opportunities for trading pop once the tariff uncertainty is settled, once the companies report their numbers with some dollar benefits in terms of FX gains, once this China plus one approach comes. So overall, we are bullish on the entire pharma space. And we believe a bullish undercurrent could continue in the weeks ahead.
Right. So, well, that's the view that we are seeing for the pharma space. But let's shift focus to the auto space. Tata Motors will be in focus after the fourth quarter earnings. Puneet joins us with more details on this.
Well, thank you for that. It's expected to be a very interesting quarter for Tata Motors because while there might be a very weakness essentially in the company's quarter four earnings, I think one of the biggest reprieves will be the UK and the US FTA. When you look at the numbers, revenue is expected to rise by just 2% at 1.2 lakh crore. Essentially, they are looking at EBITDA expected to fall by 4% to 16,000 odd crores. This will of course drag the overall margins by 100 basis points to 13.3%. That will be of course a key negative, but it looks like it's baked in as of now because of the sales volume that was down in this particular quarter. Net profit will fall by 56% to roughly 7,662 crores, and that is because we had a big deferred tax gain in the base year, which is Q4 of FY24. So they had an impact of about 9,478 crores in terms of a deferred tax gain last time, and hence that number is expected to come at a fall of 56% in terms of profits. But largely the business on an operations side has been weak. We saw that the EBITDA margin will also contract because of improvement, despite improvement in the commercial vehicle segment, and that's because of the other two verticals, which is passenger vehicle margins expected to fall by 90 basis points. That was because of higher discounts in this particular quarter, and JLR margins are also expected to be lower because of higher warranty costs. That will also be a key negative as well. Overall, the UK-US FTA we've spoken about, this will ensure that Tata Motors can export 1 lakh cars from the UK to the USA, which will be at a concession rate of just 10%. And more so, management commentary on this will be something to watch out for.
Right. Thank you so much, Puneet, for getting us your view with regards to what is expected from a Tata Motors, but you have a Hero Motor that will be reporting numbers today as well. Raghvendra, a quick view in terms of Tata Motors, and if you talk about Hero Motor as well, the expectation is that the profits could jump 8% on a year-on-year basis. Margins, however, are expected to dip slightly, and increase in realizations is what is coming in, and the operational leverage part of it is what is supporting the profitability. Your view ahead of the numbers?
So let me start with Tata Motors. We are bullish at current levels. I think all the negatives are factored in, and going ahead, the demerger of the commercial vehicles and PV passenger vehicle business could be a big positive catalyst. The global sales will see some kind of uptick considering USA and UK have a trade agreement, considering India and UK have a trade agreement, plus the JLR sales in China are actually seeing some good headroom in terms of a low base effect. So that global sales from China, the bilateral agreements between India, UK, US would actually benefit Tata Motors. So negativity is factored in, and a 20% upside from current levels to price of around 870 in a 1-year time horizon is possible in this good corporate governance auto company. Hero MotoCorp, we believe that the management has walked the talk in their previous earnings, and this earnings also this season also could be very good, and a good monsoon could augur well. They have a head start in the EV space in two-wheelers. So Hero MotoCorp at 4,000 levels is a buy. Any dip, any price correction makes it a very good entry level as well. So both Tata Motors and Hero Motors are stocks which one could have on their long-term core portfolio investment basis and should do very well, outperform the market from current levels.
That's with Hero Moto as well as Tata Motors as well. Thank you, Raghvendra, so much for joining us on the show and sharing your views so far. But we'll quickly slip into a short break. Lots more lined up on the other side. We'll be speaking to the management of Chalet Hotels as well as Map My India. Please stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching Profit Buzzers. A quick update in terms of what markets are doing right now. Overall, you're nearly at the day's lowest levels with cuts of around 1.2% coming in. 280 points is the kind of downtick that you're seeing in terms of Nifty 50. Pressure continues in terms of banking majors as well as we speak. Where we close today is going to be an interesting aspect to watch out for. But one company that is in focus from the hospitality space is the Chalet Hotels. In fact, yesterday's session, strong moves that did come in terms of the hospitality sector. If you talk about the quarter as well, the net profits have seen a growth of around 50% this time around. It's the other income which has aided profitability as well, but operationally as well seems to be pretty okay. In fact, let's welcome in our guest. We have Shwetank Singh, Executive Director at Chalet, who joins in. Shwetank, good afternoon and welcome to the show, and a pleasure to speak to you as well at NDTV Profit. My question coming to you first is, if you have to look at overall FY25, seems to be on a strong footing from a top line, bottom line, and your occupancy rates have remained pretty strong with the ARR growth that you've seen. Is this something which is expected to continue going ahead as well, or do you think this was an exceptional year?
No doubt, Hiral. Thank you for having me on the show. No doubt we have had an exceptional year. But the good thing about the way the hospitality industry today is, there's a clear demand-supply arbitrage that we are facing. The demand is growing at about 10 to 12%, whereas the supply is only growing at 9%. So those are clear tailwinds that the industry has. The beauty of the industry from that perspective is that supply can't sneak up on you. So you can see supply coming from a mile away, and that's helpful and allows us to sort of adjust our strategies going forward. So by no means is this a peak of any form. We believe that there is a lot of headroom to grow as we go along.
Right. Shwetank, hi, Mahima also joining in, just to, drive the point home as to what you were mentioning about the entire tourism space, because like you mentioned, this is the Q4 has been one of the best quarters. FY25 has also been an exceptional year. With everything that's happening in the hotel and tourism space, just wanted to get your sense as to how much of a growth are you expecting going ahead in FY26?
Hi, Mahima. Whilst as a company, we are not very, we don't necessarily give out future guidance. But since the macros of the industry remain extremely strong and the locations that we are in have their own locational advantages, so we actually expect the next year to be a strong double-digit growth north of 15%.
So, Shwetank, let's understand the strategic moves that the company has made from acquisitions to development to fundraising. I mean, the Duke's Retreat 80-room resort in Khandala, plus increase your stake in Vikramaditya Renewable Energy as well. You're advancing with a 400-room 5-star hotel project in Delhi's terminal, a 170-room resort in Goa with the land acquisition, and we're talking about a fundraise that had already happened via QIP in 2024. If I have to put all of these things together, where is it that you're seeing in terms of the milestone that you would want to achieve, not say FY26, but even if you have to look at 27 or 28?
Yeah, so thank you for summarizing that. Actually, that's a brilliant summary of where we are heading. And as you would expect, it is part of a well thought out strategy. So whilst we have done a fundraise in the recent future, that's basically to keep our gunpowder dry. That's so that funds are available whenever a particular opportunity arises. Where we are heading with this is we have a clear announced pipeline of of 4,600 rooms today, but we'll pretty soon cross the 5,000 mark. And that's also a holding number. We're not slowing down by any means, and we'll continue to grow in that direction.
Speaking of that, Shwetank, you recently bought Lakeview Mercantile Company in Goa, which is a 15-acre land. Just wanted to get your sense as to what are you planning to develop there? Will that be a luxury property? What are the kind of number of keys that you're planning to add? And what is the kind of revenue growth that you expect from that particular acquisition?
So this one in particular is actually a beautiful land parcel of about 18 acres. It has water view on 270 degrees across and we're also placed on a high plateau. So it's actually a brilliant piece of land that we have managed to sign the term sheet on. The aim here is to develop an upper upscale luxury hotel with about 170 to 180 keys. The designs are still being finalized. Currently, the Goa market is placed at about 18,000 ADR. We expect to be around that number on present day. And by the time we open, we have taken in a growth of about 4.5% year on year. So when we open this resort, we expect to be around 22,000 mark on the ADR side. Goa remains a very strong market and a very deep market. And our belief in Goa, as you can see, is very strong. This is our second acquisition in Goa. Only recently we had acquired another 11.5 acres in south of Goa beachfront property, where also we are developing another resort.
Okay, Shweta, just one more point on that, because we have seen that tourism in Goa has slowed down because of the entire, the locals are complaining about the kind of nuisance that tourists are creating. Just wanted to get your sense on that. You did say that Goa is one of the stronger markets that you're aiming at, but do you think that some amount of slowdown will take place there and that will be overall impacting your contribution to revenue from Goa?
So if you see the numbers of Goa last year versus this year, it hasn't degrown, it has slowed down. But the good thing is that if you were to slice and dice that data, what you'll realize is that the good hotels are still growing. We intend to be definitely in that bracket. The other thing to also note is that the base that Goa is coming off is actually a very high base. So a slower growth is to be anticipated. It doesn't mean it's slowing down, it's degrowing by any means. If we were to look at the airline traffic in Goa between Mopa and Dabolim, actually the combined numbers have grown steadily over the years. And even though Mopa has been a little slow off late in the last couple of months, there has been some degrowth. The overall numbers of people going into Goa remain very, very strong, and we expect that trend to continue. So actually, overall, we don't anticipate any problems in sort of expanding in Goa and spreading our wings there.
Okay. So, Shwetank, the other aspect is in terms of the kind of mix that you would want to promote from here on between luxury, mainstream brands. Is that going to be the focus, number one? And two, going ahead, what is the kind of additions that you're expected to see as well, apart from what you're already developing?
So as a strategy, we have always believed in upscale, upper upscale and luxury segment. We believe there's money to be made there, and we have proven over the years that we've made some good money in particularly being in that segment. So we don't have any current sort of strategy to move away from this existing thought process. Going forward, also we'll continue to be in that space. If you see, the Taj at Dial is in that space. The Hyatt Regency in Airoli is in the upper upscale space, and the others also that we are developing in Goa will continue to be in the upper upscale and luxury space. So that's the space that we believe is most rife and will grow very strongly.
Any new geographies that you're planning to foray into, Shwetank?
So our stated strategy on the development side has been very clear. We believe in big box hotels in key markets, and therefore, if you see, our existing hotels are also in Mumbai, in particular, with very large hotels, and also in Bangalore and Hyderabad. Our second stated strategy has been, because we wanted some geographical diversification, is to go in leisure destinations, but they have to be drivable distances within from a major airport. And if you see our acquisition at Courtyard in Aravali, about 1.5 hours from the Delhi airport, the recent one in Himalayas, Rishikesh, about 45 minutes from Dehradun. So that's been our stated strategy, and that will continue to be the way we look at this expansion plan of ours.
Okay, and in terms of something that I observed in your presentation as well, a slight shift in terms of where the pipeline execution lies, right? The balance of Duke's room will open in first half of FY26, which is supposed to get over by FY25, and the Hyatt Navi Mumbai is expected to now open in FY27, and this has gone from pipeline to unapproved due to change in regulations. Correct me if I'm wrong here, but what has gone wrong there? I mean, what's happening exactly there? And in terms of this particular delay, any sort of impact that you're seeing on your business?
So let me go with Hyatt Regency first. So what has happened there is that there has been a change in regulation from the NGT side, and what the government has asked for is that any approvals that come within 5-kilometer radius of a protected forest has to go through to the center for clearance from an MOEF perspective. Now, what that has done is suddenly it has created a huge pipeline of projects that remain unapproved because these files are going to Mumbai, to center. Just to give you an example, in Mumbai alone, there are circa 200 files that are waiting for approval at the center. So actually, it has come at an unfortunate time for us, and that is what has delayed the hotel. In terms of Dukes, which was your earlier observation, yes, there has been a slight delay, but it is a difficult territory, and we are working on a steep gradient. What has also not been very helpful is that, if we look at inclement weather conditions, particularly rainfall last year was actually 6x the long-term average of the rainfall that one would anticipate in Dukes. So we lost about 40-45 days of work there. All put together, there has been a slight delay in Dukes, but now we are in good shape, and we will soon be opening up our banquet and the rooms along with that. Already 73 rooms are operational. What we have also done is actually upgraded the product, and we are positioning it higher than what we had earlier anticipated in the feasibility. So what was earlier sort of targeted at the 8,000, 9,000 mark, we are now comfortably looking at a 15, 16,000 mark. So all in all, it's actually worked in our favor. Hyatt Airoli has been a disappointment, but we intend to come back very quickly on it as soon as we get our approvals in place.
All right, so that's going to be an interesting one to watch out for. But thank you so much for joining us on the show and sharing the views. So that's the management of Chalet Hotels. Mahima, interesting point is strong 25. Trajectory looks pretty strong as well, taking into consideration the kind of projects that they've taken up. Funds absolutely in place as per dry powder to get that expansion. It's just about how the occupancy and your room rates continue to drive it, and their segment absolutely clear in terms of the strategy that they have to look at super luxury to some extent. So that's with regards to Chalet. But thank you for joining us as well to speak to the management and Mahima, as we know, tracks hotels pretty closely. But moving on, the other stock is a mapping company, that's Map My India, which that's how people know it as the stock is also trading at the day's highest levels as we speak. That's CE Info Systems. My colleague Puneet spoke to the management of Map My India, and overall, let's quickly hear out what they had to say as well on the back of the numbers.
Just want to start off first with this particular quarter, because we've seen the growth momentum essentially continue for the company. I just wanted to first start with the map-led business that's seen a 62% growth in Q4. Growth for FY25 has also been strong. Do you expect this momentum to continue in the next year?
I'll say the momentum will continue at a similar pace going forward overall in the business. As you know, every quarter there are momentum in one area, the other areas like map-led, within automotive or corporate, within or government, within IoT also similar, like whether it's logistics or general IoT.
So let me just get into segmental performance a bit, because you do have a couple of segments. So map-led business is one and the IoT is the other, and then there's mobility as well. I'll just get to that in a minute. The map-led business has been growing more than 50%. We've seen that in this particular quarter as well. But the IoT-led business, which is the newer business, is down 10% in this particular quarter as well. Could you just talk us through a little bit more on the IoT-led business? What is the business like essentially, and how do you expect some growth momentum going into next year as well?
Yeah, IoT-led business is an interesting one. You sell more hardware, in future you get more SaaS revenue. That was the strategy a year back. Last year we shifted the strategy a little bit. We said, let's see what happens if we reduce the sale of hardware. Does our SaaS revenue go up? And you can see from the results that the SaaS revenue went pretty high. So it's the hardware part that increases, leads to at times what you see the growth in the overall number.
So if I understand this right, you mentioned that you wanted to think about reducing the hardware side of the business and see if it has any kind of material impact on the software side of the business, but that's not happened. The software side and the SaaS side momentum has continued. Is that correct?
Yes, that's exactly went up quite decently. So now we have more confidence that will happen. So we'll go back with the old strategy where the hardware sales and the growth you can see.
And if you can just talk us through the customer profile for your IoT-led business, which is, you mentioned about the hardware side of the business as well, because your map side also has a lot of automotive revenue as well, which you cater to a lot of automotive clients. Essentially, what kind of clients do you have in the IoT-led side? And do you expect that to have a higher growth in this year in FY26, because it's of course 1/3 of a map-led business?
Well, IoT-led business cuts across automotive, corporate, and government. So that's one way we look at our overall business of IoT. The second part, we look at what is there in the logistics SaaS business. So between the two is where the overall IoT business happens.
And Mr. Verma, if you can also talk us through, so one, you have the automotive side, which you've spoken about. The other is the consumer tech as well as the digital enterprise business. That growth has actually been quite faster, and that's understandable, because the automotive side, essentially the sales have also slowed down in the industry. Within the consumer tech, there would be a few aspects to look at. Could you just talk us through a little bit of that aspect as well?
In the consumer tech side of the business, what we say C&E, you saw really a decent growth, or rather a high growth. Now that growth, along with the fixed price revenue model, is helping us a lot, because the fixed price is also giving a very high level of predictability. So the business is more moving towards predictable business rather than estimate business.
And Mr. Verma, please correct me if I'm wrong, but a lot of the consumer side of the business essentially would be working in social media. I think you mentioned a little bit in the presentation as well, e-commerce as well. While on the digital and the enterprise tech, you are working in segmental performance as well, right? With BFSI, energy being others. So if you can just split and just give a view first of the consumer side. When you mentioned that you're looking at e-commerce as well as quick commerce, does it essentially mean that you're providing your technology to these companies such as Zepto or Blinkit or so on, or if you can just talk us through a little bit of what that business is for the consumer side?
Okay, without naming the companies, but all the big giants that you know, from e-commerce or from the social media, or from the quick commerce, I think we have penetrated in most of them now. In some cases, we had a very great upsell, and that's what you saw. That helped us in a high growth in Q4 in the consumer tech business.
And when you say segmental performance in the enterprise digital tech business, which is part of this as well, you mentioned that you're doing a lot of work in BFSI as well as energy.
Yes.
Is that comparable to what the listed IT companies would also be doing, or is this something different that you're offering here? Is it more so of a traditional business that's going to this, the land records, the mapping, or is this something else that you're offering here, which is showing the sharp growth as well here?
Well, when you think about BFSI, definitely our business is highly product and platform based, where these BFSI, or even you think of the NBFC like that, land records and all that you mentioned, yes, we do participate in that, but we have always calibrated. That's part of our government business. We have always calibrated that business, and I can share with you that approximately 20% of our revenue last year came from the government business.
And for the governments, essentially, that's a lot of will be land records. Apart from that, anything else that you're doing with the government? And is it more like you're working with the central government, or is it with the states as well? Because we've seen a lot of change in terms of approaches from a lot of states like Maharashtra. We have a newer government in Delhi. Rajasthan and Madhya Pradesh have also been doing a lot of capex in terms of infrastructure. So is it that you're seeing a lot of activity in terms of these states as well, or is it a lot of work with the central government?
No. It cuts across the states, municipal corporations, as well as the center. It's not limited to one. It's also, you might have seen our presentation where we have talked about, creating the government business under the banner of what we are rechristened as Mappls DT. DT stands for Digital Transformation, Digital Twin, and Defense Tech. So we are present in all those three areas, supporting whether at the municipal level or state level or at the center level, and it is through our products and platform with a very little component of services.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Puneet. Well, Puneet, if you look at the markets, the benchmark seems to be taking a breather, but the broader markets, they continue to outperform.
Well, definitely, and we've seen from the day's high as well, We were almost in the implied open in the morning at 8 a.m. We did highlight a 120 point downtick. Post that saw some recovery, almost a flattish opening. But then since then we've continued a downtrend of 24,589 on something like a Nifty 50. The Sensex as well has broken through that mark which we spoke about. It was hovering around 900 point gap down in the start. It's down almost 1250 points. The mid cap and the small cap index as well continuing to hold some positive momentum, but it has tapered down since the last couple of hours. I think at 12 o'clock we did highlight it was up 120 points. It's down up. It's up almost just 35 points now on the mid cap 150. The small cap as well. It is trending in the green, but off the highs by roughly about 80 odd points for the small cap 250. Let's look at the NSE 500 finally, because we've seen a lot of stocks react today, both in terms of earnings as well as a lot of buying and selling in terms of promoters as well. So we've seen something like a K-Fintech see almost 10% in terms of stake sale and promoter stake essentially being changing hands. Rallis is up almost 10%. Bharat Dynamics is the other one which is in the green today. On the negatives, and if you can pull the BSE 500 again, we are seeing some pressure on Aether Industries. We've seen a promoter stake sale there as well. On the other side, some pressure seen on something like an SRF. But that's essentially how the markets are. Let me now welcome in Sneha Podar, who's the Vice President Research at essentially Wealth Management at MOFSL. Sneha, good afternoon. Thanks so much for joining the show. And just want to start off first your view on the markets, because we've seen roughly almost a 300 point down move now. How are you anticipating the benchmark indices to go compared with the broader markets?
Okay, very good afternoon. And what we believe is that given the sharp rally that we saw yesterday, the markets are likely to, though remain positive throughout the week, but it would likely consolidate in a broad range. The overall global cues seems to be quite positive with the easing of the trade tensions between US and China, and overall the de-escalation that we've seen in the geopolitical tensions. So both these will keep the overall sentiments positive. And further, with the FI support coming on the basis of continuous buying that we've seen over the last 8 to 10 sessions. So obviously that provides the further support to the market. So overall trend remains positive for the market, but then given the sharp up move that we've seen in the recent, so the market is likely to witness some sort of profit booking and consolidate in a range before making a fresh up move.
Right. Multiple stocks that remain in focus. They have been buzzing in trade. It's CARE Rating, JM Financial and IIFL Finance. What is the rationale behind these moves in these stocks? Let's go across to Harsh.
First off, I want to talk about CARE Ratings. Very strong set of numbers, especially on the bottom line. I'll quickly pull them out. 22% revenue growth, EBITDA up 63%. Why was the EBITDA up? One, it was aided by a lower other business expenditure, and that kind of aided the number with regard to where EBITDA is concerned. Margins up 1100 bips on a YOY basis, and PAT up 77% on a YOY basis. So very strong numbers. PAT is now at 43 crore versus the 24 crore number same time last year. In terms of segments, the ratings business is up 25%. Other businesses also seeing a decentish kind of EBIT. They've turned profitable from a loss. Let me just put it at that. And in terms of other expenses, they fell 15%. Other income was up 47% on the back of treasury gains. And there was strong growth, of course. So all of those factors aided the numbers for something like a CARE Ratings. Now let me also look at JM Financial. Now JM Financial, very different set of numbers. Flat on the top line. But when you're looking at the provisions number, the credit costs have come off very, very sharply. And that's what's aided the profit after tax number. I'll quickly read them out. Total income was up 20% YOY. But in terms of the merchant banking business, which is the investment banking business, the revenues were muted, and that contributes significantly to profitability as well, and therefore profits in that segment, in that vertical, has taken a hit. Outside of that, you saw provisions at just 7 crore versus the 256 crore number same time last year. It's also down 94% sequentially, and therefore you're seeing the profit after tax jump. It was a loss of nearly 700 crore same time last year, currently sits at a profit of 235 crore. So that's the other plus, something to keep in mind again where JM Financial is concerned. Last off, I want to also talk about IIFL. We've had an HSBC note signaling a 42% upside. They've upgraded the stock. Gold and microfinance recovering is what they are banking on. Credit costs likely to decline. They're expecting ROE of 13 to 15%. Management has guided for 15 to 16% ROE. Capital raising is something that you'll want to keep your eye out on. It's in the pipeline, but they're expecting capital raising to be largely capital accretive or book value accretive, because they believe that capital will be raised at a higher book value or at a higher value than the current book value. They've increased their target multiple from 1.1 to 1.5, which is what has led to the re-rating in the counter for them. And they've also said that the 2-year forward price to book prior to this was 1.8 times, and therefore warrants that kind of a price to book, a very solid upside that they see here as well.
Sneha, Sneha, coming to you on these stocks, any coverage on Care Ratings, IIFL Finance, on JM Financial, any views on these stocks?
No, we do not cover these stocks, but with respect to overall broking industry, the broking companies, I can just share a view that the numbers coming in Q4 was expected to be weak, given the overall the weakness in the cash market as well as the F&O market because of the regulatory changes. So the overall market environment was known, and thus the results were are coming in line with what the street expectation is. But then going ahead, what we believe is that gradually as the market recovers and the overall market activity recovers, the companies especially with the F&O exposure, they'll use the corrective pricing lever, and they'll try to revive their overall revenue growth and protect the overall profitability. So we can gradually from Q2 onwards, we can expect the recovery to start for these broking companies, and the other products that these companies have in terms of diversification, that is whether it's into the gold loans or into fixed deposits or the wealth management, the AMC business. So these will provide some sort of stability to the overall revenue growth that is expected to start recovering from Q2 onwards. So the current valuations are pretty attractive for these stocks, and one can actually do the cherry picking and start accumulating such stocks in their portfolio.
Got the views there. Another stock that's in focus today is Zaggle Prepaid. After the company came out with its Q4 earnings, revenue was up 22% in this particular quarter, coming in at 412 crores. We also saw 25% up move on the EBITDA, with the overall margins up 17 basis points to come at 8.81%. We've also seen the profit actually handsomely grow by 50%, coming in at 31 crores versus 19 crores in the same time last year. And the big jump in net profit is of course led by the business fundamentals, but also a higher other income that's reported in this particular quarter. We've seen the other income go up almost 3.5 times in this particular quarter, and hence we're seeing that kind of growth. But we've also seen the margin expand both on a YOY and a quarter-to-quarter basis as well, and hence that's positive 5% up move on something like a Zaggle. The other aspect to note about Zaggle is, of course, it doesn't have a direct peer in the listed stock exchange. They do provide a lot of services, both in terms of program revenues as well as in terms of gift cards to corporates. But a lot of B2B work is happening with something like a Zaggle does. We've seen the company has its program revenue grow by 16% in this particular quarter at 157 crores, where the Propel platform, which also has gift cards to employees, essentially something like a Sodexo, but on the listed side, is something that the company does. That revenue has grown up 27% to come in at 245 crores. while its new business, which is SaaS, which is still a smaller portion, is just 10 crores in terms of revenue, but that has grown as well in this particular quarter. FY26, they are anticipating a growth of about 35 to 40% in terms of growth, and that's in terms of revenue growth. So that's a very strong number. And the other aspect is the EBITDA margin in the range of 10 to 11% from the current 8.8 to 9% range. Sneha, I'm not sure if you have coverage on a stock like Zaggle, but how do you see these new age startup companies essentially? Because we've seen a lot of investor interest, especially in stocks like Zaggle, something like PB Fintech as well, which is in the banking space or in a something like those kind of companies. So first, if you have any coverage on Zaggle, and secondly, any kind of view that you have on the new age startup companies.
We do not have coverage on Zaggle, but overall, in general, these startup companies, there's a lot of potential because they tap the new age themes which are emerging. And the problem with these companies are that they are front loading a lot of investments in order to expand the business, which is actually delaying the overall profitability. So that is a problem that we've seen with Zomato, Swiggy, or the Paytm, Policy Bazaar kind of companies. So all these companies, they are front loading their investments. But the kind of potential that they have in terms of market penetration, that is really huge. So it's really need to be seen which company's model actually emerges as a successful business model, and that will be known probably over the next 2 to 3 years time frame. For example, Paytm, if we talk about, there were a lot of regulatory hurdles and corporate governance issues that cropped up. But then the company actually cleaned up its book and tackled all the regulatory issues that were highlighted. And now it is again back on its growth path. Ideally, from FY26 onwards, from last few quarters, we've started some improvement seen in the overall profitability, and FY26 should be a turnaround year for them. So we are hoping that a few models from these startups will emerge as winners going ahead, but it's really difficult to say at this stage which will turn out to be the winners.
Right. Cipla is the stock that has come out with its numbers. The revenues seem to be pretty much ahead of what in fact, it was in line with what the street was expecting. 6,730 crore rupees is the revenue that has come in, pretty much in line with NDTV Profit estimates. The revenue has, the net profit number has come in 200 crore ahead of the street estimates. But again, the EBITDA is pretty much in line with what the street was expecting at close to 1,500 crore rupees. The margins have come in at close to 22.8%. The street was expecting this number to be close to 23.2%. So not a big miss that has come in on the margin front, pretty much in line. And again, ahead of what more than what the company had reported in the previous year. 6,730 crore is the revenue. 6,700 is what the street was anticipating. 1,534 is the EBITDA number. 1,556 was the estimate. 22.8% is the margin. 23.2 is what the street was estimating, and the net profit number that has come in at close to 1,200 crore rupees as against 1,000 crore rupees what the street was anticipating for Cipla. Moving on, a host of stocks that we need to keep an eye out for on the back of index changes that is expected to announce in the remaining part of the month of May. In fact, MSCI will be coming out with its announcement tomorrow, that is May 14th, and the flows regarding the same are expected to happen on May 38th. So what stocks will get added? Coromandel International, Paytm and Nykaa is what the street is anticipating would get added into the MSCI standard index, and the inflows in these stocks could be anywhere between 170 to 200 million US dollars, while Thermax is the stock that could move out of the MSCI standard index, and that could lead to an outflow of close to 126 million US dollars. Apart from that, if you look at FTSE, now that FTSE index changes announcement would come in on May 23rd, while the flows regarding the same are expected to happen on June 20th. Now Hyundai, Vishal Megamart, Swiggy, NTPC and Vari Energies are the stock that we need to keep an eye out for, because these stocks could see an inflow of anywhere between 44 to 131 million US dollars. And lastly, when it comes to Sensex changes, the announcement is expected on May 23rd and flows on June 20th. Trent and BL are expected to get added into the Sensex index, while Nestle and IndusInd Bank would move out. Now, BL and Trent could see an inflow of anywhere between 275 to 280 million US dollars, while Nestle and IndusInd Bank could see outflows of anywhere between 135 to 210 million US dollars. Coming to you, Sneha, this index changes anything that we need to keep an eye out for? There are a host of stocks, I understand. One stock in particular I would want to understand from you is Nykaa. Now that could get added to the MSCI Standard Index. 170, 175 million US dollars of inflows are expected. What is your view when it comes to Nykaa?
Okay, on Nykaa, we are not really very confident because the kind of competition that the company is facing, both with regards to online and the offline format that they have. So we are a little skeptical on it, though they have shown improvement in terms of
Right, we'll get back to Sneha on Nykaa's view, but then another stock that we need to keep an eye out for is M&M Finance. Now, they're looking to do a rights issue of close to 2,996 crore rupees. Now, the rights issue is priced at around 194 rupees per share, which is at a steep discount of nearly 25% to the current market price. The rights issue ratio is for every 8 shares, the shareholder will get 1 rights equity share. However, the estimated ex-rights issue price, that is at around 250 rupees, which is just at a discount of close to 3% compared to the current market price. Now today, in fact May 14th is a record date, which means that today is the last day for any shareholder to buy the shares of M&M Finance if they want to participate into this rights issue. And the rights issue will open on May 22nd and will remain open till June of 6th. Now, what are the sequence of events here? Now, if you are eligible for the rights issue, then the rights entitlement firstly will be get credited to your account on May 21st, and you can trade this rights entitlement from May 22nd till June 3rd. Now, what is a rights entitlement? Rights entitlement is a temporary credit of this rights shares, and investors can either choose to keep this rights entitlement and subscribe to the rights issue, or else they can go ahead and sell this rights entitlement in the market. Now, what existing and old investors should do in case of M&M Finance? They can consider selling the rights entitlement as and when they get credit to their account, because the estimated rights entitlement price stands at around 63 rupees. Now, assuming an investor has around 8 shares, they'll get 1 rights entitlement, which will be priced at around 63 rupees, which means that, and if you sell that, it translates into a dividend or gain per share of close to 7.88 rupees. Now, this will be the highest ever dividend, or M&M Finance has never paid such a high dividend in past, so this could be a good gain coming in for the existing or old investors, and the implied dividend yield would stand at around 3%. Now, if they choose to keep this rights entitlement, then there is too much of a hassle that is involved. They need to keep a track of the payment dates over a period of time, and if they fail to pay, then this rights issue will be forfeited. And what can new investors do in case of this M&M Finance rights issue? Well, there is no trading opportunity, as the entitlement is not too much in favor. You spend a lot more to get a very limited amount of shares. You're buying 8 shares and you're just getting 1 share. So there is no much of an arbitrage left here. And so hardly any gains if one buys fresh M&M Finance shares for arbitrage. So no arbitrage opportunity here, but old investors can go ahead and sell the rights entitlement.
Well, thanks for that, Somit. Actually, a very interesting point, essentially, in terms of M&M Finance as well as the right entitlement that is there. The other one, a couple of stocks I want to mention specifically from the auto pack. One is Hero MotoCorp. The company is expected to come out with its earnings today. And while we've seen the quarterly sales come in at a very tepid growth rate, revenues also just expected to rise by 2% in this particular quarter. Margins are expected to fall by 10 basis points to come in at 14.2%. With the overall profits as well expected to rise by 10%. Now, revenue growth is expected to help because of higher realizations that the company had in this particular quarter. They've also taken a price increase, so that will be visible in the revenue growth number as well. The other key aspect is the EBITDA margin. That is contracting despite having a higher revenue growth, and that's because of higher marketing expenses in this particular quarter. We also had the Bharat Mobility Auto Expo in January this year. They've also had a couple of launches in the 125 and the 160cc space of scooters. So that will impact the EBITDA margin, while the overall profit will be supported by operating leverage, and hence we are seeing that beat of 10% as well. So talking about the sales number as well, it was very typical, just 0.7% growth for something like a Hero. 13.8 lakh units is what they've sold versus 13.9 in the same quarter last year. We've also seen that the sales have actually deteriorated by 42% in the month of April compared to April of 2024. So I think more than the numbers, a lot more will be looked at in the commentary for something like a Hero MotoCorp, essentially because we've seen companies like Bajaj as well report 6 consistent months of decline in the domestic space for two-wheelers. So that will be a key negative as well to watch out for. And what the management expects in terms of commentary, we had roughly about 6% growth for the industry in FY25. If that continues, will that have a higher growth rate in this year? That is definitely something to watch out for. The other stock in the auto space which is something to watch out for is Tata Motors. Again, expected to come out with its earnings. Now we are expecting, a similar trajectory for something like Tata Motors because the sales haven't been supported, essentially the financials. So revenue expected to rise by 2%, 1.2 lakh crores is what is expected in terms of revenue. We're also expecting the margins to fall by 100 basis points in this particular quarter to 13.3%, and the overall net profit is expected to actually fall by 56%. Now the key reason for this big fall in net profit is because in the same time last year, which is quarter 4 of FY24, the company had a huge tax write back for Jaguar and Land Rover worth 9,400 odd crores, and hence there is a base year effect. Last year the net profit was roughly 17,000 crores, but largely supported by the tax write back, and hence we're going to see that fall in profit, but that will be something to watch out for. We have to remove that aspect of tax write back and then compare it with the numbers for profits. We've also seen that the EBITDA contraction is expected in this particular quarter, and that's largely led despite the improvement in the truck business for something like a Tata Motors, but the passenger car business hasn't supported that, and that's because of higher discounts in this particular quarter. Finally, the one key positive though, and that is something which has come in favor of Tata Motors just in the last 2 days, is the UK-US FTA. Now under this FTA, manufacturers like Jaguar and Land Rover will be able to export 1 lakh cars to the USA at a concession rate of 10%, which was expected to be 25% earlier based on the US tariffs. So that is the only key positive aspect, and I think the company will also be talking about this particular aspect overall. But Swamit, essentially the UK-US FTA coming at a very important time for Tata Motors in a quarter there's not much to talk about.
Well, yes, multiple benefits. In fact, the India-UK FTA and the US both will benefit Tata Motors. Moving on. India seems to be taking a tougher trade stance against the United States. In a formal notification to the World Trade Organization, India has proposed retaliatory tariffs on the range of US goods in response to Washington's continued duties on Indian steel and aluminum exports. The move, if implemented, could mark a significant moment in India's evolving trade strategies, especially with bilateral talks with the US still underway. My colleague Rishabh joins us with more details on the same.
Right, so Amit, what we saw coming in from the WTO last night was sort of a shift in stance that India is portraying, especially given the fact that there are ongoing bilateral talks going on with the USA. Despite that, India has chosen the platform of the World Trade Organization to actually register its protest and also file potential retaliatory duties against the US as well. I spoke to a couple of experts. What they had to say was the fact that this is surprising. It comes at a delicate time between India and US relationships. Obviously, the global trade, the global tariff wars, the uncertainty is still very much there. It is also signaling India's tougher stance at the WTO, but it continues to remain within the WTO's rules and regulations as well. What Pankaj Chadha of EEPC, the Engineering Exports Promotion Council, told me was the fact that this move is heartening. It shows that we still have some sort of a voice at global stages, but the situation remains volatile. It remains flexible given the fact that these duties have just been proposed right now. They have not been implemented. The potential date of implementation could be 30 days from now. So around June 8th or June 10th is when we can expect certain duties if the US does not withdraw its counter duties, or if the US does not invite India to the negotiating table with respect to these tariffs. So the next 20 to 30 days, we'll be keeping our eyes peeled on what sort of action the US now takes, given the fact that the ball is now in Washington's court.
Well, thanks for that, Rishabh. But the other key aspect and story is actually coming from the pharma space. We've seen the US President Donald Trump sign a wide-reaching executive order on Monday, He's mentioned directing the drug makers to lower the prices of medicines to align with what the other countries have. Now, we've seen, we told a press conference that the government would impose more tariffs. The prices in the US do not match with what those other countries are. Let's get my colleague Varsha to tell us more about this particular news flow.
Trump has directed drug makers to lower US drug prices to match those paid by other countries, and he aims to reduce price between 59 to 90%, and he has given drug makers 30 days to set price targets and promises further actions if companies don't make significant progress. Initial fears of most favored nation price caused drug maker stock declines, but stock recovered and rose on Monday as order was seen as less severe than anticipated, and shares of Merck, Pfizer and Eli Lilly, which are the innovator pharma companies, all rose. If drug makers don't comply, government will use rule making to enforce international pricing according to Trump, and he'll consider importing drugs from other developed nations, and he'll consider export restrictions, and he has directed FTC to consider enforcement action against anti-competitive prices. Let's see what are the brokerages view on that. Citi says that executive order to cut US drug prices, and the reasons behind high drug prices lie in the insurance system and partly reflect the margins taken by middlemen, and simply lowering headline drug prices may not resolve the issue according to Citi, and view such headlines as negative, especially for pharma companies like Sun Pharma. Generics would least be impacted in their view from this order. While Macquarie has the same view, he says that most favored nation pricing model for prescription getting restructured, and the Sun Pharma sells branded medication in the US market, which could be impacted. And according to Macquarie, generics are much lower prices than their branded counterparts, and generics won't be impacted. So both the brokerages are of view that Sun Pharma is the only counter that would be impacted.
Well, with that, it's a wrap on this edition of Top Trades. Stay tuned and keep watching NDTV Profit.
That's huge. That is a biggie. It's out of there.
गोल्ड क्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims. Is the outlook as rosy as the company claims? Know your company. Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. Let's talk about where the Nifty is at the benchmark. Seeing a bit of pressure today, but when you contextualize it over the last couple of days, we saw a 900-point rally yesterday. So this bit of cool off of around 300, 350 points won't really bother investors as much. Hopefully, 1.4% lower on the index. So clearly some bit of pressure. Let's look at it intraday and let's see how the trajectory has been. Well, we're sitting at the low point of the day and we started off at the high point of the day. So there's been a bit of a decline, especially over the last hour or two, and a gradual one on the index at least. Let's look at the contributors, and some of yesterday's positive contributors are contributing negatively. So HDFC Bank contributed 110 positive points yesterday, Infi around 90 odd positive points. So a couple of those stocks in focus. Bharti, obviously results awaited, those will come shortly post market close today. But what's doing well is defense, and BEL right at the top. When we are looking at the heat map as well, likely you'll see BEL being one of the top gainers. There you go. You see that 4% higher on a BEL. Dr. Reddy is also doing well. Some flavor of pharma and some defensives coming into play, including the defense sector as a whole, which is really shining in trade today. Outside of that, you're seeing pressure on IT as well. Infosys, TCS, HCL, Tech, all of those in that bottom basket of stocks within the Nifty 50. Even a Wipro is down to 2.5%. So those are the pockets of pressure. Let's look at the sectors as well before I toss it to Neeraj for broader markets. That's how the sectors are evolving. Pharma is doing well. PSU banks are doing well as well. And then you have the Nifty Defense, which is up 4%. What's not doing well is an IT, and FMCG is down 1.5%. We haven't spoken much about that, but we will through the show today. And the Nifty Metal and the Nifty Realty Index also down around 1 to 1.25%. The Nifty Auto also throwing that one also into that same basket, around 1 to 1.25%. So that's where some bit of the pressure is as well. Let's look at the advanced decline very quickly. There you go. That's how it is. A slight shrink that we're seeing, but advances outstrip the declines, which clearly means that broader markets, there is traction. Neeraj.
Yeah, I mean, relative traction for sure, because it's 0.44% higher than Nifty small cap 250, if you can pull that up. And then beyond that too, there will be specific pockets which are doing well. So I mean, just the simplest way to think of this, if you bring up the components of the Nifty Defense or the Defense Index, right? Or you will see that from a Bharat Dynamics to a Zen Technologies to a Garden Reach Shipbuilders, the clutch of names out there which have had some stupendous gains in the session today. Then promoter buying leading to Tanla Platforms doing about 9% in the session. So that is one to keep an eye out for. There is strength in CNC manufacturers. Jyoti CNC is back up in the gainers list. 4.5% higher for that one too. So that's done okay. Stocks in which there was some results pressure have kind of been weak. So SRF is slightly wobbly. UPL slightly wobbly today, down about a couple of percent or 3 or 4 percentage points a piece for both of those. We saw KFin Tech with the block deal under a bit of pressure, and the reason why this pressure would be there because they've sold 7% stake, but another, I mean, total of 33% with those shareholders, General Atlantic Singapore, right? So I would suspect that the street might believe that there might be continued pressure on this one until that selling mood is out of the way. So keep that in mind as well. But defense is the sector to really focus on, and we try and talk about that as well. Harsh?
Okay, so those are some sectors, pockets to talk about. But on the benchmark, and let's quickly take a view. Kush Bora, founder kushbora.com joining us. Let's quickly take a view on the index, Kush. Okay, I believe we're still, believe Kush has dropped. So well, we'll quickly discuss a few stocks. And while we are at it, you look at a Tanla Platforms, you're looking at Allied Blenders up 8%. There's a fundraise which is likely coming there. You have a Gensol which is up 5% on the back of both of the Jaggi brothers resigning from the board of Gensol. Cochin Ship is up 4%. That's likely on the back of the way in which defense in any case seems to be moving. So those are broadly how sectors and themes are playing out. But let's go straight across to Kush joining us. Kush, on the index, 1.3% lower today. Yesterday, we had a fabulous day of trade. Is this par for course or would it worry you?
Hi, Harsh. First of all, very good afternoon to you and to all the viewers. Higher they go, harder they fall. We've heard that before, right? So that's exactly what is playing out, which is, we've had a much higher than expected run yesterday. Now, the fall that we are seeing is perhaps a little too sharp for everyone's comfort. But if you ask me, I think this is par for the course. There's a good support zone near the 24,350 to about 24,500 zone. So as long as that is intact, I think, we are in good stead. The rally that had began, before, the cross-border tensions came about, I think that will resume. And 24,800 as a target was hit, but I think we'll move again towards 24,800, 25,000 very soon. So I think fairly par for the course. A dip closer, to 24,500, which we are seeing right now, should be taken as, a buying opportunity. The only thing is that, all throughout the day, the index, has been moving lower. And the moment you find some kind of strength coming in is where you should go out and buy. I think that should come somewhere close to 24,500 as the put options data for this weekly, options expiry is also suggesting.
And what about the Nifty Bank, Kush?
Well, an interesting move on this one. So if you see the fall that began, late April, twice, yesterday and today, both the times, 71% retracement, 72% retracement on this one, and the turnaround has happened from those levels. So once again, 55,500 will be the level to watch for on the upside. I think down, on the downside, you've got a good support near the 20-day moving average, which is very close now, which is 54,500 thereabouts. So I think any dip closer to those levels will be taken as an opportunity. I would have actually given an all-out buy call had it not been the fact that we are actually at the low point of the day, for the Nifty and Bank Nifty both. I think after a brief hiatus with the likes of HDFC Bank, ICICI, and SBI to some degree correcting, we did see some buying interest return to those names. I think that will continue. HDFC, SBI had seen a sharper dip compared to ICICI. I think those are the pockets which could still trade and invest in from a near-term perspective. Both the indices on a fairly good footing. This this dip that you're seeing, once it once it rests near those support levels, I think this will turn out to be a good buying opportunity once again.
And Kush, your picks for this afternoon, therefore.
So going with two long calls, one of them is Larsen and Toubro. Again, we've seen a good move on this one over the last 2 days, some profit. The rest of the market, but a good support zone, around the 3,500 mark. So from a long perspective, 36.80, 37.70 are your targets. 34.95 is where you place that stop loss. GE Vernova TND, this one has had a very good run over the last month and a half, and that run has practically been agnostic of whatever the market was doing, and it had good weekly gains as well over the last 3 to 4 weeks on the back of fairly decent volumes. So from a positional standpoint, 1745, 1795 are your targets. 1640 is where you place that stop loss.
And Kush, before I let you go, difficult to not talk defense on a day like this. What's the view like on defense? Because we've seen quite a few days where defense has really outperformed.
Harsh, I think defense is now becoming, a structural play with whatever, just recently transpired. Defense has had, a longish period of consolidation profit booking as well. You've seen, a goodish bit of rally come around in the last 2.5 months. I think now with whatever profit booking had to come in yesterday, I think from today onwards, there could be a new rally that will emerge in some of these names, including the likes of HAL, BEL, BDL. All of these will also start seeing some traction. Not particularly fond of the shipping names, but if you talk about the Idea Forces of the world and HALs and BES of the world, I think this is a good time to start accumulating them. not only from a near-term perspective, but I think from a medium to a long-term perspective also, they are now starting to shape up rather well.
Okay. That's one, but actually, Kush, sorry, I know Harsh said we're letting you go, but just one quick, very quick follow-up question. Is there a trade in any large cap IT name?
So I think they're starting to shape up rather well, Neeraj. After whatever's happened with some of these names, I think they're starting to shape up well. We did like HCL Tech for some time, and we continue to like that. It's just that they're not having a clear, runaway kind of a rally. So if I were to pick one, I would still go with HCL Tech. Infosys also is actually giving a breakout, but the inside bar that is forming today is suggesting that there could be some pressure, around the 1625 mark. So I would go with HCL Tech, but I still believe that there is a lot of steam in the mid cap names like Persistent and so forth. But yeah, among the large cap ones, you'd want to stick to an HCL Tech. On the downside, if you're trading, then your stop loss is at 1575, and on the upside, the recent swing high close to the 1695 mark. And once that is taken out, 1745, these become your target.
Right, Kush, actually we'll request you to wait back, because what we're going to do is we're going to have a quick conversation with the management of Zaggle, and then maybe circle back to you with regard to views. Zaggle, the stock perked up 6% in trade. Avinash Godkhindi, the managing director and CEO Zaggle, joining us this afternoon. Avinash, you gave us a guidance FY25 full year. If I recall right, of 58 to 63% top line growth. You've done 70%. Believe you've guided FY26 at 45 to 50%. Please correct me if I'm wrong here. You believe that there's an upside bias to that guidance, and what would the target be on this base? Could you beat the 40 to 50 odd % guidance that you've given for FY26 as well?
Thank you for having me on your show, Harsh. Yes, we've done very well this year, and we're delighted by the numbers. Of course, there's always scope for improvement, but the numbers have been great on the top line side. PAT has doubled. EBITDA has grown very strong. So every metric, cash flow has improved significantly. So we are thrilled with our results. Our guidance for the next year on an organic standalone basis is 35 to 40%. And that's what we are guiding for, including the potential acquisitions. If they happen before September 30th, it could be as high as 80%. But right now we're sticking with our guidance for the organic Zaggle, which is 35 to 40%. And we are guiding this number today, given how uncertain the times are with all the things happening around the world and in India. But there's always scope for this to be moved up as we see the year.
Right. Avinash, one key piece, and I'll stick to the financials for maybe a minute or two more. One key piece is that I see your cash flow from operations turns significantly positive versus the negative number. What's changed this year, and what's the direction like for FY26? Because that's the key number. Your receivables have gone down.
Yes. Thank you for that question. We've always consistently held, Harsh, that we are working very hard behind the scenes to improve our cash flow position. We have historically always been a cash flow positive company for the longest time in our 14-year history. It's just the last 1 or 2 years that we turned negative. And we were very clear that this has to change. And we've been able to improve that very significantly. And that would be the trajectory in the coming year as well. We are extremely focused on improving our cash flows. And that's something that we are committed to making it happen.
No, so just contextualize it for us, Avinash. Clearly, you're keen on that cash flow from operations number getting better. Direction-wise, we take your point. Want to try and understand what was the difference between the last couple of years to now? Is there a particular client cohort that you were targeting which required this kind of working capital requirement? Just explain what's gone about over the last maybe 2 to 3 years.
See, what happens in our business is a lot of our receivables are from banks. And when we went IPO about a year and a half, close to 2 years ago, last September 23, we had 4 partner banks. Today we have 16. Right? And some of them are public sector banks like SBI Cards, like PNB, Bob Cards, etc. And each bank, given their size and given their nature, has their own approach to clearing their payables. So we worked very closely with these banks, explained to them the nature of our business, why they should be clearing those invoices quicker, and that has helped. There's still significant scope for improvement. We've also worked with some of our corporate customers to make sure that the terms are such that we improve our cash flows. And it's just a lot of work behind the scenes, common sense, putting a lot of focus on that. In our business, it's a lot of getting the basics right, and that's what we've been able to do. No rocket science, to be honest.
Avinash, good afternoon. Neeraj here. As you look forward to FY26 and beyond, naturally the pace of growth at a lower base over the last 3-4 years may not be able to be replicated in the years to come. Is FY26 the pace of growth that you've guided to, which is lower than FY25's, is that the new normal, or do you reckon FY26 is a one-off for now?
See, Neeraj, one thing is the guidance that we've given right now, two important factors. One, it's on a standalone basis. In the console basis, if the acquisitions that we are looking at, if they close in the first couple of quarters, then you'll see a much higher growth. So our growth strategy is both organic and inorganic. The second thing, of course, is we are being conservative. We are being cautious given the environment and given the fact that it's beginning of the year. We like to under promise and over deliver. And that's what we are trying to do. So if you recall last year as well, when we started off the year, our guidance was about 45 to 50%, right? And we consistently saw traction kick in. And we were able to up that guidance. By last quarter, we were at about 58 to 63%. So I'm not promising that that's what is going to happen, but that is the kind of thing that we like. Rather than promising 70% and doing 68, we'd rather promise to you at the beginning of the year 45, 50% and then deliver 68.
What you've guided is impressive enough as well, Avinash. I speak to a lot of CEOs who say that trying to grow at a much higher pace might actually lead to accidents. So might as well grow at a sober pace for a longer period of time as opposed to grow at a very quick pace for a bunched up 2-3 years and then suffer. But to each their own. The second question that I have on this, Avinash, is because it's a slightly different industry, right? And I'm not saying it's probably as large as IT was back then, but back in 2000, if you ask an IT CEO about the number of years for which they could grow at 15% or higher or 20%, they would have easily said that it's, whatever, a decadal growth or maybe longer, etc. And they've done that. You reckon the industry that you are in, you could grow at a reasonable growth rate for an X number of years? So, and therefore, what is that X number of years and what is that reasonable growth rate? If I can try to ask you to crystal ball gaze.
See, this is a decadal growth story for sure.
Starting now or starting back in 2020?
I would say starting in the last couple of years for Zaggle, post-IPO, right? And spend management as a category is a category. See, 30 years ago, ERPs were unknown. 20 years ago, HRMS. 10 years ago, CRM. Today, these are all established categories for corporate, solutions or softwares, right? So spend management 10 years down the line, we strongly believe in India would be a story that everybody knows. And just like in, ERP, you talk of SAP, Oracle, in the same way in spend management, when people talk of spend management, they'll say Zaggle. That's our goal. That's what our belief is. That's what we are working towards, and that's what we are seeing. So we are category leaders in India. We are growing globally. We've also, in the analyst call, announced our partnership with Mesh Payments, which is a US-based T&E company where we will serve their large companies in India here, and they will serve our companies who are Indian MNCs who are having operations there with their corporate card solution. So that's going to be, again, another growth driver for us. So multiple opportunities to be able to grow both domestically and internationally. And spend management as a category is bound to grow because economies are growing, spends are growing. more and more of these spends are getting digitized, and AI is really changing the game, right? And AI is going to make sure that all of us are much more focused on efficiency, optimization, and that really helps our business.
Avinash, I'll go back to your guidance and your numbers. 1,300 crore in terms of top line today. If you do an 80%, it's roughly 2,400 crore next year. I also understand that factoring in an 80% growth rate will likely mean that there will be acquisitions along the way as well. Are these acquisitions likely to be margin neutral at the very worst for you? Is that how I could term it?
So, Harsh, our guidance to the street right now is to look at the 35-40%, growth organic. As and when the acquisitions close, obviously those numbers will add, and if they close before 30th September, we'll be able to add that. But yes, these will be, EBITDA accretive, apart from some extraordinary opportunity that comes our way. It's an offer or an opportunity too good to refuse. By and large, we are looking at EBITDA accretive, opportunities. And that's a focus area where multiples are much more attractive for us. That's how we're looking at these opportunities. And that's why it's taking a little while to close these deals. We raised our QIP in December. And we knew that we would take some time because we knew the targets. We had very clear ideas around it. But we want to make sure that we are able to extract the best value for our investors and create win-wins.
Point taken. Avinash, give us some color on the ticket size that you're looking at. Is this going to be a different geography at all? If those are the kind of acquisitions you're going to make, what's the nature? Is it going to be largely in the space that you operate in? Are you going to diversify in terms of your service providing? Just give us some texture on that.
Yeah. So in our space, spend management and adjacent spaces, by and large, right now looking at India, but there are a few opportunities that are very attractive in certain global geographies which we are evaluating. We've already given a sense that we are looking at, Middle East and maybe the US, but of course the US is every day is a new day, so we take it as it comes. But by and large, in and around the space that we are, adjacent spaces, and looking at EBITDA accretive.
And Avinash, you've also guided that your margin starts to hit mid-teens maybe in 2 to 3 years from now. At least that was the last guidance. I unfortunately have not been able to attend your con call, so not sure if that guidance has changed. Just give us some perspective on that and the journey, maybe over the next 2 to 3 years. Could you give us some perspective as to how you expect your margins to grow on a current steady state basis? I mean, if you acquire, of course, that may be subject to change.
So for our this year, our guidance is 10 to 11%. Last year, we had guided our EBITDA to be adjusted EBITDA to be in the range of 9 to 10%, and we were able to achieve that. This year, our guidance is that it will expand to 10 to 11%. And in about 4 years, we're looking at a EBITDA margin of about 15% overall. That's how that trajectory would move. And obviously, it wouldn't be a step up. It would be it would be year on year improving by about a percentage point, give or take.
But which is very interesting, because if you, let's say, grow at whatever rate you grow, you said it's a decadal opportunity, and you grow anywhere between 25 and 50%, right? Let's assume CAGR. But if at the same time, parallelly, if your margins are growing, then you are effectively telling us that your bottom line growth for the next 5 years, considering that you move margins from 9% currently to 15%, could actually grow much, much better than what your top line growth will be.
Yeah, possible. Yes, that's what we are aiming for. That's what we are seeing. Absolutely. Yeah.
Sorry, I haven't looked at the this thing, but I presume the business like yours doesn't get too much of debt, right? The debt numbers will not be too heavy per se.
No, hardly any debt.
Yeah. So okay, then so therefore very good top line growth, better bottom line growth. I'm presuming return ratios would look good. You are growing. All of that is great. Inorganic moves, in order to do these, would internal accruals be enough? Sorry if Harsh has asked this to you already, or would you need to raise any kind of capital?
So we did a QIP of 595 crores in December, right? And that, along with the internal accruals, and we'd obviously want to make sure that we are getting the right win-wins there. So work with incoming CEOs, founders, promoters, and make sure that there's a good earn-out for them as well. For our current plans, this is more than sufficient. We don't see us raising further capital, at least in the near future, for sure.
Avinash, my last question in two parts. One, is it very easy to replicate the model that you currently have in India into other global and other parts of the globe as well, or is there competition there and the rules different? Part one of my question. Part two, can AI materially disrupt a business like yours? Does it worry you, or does it enhance your proposition?
I'll take the second one first. AI absolutely excites and energizes us. It's brilliant for our type of business. It's a great tool for us to enhance, both the value proposition as well as our own internal productivity. And look, for a business like ours, where there are complex integrations with banks, with ERP systems, with HRMSs, with complex regulatory frameworks, because you've got a lot of corporate credit cards, forex cards, prepaid cards. The AI is a great tool to enhance this business. AI completely being able to disrupt this business is not something that is possible, because of the number of integrations and the number of complexities that you have in terms of regulation. And that's precisely the reason why you got players like Mesh and others who are looking at India for their customers, who are like very large global customers and who are setting up GCCs here. They need a strong local partner like Zaggle for all their travel partnerships and their corporate credit card and prepaid card and forex card needs. Globally, there are a bunch of companies which are listed, and multi-billion-dollar companies like CorePay, which is an NYSE listed company, Vex, NYSE listed, multi-billion-dollar companies, Brex, Ramp, Pleo, Payhawk in Europe. So there are a whole host of spend management companies which are very scaled up, multi-billion-dollar companies. And this is an established space now in the developed markets. In India, of course, we are getting there, and Zaggle is leading the charge.
Okay, Avinash, we'll leave it at that. Thanks so much for coming in and speaking with us and telling us candidly and comprehensively on what the plans are with regard to Zaggle. Stock perked up 5% on the back of what were a very solid set of numbers. Anyway, we'll take a quick break. On the other side, what we're going to do is we're going to take Heard on the Street, which is Somi getting us all of the chatter in dealing rooms, and we'll start discussing individual stocks. So stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to see.
Welcome back. Thanks for staying with us on India Market Close. Gale's numbers at the bottom of your screen. EBITDA up 13%, top line up just about 2%. And when you're looking at profit after tax, it's down 47%. In terms of its estimates, the numbers largely looking in line. But what we're going to do is, before I get ahead of myself, I'm just going to wait for Somit to get back on exactly how he's viewing the numbers. So we'll wait for that. The stock just hit the low point of the day and has rebounded from there. So seeing that movement with regard to where stock price is concerned. Also, there were Cipla's numbers which were announced. Their Q4 numbers posted a good set of numbers. In terms of how the numbers looked, I'll just quickly pull them out. They're largely in line with expectations. You had revenue at 6730 crore versus the 6700 crore estimate. So it was up roughly 9% on your screen. EBITDA was up 17%. Again, maybe a couple of percent lower than what our estimates were indicating the number to be. 22.8% margin, again steady at the estimate was at 23.2, so largely steady in that sense. And profit after tax came in a solid 30% higher at 1222 crore. Let's discuss this and more. Let me bring in Aditya Shah as well. Kush Bora obviously still with us. Aditya Shah, founder, Hercules Advisors, joining us. Aditya, I want to try and cover a couple of numbers. One is Cipla, of course, but I also want your take. Actually, let's do Cipla first. Aditya.
No, first the numbers look really very okay, but the main trigger point now is Trump's tweet yesterday, where he said that we are going to lower the drug prices from 30%, between 30% and 80%. Cipla's major portfolio is Opthal portfolio, which is in the US, and if there is any movement with respect to lowering the drug prices, all these generic companies like Sun Pharma, Cipla, Dr. Reddy's are going to take a hit. So from my perspective, I'll be very careful on the generic pharma who are operating, especially in the United States. A lot of these companies could see further price erosion apart from the pricing pressure that they already feel. So from my perspective, I'll be really very, very careful on the generic pharma companies, which especially operate in the US.
And Aditya, then you have these chemical stocks, especially agro, something like a UPL, something like an SRF. What's the take with regard to those? Because I know that you like an SRF from what I recall. What's your take on the numbers, and how would you view the commentary? What's the direction looking like in terms of business? Because numbers weren't looking too strong in that sense.
I tend to disagree there, Harsh. The chemicals business within SRF reported fantastic set of numbers. The revenue growth was at about 30%. The margins continue to remain really very strong. Today the stock is down because SRF is already rallied this year by about 35%, and this is just a reaction to the results per se. From my perspective, I am seeing across the agrochemical space companies tending to recover, and the bet that at the end of 25 or somewhere early in 26, these companies will tend to recover is slowly and steadily starting to materialize per se. Naveen Forin reported very good set of numbers. SRF also on the chemicals business has reported very good set of numbers. So as I keep saying, Form is temporary, but class is permanent. Both Navin Fluorine and SRF will continue to do extremely well as the refrigerant gas business continues to do exceptionally well for both of these companies. So I'm positive on agrochemical space as well as chemicals per se. The recovery, painfully slow, has been over the last 2 years, but that recovery will slowly and steadily start to materialize by the end of this year and early next.
Okay, you don't want to talk numbers on your screen as well. The surprise element out there, nothing great, but the surprise element to my mind might be that the margins have actually done a bit better than what might have been anticipated, because actually no, the revenues also had slightly above what was estimated. The bottom line though is below. So I wonder what's led to that. The expectation was of a 2% revenue rise. It's coming at 4.4. Margins may be slightly lower. Let's wait and watch what happens there. And but the PAT number, nothing untoward. It's almost everything seems to be largely in line with estimates right here. Margins in line with the NDTV Profit estimate of 14.2% as well. So no big changes out there in terms of what is delivery versus what was anticipated, which is why maybe a flattish number on Hero. While Puneet comes in and talks about that, actually Aditya, very quickly, any initial thoughts on Hero, and then I get in Somit for GAIL.
Okay result, but the valuations are comforting, so I'll be very interested in this.
Okay numbers, but valuations comforting, so interested in that. That's Aditya's call. The results don't do anything. The valuation number is a completely different story altogether. Keep this in mind. We'll get in Puneet in moments from now to talk about that. Kush Bora, I wonder if there is a trade that you see here. There is a bit of a spike which may cool off as well, because I don't know if Harsh sees anything different. I don't see anything in the numbers which would lead to a material spike, but purely looking at a slightly medium term or short term charts, is there a trade in GAIL in Hero?
There most certainly is now, Neeraj, because if you look at the price movement, today's action is actually a follow through on what happened yesterday. Yesterday, the stock was up 3.5% on the back of fairly decent volumes, and today you're seeing gains. Mind you, this is a breakout move. Yesterday's move itself was a breakout move above this 4,03980 kind of mark. I think there is a fairly interesting risk reward ratio where the stock can actually head towards the 4350 level, and the support zone is actually not too far, 3850, 3900 odd. So I think 1:2, 1:3 kind of a risk reward ratio. The stock gaining ground after 2 good days of up move. So I think Hero is something that from a risk reward ratio perspective and a momentum perspective also can be considered as a positional bet.
Okay, Puneet is here. Puneet, the estimates, and it's bang in line with estimates, so good work there. But anything that stands out? We couldn't see anything on the numbers which is unusual.
Well, nothing needed, honestly, because the estimates were so paved down in this particular quarter. Revenue growth and EBITDA growth was just expected to be around 2 to 3%. So within automobiles, companies like Hero, and we'll see that for Tata Motors essentially as well, the estimates are so paved down in terms of growth numbers that while the numbers have come largely in line with estimates, it is still a weaker number in terms of fundamental performance for the company, and that's something that's reflected as well. Revenue was expected to be a 2% growth. It's come at 3.4. So there is the number in terms of EBITDA as well, 1416, which is effectively translating to margins of 14.2%. Bang in line with estimates again, and brokerages were estimating a higher operating leverage. That's why the profits were expected somewhere around 1100 crores. It's come in there as well. So overall numbers were there, and in terms of performance as well, in terms of sales, we've seen a very slow quarter for the company at roughly about 13.8 lakh units. That's just a 0.7% fall actually in terms of sales compared to the same time last year, which is quarter 4 of FY24. And there's been a lingering issue essentially in the domestic motorcycle segment that's been reflected in numbers of Bajaj as well. So for the last 6 months, Bajaj's sales in the domestic two-wheeler sales have actually either been flat or have fallen. And for Hero as well, they've reported just a 4% fall for FY25 in sales numbers. So effectively, we will be looking at a lot of commentary coming from the company. We've also had a management change now. Mr. Niranjan Gupta has moved on from Hero. So that is another key aspect, but valuations are at multi-year low for something like a Hero. It's just trading at 16 times price to earnings versus 37 of TVS. So I think commentary in terms of what's happening in the 125cc and no growth in the entry level segment, that will be something. So the premiumization strategy for Hero will be looked at, but overall numbers largely in line with estimates that were paved down so much for analysts based on the company's poor sales performance in Q4.
Okay, thank you for that, Puneet, for the very comprehensive explanation on what's happened to Hero in Q4. But Somit here, I know heard on the street is what we're all waiting for and we're delayed. But first off, GAIL.
Well, on the revenue and the bottom line front, the numbers are pretty much in line. EBITDA is where one factor where there has been a beat of 5%, 3,050 is what the street was estimating. The company has reported an EBITDA of 3,200 crore. Mainly, this beat must have come in from the gas transmission and the gas marketing business of GAIL. These are the two businesses which have been firing for GAIL for the entire part of the FY25, and in Q4 also they have delivered. Now, what is important to track from GAIL is what is their FY26 guidance. The company will be holding a press conference anytime soon, and FY26 guidance for the marketing and the overall EBITDA is something that the street would be wanting to know from the GAIL conference call and going forward.
Yeah, we'll wait for that and maybe get you that tomorrow. But Somit, while we're at it, heard on the street, what are you hearing from dealers?
Well, the first stock on the list is IIFL Finance. The stock is up 5% in trade post a foreign broking firm HSBC upgraded its rating on the stock to buy from hold, and I've also hiked the target price. But the buzz on the street is that there might be a potential fundraise announcement that could come in from IIFL Finance. The NBFC might be looking to raise as much as 400 crore rupees is what the dealers are indicating, and one of the anchor investors or one of the lead investors in this could be Fairfax as well. When it comes to Indus Towers, if you remember back when Indus Towers had reported their numbers, the company did not announce any dividend, and that was one of the major reasons why the stock had fallen around 7 to 8% in trade. But what I'm hearing on the street is that the company might soon come out with their dividend announcement, and that might be around 15 to 20 rupees is what the dealers are indicating. When it comes to Ceylon exploration, dealers are indicating that large HNIs have started to accumulate this counter, and potential one of the triggers for Ceylon exploration going forward could be the merger approval with the promoter entity. That could be a big trigger coming in for Ceylon exploration. Syrma SGS and Jubilant Ingrevia. Couple of these stocks, dealers had indicated earlier that smart investors are buying ahead of the Q4 numbers. Jubilant Ingrevia did come out with their numbers. It was still a set of numbers. Syrma is yet to come out. So keep an eye out for both these counters in trade. And lastly, Asian Paints. That is one stock that has been, and the buzz on the street is that there could be a potential block deal in Asian Paints. Now, if you remember Siddhant Commercial, this entity owns around 5% stake in Asian Paints, which is a Reliance Industries entity, and this entity could offload some of its stake in Asian Paints is what the buzz on the street is, and that is one of the reasons why Asian Paints is down in trade today.
Okay, thanks so much for that, Somit. Aditya, what any names that out of all that Somit has just mentioned which are on your list, especially an IIFL Finance, something that I found interesting, possibly a fundraise coming through. There's been enough buzz about IIFL Finance being even on certain on the radar of certain top marquee investors. So just trying to understand, do you have a view with regard to an IIFL Finance?
So many people are raising funds that I think I also should go and raise funds in the market. From my perspective, raising funds is not a positive thing. Companies are diluting their capital at the behest of existing shareholders. IIFL Finance, with all the fiasco of the gold loans that happened, I will not be too much interested per se. I would look at microfinance in spite of IIFL Finance. I would look at microfinance space where at least the valuations are comforting, and the microfinance cycle, according to me, has dropped out per se. So to play the entire lending sector, I would keep my money in the top banks and try to play 20 to 30% in the smaller banks per se, which would be microfinance sector also.
In microfinance, Aditya, what are you liking? Because HSBC's note today morning seemed to suggest that play IIFL for gold and microfinance. You seem to be suggesting IIFL is not the best play.
So for me, if you wanted to play the gold side of it, I would go to CSB Bank. They are doing pretty well on the gold lending side of it. Okay. On the microfinance side, I would look at Ujjivan, I will look at Equitas, I will look at somebody like an Arman Financial as well, where the valuations are really very compressed per se. To some extent, IDFC First Bank valuation was also compressed. but then IDFC First Bank keeps raising money as if it is their tea and coffee per se. So that is a risk with IDFC First Bank. However, micro lenders really look very interesting. Some of them are trading at about 1.2 times price to book. That's where the real juice is over the period of next 2 to 3 years.
And Aditya, what's your take with regard to some of the financial intermediaries? I'd like to cap a couple of questions off before I go to Kush. Some of the financial intermediaries, something like Care Ratings, came out with numbers, very, very strong set of numbers. We've also seen a KFin Tech in focus on the back of Warburg to some extent exiting the counter. What's the sense with regard to some of these financial intermediaries?
So intermediate is a wide range of basket. There are brokers, there are AMCs, there's a depository also listed on the stock exchange. According to me, most of these stocks are really very expensive. If you're looking for some, CRISIL is my topic there. CRISIL is a fantastic company with high operating leverage, as well as the brand of CRISIL is really very strong from my perspective. So CRISIL continues to remain a topic there. However, within the entire AMC space, I feel that a lot of competition is coming about with everybody trying to open a mutual fund now. So there, I don't think there is a good opportunity with respect to valuations. Similarly, within the broker basket, we've seen Angel One reporting a really very poor set of numbers. Within BSE and NSE, BSE is extremely overpriced per se. So I tend to avoid the entire capital market play. None of the stocks really there are really cheap per se. All of them are really very expensive, and they would be expensive since the market has seen a lot of rally over the last 2 to 3 years. So tend to avoid them. Would stick towards banks and micro lenders. Micro lenders is the place where valuations are extremely lucrative at this point.
Okay. So that kind of encapsulates some pieces with regard to fundamentals that we want to talk about. Kush Bora, let me come to you. We've spoken defense. What about something like an IIFL Finance? There's plenty of buzz on the street today. You had a positive HSBC note, and likely that, as well as what Somit spoke about, carrying the stock up 4%. How is it looking from a technical perspective?
So before that, I think we must. You've done it enough. I think I must congratulate Somit. I think I'm going to create a watch list, for all the stocks that he mentions going forward as a part of heard on the street. Very exciting names, I must say. I was actually looking at some of the other names also that he was mentioning, but with the likes of IIFL Finance, I like this one. There's been a good move, and it's not a sporadic one. It's actually come off the back of a gradual uptrend that the stock has been witnessing from early March. Of course, in line with the markets, there's been fair degree of volatility, but this is a steady up move, especially if you see on the weekly basis. This has been a good up move. The breakout has come after some consolidation in the near term around the 380-85 mark, which was a resistance. So I think this could well continue. At the moment, just at the moment as we speak, the stock is at the 200-day moving average, which is actually at 405. So maybe some profit taking, especially considering the fact that in the last 3 days the stock is up from 352 all the way up until 405. So maybe some profit booking might come, but I think on the whole the structure is very nice. The resistance levels of 380 will start acting as support. On the way up, 435, 450 could be the next level to watch for. So IIFL Finance fairly constructive.
Okay, well, doing well is IIFL Finance, not just today, for the last few days. So bear in mind that particular name. Okay, the other stock which is surging today is Tanla Platforms, up in double digits, 12% now. In fact, Puneet Johnson, with the triggering of the up movement, Puneet, I reckon it's got to do something with the promoter buying.
Well, definitely, that's the key news flow coming in for Tanla Platform today. Stock was at multi-year lows, and the promoter has come in and decided to buy some stake. They've said that promoter Dasri Uday Kumar Reddy has bought 18 lakh shares. That's roughly 1.38% of total equity of the company at 470 rupees per share. Now, Small Cap World Fund Inc. has roughly sold about 16 lakh shares at a similar price range, and we've seen the American Funds Insurance Series also sell roughly 2 lakh shares at 470.15 as well. So I want to take a step back and look at Tanla and what the business does. It's essentially an IT company with a lot of focus on telecom business for most companies. So it's working heavily with the government as well as enterprises and the telcos. So it has ongoing business with the likes of Bharti Airtel, Hexacom as well as Vodafone Idea. The other key aspect is that it does offer 3 key platforms as its solutions. Now, one is ATP. Now, this is one of the, it's a key platform for telcos in terms of scam identification as well as prevention. And that is, the company claims this is India's first anti-phishing platform. So that's been gaining a lot of attention. The other aspect is TrueBlock, which is the world's first blockchain-enabled communication stack, which is offered to enterprises. And finally, Wisely, which is an omni-channel digital interaction platform. All of these is mostly held for communications with enterprises as well as with telecom companies, which use for maintaining or getting their information out. And that is one of the key moats of something like Tanla. It doesn't have a direct competitor essentially in this business, but it is offering its niche in the telecom space for IT. Now, what's key? What's something which has been something to watch out for is the last 5 years, because the stock actually hit a multi-year low in May of 2020, largely triggered by COVID, of 64 rupees per share. If you look at since then, the stock hit an high of over 2,000 rupees in January 2022, and since then has corrected 70% again. So we've seen a lot of volatility in the stock prices of something like a Tanla, and the revenue growth CAGR has also been just 4 to 5% in the last 3 years. So essentially it's a stock that's at a multi-year low essentially in terms of stock price as well as financial performance. But looking forward, they are looking to work with a lot of OTT platforms, and they have roughly 29% revenue coming from the OTTs, and that is a high growth segment right now. So that is something to watch out for. The other aspect is the stock valuations is just trading at 11 times price to earnings for FY26, much lower than the 24-30 times price to earnings for the IT companies. So that's a lowdown on Tanla. It's been very volatile over the last 3 years, but definitely a stock to keep on radar after the promoter buying.
Okay, well, certainly strong up move today, 11.5%, 12%. Keep an eye out for that. Puneet, thanks for bringing that out in great detail. Now, Tanla Platforms is one. Let me try and look at other pockets of strength, if you will, in the session today. As we speak, by the way, the small cap index is surging. If I'm not wrong, this could well be the high point of the day for the small cap 250 at 0.75%. Not necessarily the high point, but a bit of a recovery from the last 1 hour lows for sure, very close to the high point of the day. So the broader markets continue to do well, even as the Sensex and the Nifty IT are sulking a bit. Aditya, so either a Tanla Platforms, I'm talking about the 2 or 3 or 4 stocks which are moving up today on the 500, and tell me if you track any. So either a Tanla, or after a while I'm seeing Lakshmi Organics go up 6-7%, and I know you track the chemical space closely. Or maybe I'll add the Vishal Megamart stock, which is now has consistently come out with fairly decent numbers in the last few quarters.
So I'll talk about the stock that has surprised me per se, which is Vishal Megamart. The results continue to remain really very strong. I'm surprised that the 30, 40, 50% growth that the company is really giving is very similar to what Zudio is already doing on their business. People are plugging into cheap products in a mall. So that concept of cheap products in an AC shopping mall is really picking up, and companies like Zudio, companies like Vishal Megamart, those all companies, for that matter, Go Fashion as well, they've also done pretty well on this number. So one theme that is picking up within the FMCG space is cheap products in an AC environment per se, and all of these companies are guiding towards 30 to 40% growth. So this space really looks really very interesting from a medium to a long-term perspective.
Got it. But so could the valuations here be a bit of a deterrent, Aditya? I mean, trading
Yes.
12 months about 95 times, even if they grew 50-60% about 60 times, is that the deterrent in Vishal Mega?
Yes. So again, FMCG, the problem really is the valuations per se. If you look at it, most stocks would trade at 50 to 100 times multiple. So therein, I would be cautious, but I would always keep studying these stocks. In case of any valuation derating, I would be very interested in those stocks per se because believe that India's consumption theme is playing out in those stocks per se. Yes, valuations are expensive. You need to watch out for these stocks, not buy them or buy them right away. Wait for a dip and then try to enter these.
Okay. Well noted. So, well, wait for a dip maybe into Vishal Mega Mart. But today is zooming. Kush Bora, any thoughts here on Vishal?
Well, this one's a little stretched right now, and if you see, there are some cool-offs that are happening on the volume side. There is some cool-off happening, on the momentum indicator side as well, where you're seeing some negative divergence, perhaps crop up. You'll see that formation. This is slightly preemptive, but you'll see that happening over the next couple of days. So while yes, the move has been rather steady once it hit that sub 100 levels. But I think from a very near-term perspective, I think it's gone slightly overstretched. So a pullback towards the 120 zone, perhaps slightly lower as well, would be a good time to enter. As I said, from a very near-term perspective, it seems slightly overstretched.
Kush, I didn't have your view with regard to some of the financial intermediaries. A CARE ratings is up 13%. Zaggle, maybe not core financial intermediary, but we spoke with the management earlier today, is up 5, and these are all on the basis of numbers. JM Financial is up 4, Prudent Corp is up 4, so some very strong gains seen by some counters. Any of these on your radar and something that you like?
So, I mean, the reason for the big smile is that CARE ratings popped up on our research as well 2 sessions ago. We missed it because it seemed overheated, and then it's actually jumped 200 points from there. So this is one trade that yes, I must admit, we missed, and now it's seriously overheated. Plus the medium-term resistance of 1500, 1525 acting up. So on a pullback closer to the 1450 mark, perhaps you could consider. On the other hand, Zaggle is a very different play. Very good risk-reward ratio, on this one. 360, 365 was a resistance band for a good part of this year. So the last 3-4 months, that's been a level which the stock hasn't really been able to cross. So I think from from a breakout perspective, from a risk reward perspective, I think Zaggle is one stock that you could well consider. Even the momentum indicators have shown a breakout. So I would be very constructive on Zaggle with the stop loss around the 360 mark. On the way up, 415 and about 440 are your next target. So positional bet more than a momentum play right now, but offers a good risk reward ratio. And as I said, there's a breakout already happening on this one. So Zaggle prepaid is something that you can consider. One more stock that I would like to add, which is consolidating and is on the verge of breakout, is Fusion Finance. It's not done anything for the last 6-7 months or so, but the volume patterns that I've been tracking on this one are starting to show signs of accumulation, and it's gearing up for a big move. 180 is a bit of a resistance for this one, but I think once it crosses that level, I think you will see this one boom past. So fairly constructive on Fusion Finance.
2.5% higher on a Hero Moto as well. Aditya Shah, the other set of stocks which were buzzing yesterday as well as are doing decently well today are the hospitality counters and ITC hotels, Mahindra Holidays, and IHCL, of course, then the larger ones, IHCL, EIH. Any of these that you like? Do you find value in these? And if so, if not, how would you play the space?
Definitely no value per se. Indian Hotels is continuing to do exceptionally well. Their results were fantastic to say the least. But the stock is really very expensive. So if in this space you want to play something, there's a smaller stock known as Samahi Hotels or Chalet Hotels. Those stocks look really very interesting per se. Within this space, stocks are expensive. Again, if you look at the airline business, only stock to invest there is Indigo, and that too is really very expensive. If somebody wants to take a contra bet, then SpiceJet could be interesting contingent on the fact that they turn around their business, which looks really very unlikely at this stage. So if I were to take a bet, I will look at Samahi or Chalet Hotels per se. But however, it is not necessary to invest in this space per se. There are many other sectors available at decent valuations per se.
Okay. Would you play hospitality, Kush, and if so, how?
Not really, Harsh. I mean, I've been tracking some of these names and they haven't really given those breakout kind of moves. A sideways consolidation at best on some of these names. Perhaps, what Aditya mentioned as Hami, but there too, the 200-day moving average resistance is proving to be a stiff one. It's just, marginally above that. But at the moment, most of these names seem to be in a consolidative phase, so not very constructive on these, especially now when the mid cap and the small cap segment has started to pick up. There are a lot of other names, including the ones that we've discussed, are doing well. I wouldn't want to go into a consolidative kind of a move right now. So I'll wait and watch on these, but no picks on the hospitality space just yet.
Okay. Now, to our brokerage note of the day, we had Motilal Oswal initiating coverage on Jindal Stainless. Buy rating, target price 770. So considerable upside from here as well, over 20%. Anushi joins in with a detailed outline on what the note seems to be suggesting. Anushi.
Right, Harsh. So it's a 26% of an upside that we are seeing for Jindal Stainless, and this is what Motilal Oswal has come out with its report. They've initiated a buy call on this stock. A lot of the play that is there for the key rationale is on the basis of the expansions that the company is making. So the strategic expansion that they are making are believed to strengthen its global leadership going forward. In fact, the expansion is underway to cater to the robust demand that the company is currently having. Do note that this, even in the operating cash flow picture also, if we say, is comfortable levels to support this kind of ongoing capex for the kind of expansion that the company is making for the next 2 years as well. Considering this, the kind of revenue growth that the company is projecting, the EBITDA and the PAT CAGR, the expectation is for about a 17% of a EBITDA CAGR growth, the 21% of a PAT CAGR, that's a net profit growth expected over FY25 to 27 period. However, the key risk here would remain on the sector related specifics, that's a nickel price volatility, the rise in imports and domestic demand situation slowdown. So it's mainly on favorable operating cash flow pictures, the kind of projections that are there for EBITDA and PAT, and how the expansion is expected to create demand forward for the business. So Jindal Stainless and focus on the back of this note.
Okay. Aditya, would thank you so much, Anushi, first off. Aditya, would Jindal Stainless be on your list?
No, definitely not. The stock price has rallied over the last 3 to 4 years from about 100, 150 rupees to about 700 rupees. Of course, it is the number one stainless steel player in the country, but the valuations now do not warrant any investment at this stage. This on top of the fact that today on steel products, India has imposed some duty on on US at a time when tariffs are there and at a time when it is not clear how tariff wars will play out. I tend to avoid the metal sector first. So according to me, valuations are expensive. Times are not very clear, so I tend to avoid this.
And Kush, your take?
No, from my perspective, the view slightly differs. There is a breakout momentum play to be had on this one. There's a falling trendline resistance on the weekly setup that has been breached. Volumes also, if you see, are on the higher side, and the moving average crossed and sustained over the last two and a half, about 3 sessions or so. So I think higher levels are very much in play. 645, 665 are the levels to watch for on the upside, and on the downside, about 600 is where you place that stop loss. So yes, from a momentum play perspective, you could consider Jindal Stainless.
Okay, Kush, we'll let you go on that note as well, because we're going to also slip into a very, very short break. On the other side, we'll get you top BTST ideas and we'll continue to talk stocks. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Back with India Market Close right here on NDTV Profit. Just a word on, like we said, some stocks which are really buzzing. The small cap spaces are rising up further. And from amongst other stocks that are making a move, watch out for the CNC stocks. Jyoti CNC has had a very good move today. And we've spoken about defense names. Zentech is on a roll. Yet another 5% up move for that stock. It's locked on upper circuit yet again, was up in the similar fashion yesterday. The other one which which we kind of spoke about well, was KFin Tech. The fact that they've got so much of the shareholders have a fair degree of equity and they've sold only 6.5% or maybe more. Let's assume they've exercised the higher portion and sold maybe about 10%. Even then, I think because the funds, General Atlantic, have 32%, KFin Tech is under pressure because the street will believe that this will consistently keep on coming out with some sales. Okay, MRF is a counter that we are following closely. Let's get in Puneet to talk the bull versus bear case. Puneet.
Well, thank you for that. So, tire space as a whole, we've seen the results from CIAT also come in very, very positive. We're expecting some corporate action in Apollo Tyres, as my colleague Swami highlighted yesterday. MRF, after the company came out with its earnings, has been on the up move. Stocks up almost 24% in the last 1 month, and that was largely, looks like, anticipating a positive Q4 number. Margins were up 337 basis points on a quarter-on-quarter basis in a time when the natural rubber prices have been high. Margins have been affected over the last 3 quarters, but Q4 saw the first positive reversal of the same. On the other hand, revenue has largely remained stable and stagnant actually in FY25, and that is backed by slower demand as well. So slower demand as well as higher natural rubber prices were impacting both revenue and margins. That seemed to be expecting to go better going forward as well. In terms of the second bull and bear case, the key aspect was the strong outlook for both the OEM segment for the company as well as the replacement and the export market. The company did highlight in its Q4 earnings that they are anticipating some revival of growth essentially in the replacement market, which is majority of this new sales, which is 70 to 80% of new sales, and that is one of the key commentaries in this particular result. Rubber prices will also take a couple of more quarters. That's what the management highlighted. It is lower compared to the previous quarter, which was a high essentially of the last year. But over the next 2 quarters as well, it might impact margins. So demand will be something to watch out for as well. In terms of the third bull and bear case, and here we saw the disparity between brokerages as well. CLSA actually raised their target price after Q4 earnings by roughly 30% to 1,68,000 odd. And that is not something that Kotak is very bullish on. They feel that the current valuations are still expensive for MRF, and they have a target price of 1,15,000 as of now. So when you finally look at the valuations, currently trading at 22 times price to earning on a 1-year forward basis, that is comparable to largely in line with its peers. But MRF is the leader in the spaces that it operates, so it could be some valuation premium that it could command. But currently, at least at 22 times, we've seen a higher growth essentially for likes of JK Tires as well as CIAT, and they are trading somewhere around the valuation multiple of 17 to 18 times. So that's something that the investor will have to take a call on. But overall, strong Q4 earnings and pivots well going into FY26 for the tire makers.
Okay, so that's on MRF, something to keep in mind. Thank you so much, Puneet, for all of that perspective. Aditya, if I can come to you with regard to IT in particular, what's the sense like? There is Aditya, apologies, I'm also joined by Aditya Agarwala now, or rather we are also joined by Aditya Agarwala now, so I will specify. Aditya Shah, if I can ask you, what's the take with regard to IT? Does the thesis change given the fact that you're starting to see resolution with regard to tariffs, at least country-wise? I'm not talking about pharma in particular, but even otherwise.
So, Harsh, it is now very clear that India is going to make a deal with the United States with respect to tariffs. But the cost of doing business for IT companies is going to move up. That is now very clear. A lot of that is now priced into the stocks, where the stocks have taken a time correction over the last 1.5 to 2 years as the market was building in Trump moving into the presidency. So in my perspective, I believe that the IT stocks have made a bottom. You cannot really predict when they will start to move up. But from my perspective, this is the time to slowly and steadily accumulate. Within the large cap IT pack, we continue to like HCL Tech that has continued to deliver very strong results, dividends, as well as stable returns. Within the small cap, within the mid cap IT space, you can look at something like L&T Infotech Mindtree, which has taken a lot of correction over the last 2 to 3 years, or L&T Technology Services. Most of the small cap, mid cap IT stocks continue to remain still expensive even after the time correction. You have to be very, very careful when you try to add these stocks. So as I said, L&T Infotech Mindtree or L&T Technology Services or Tata Elxsi when they report very poor results and the stock price corrects. So these are the stocks that you can look out for. And finally, Tata Technologies, after IPO, the ER&D bus has fallen apart and the stock has taken a massive correction. So that is also one stock where you could look at.
Aditya Agarwala, just going to shoot a few questions your way. First off, with regard to the index and the bank nifty, the Nifty 50 and the bank nifty, how are you viewing the developments over the last 2 days? How are charts therefore looking, and what are the levels you are looking out for now?
Hi Harsh, good afternoon, thanks for having the show. So I'll also bring into the picture the Indian VIX here along with the Nifty and the Bank Nifty, because what is very interesting is despite the fact that we're witnessing a bit of a profit taking in the Nifty, which is getting extended as the time progresses, but we're not witnessing any kind of a panic in the VIX that is concerned. It made an attempt to cross that crucial level of 19. From there, we have seen a gradual correction in the VIX. So keeping that in mind, I would analyze the Nifty and the Bank Nifty, both the indices together. And I don't see this profit taking that we're witnessing in trade today as a significant dampener to the rally that had kick-started yesterday. It could be more of a profit taking, that's it. On the downside, I'm closely watching for levels of 24,400 or 24,300 as far as the Nifty is concerned. And as far as the Bank Nifty is concerned, I'm watching closely around levels of 54,800 or 54,900, which is almost there on the Bank Nifty. So give or take another 50-60 point, I think both the Nifty and the Bank Nifty should start look good to go fresh long as far as both the indices are concerned. And clearly with mid cap and small cap end of the market outperforming, it is visible that maybe this is just a profit taking, nothing much to worry about with today's profit taking.
Yeah, nothing to worry about for sure in today's days of profit taking. The question, Aditya, is what to do with some of the large cap IT or mid cap IT names which have had a stupendous rally and a bit of a pause today. So is this pause giving you a chance that you would go out and log into some of these? And if so, which ones?
Absolutely, Neeraj. Good afternoon. So I would look at mid-cap IT stocks. They are a little favorite for me at the moment. And if I peg them in a ranking order, maybe I'll go for a Coforge as the top bet for me. I think this is one stock which has come off its lows significantly. And almost we can call it a V-shaped recovery in the stock. And today what we are witnessing is it witnessed a breakout from a consolidation in trade yesterday and it's come down just to test that breakout level, which is closer to about 8,100 odd levels, and from there it's witnessing some kind of a buying activity. So the stock is a little soft in trade today. I would definitely go ahead, initiate a fresh long in Coforge at current levels. Look for a target of 9,000 and above. You could have to spend at least a month or so here, and maybe a stop loss of sub 8,000 is also something that I would be looking at. The second stock, which is not very much talked about at the moment, is Birlasoft. Again, the stock has come off the cliff significantly, and it's formed a good base around these areas. And what is very interesting is back-to-back 2 trading sessions, we're witnessing very good volumes in this stock. Though the stock has not seen any kind of run-up in price, but volume is suggesting that there is good buying happening in the stock at these levels. So Birlasoft is also one stock that I would want to put in my portfolio, hold it for some time, because I'm looking at a target of 510 here. Neeraj, 510 is what I'm looking at in Birlasoft, with a stop loss just around 400 odd levels, offers an excellent risk to reward. So Coforge and Birlasoft, these are the 2 stocks for me within the mid cap space which stand out, and I think definitely one should create a portfolio of these 2 stocks.
Okay. Yeah, I mean, it's not cheap though, Aditya. I mean, on the results day, I remember, for example, Persistent at 4,300, 4,350, now at 5,800. Some of the others too. And I know you spoke about LTI Mindtree being the one, but let's assume if I don't want to go for the top 5, top 6 names, and LTI Mindtree used to be a part of the Nifty. But the second layer, if you will, right? Does a product or an ERD company like Persistent, KPIT, do they come into the fray at all? These two names?
That's for me?
Yeah, Aditya Shah.
Yeah, so as I said, the ER&D space, we've seen Tata Technologies take a 50% correction from the top. So that looks really very interesting for me. The valuations there have weathered down and the growth should come back in the next 2 to 3 years. So Tata Technologies looks really very interesting. That is something within the ER&D space that you should watch out for. And as I have been consistently saying, L&T Technology Services is another ER&D as well as an integrated player within the 5G and the driverless car. That looks really very interesting. The stock has underperformed over the last 1.5, 2 years. That is something that you should really watch out for. KPIT, if you talk about KPIT or Coforge or Persistent Systems, strictly not ER&D players, but those stocks are really very expensive to buy.
Sorry, you're saying KPIT is not an ER&D player, Aditya?
It is, but it is very expensive to buy.
Okay, yeah, fair call. Okay, fine. The valuations are, of course, expensive. Okay, point well noted. Yeah, and I do remember that you spoke about some of these others, which is why I just wanted to speak about the two specific points. But okay, I get your point that they are expensive in nature and therefore you'll likely maybe stay away. Aditya Agarwala, the other bucket which showed remarkable recovery yesterday was pharmaceuticals, right? Intraday recovery, very good. Today, arguably at the start of the day, it was the sector of the day with the kind of moves that it made. Large cap or mid-sized ones, is there a trade in any of them?
Definitely, Neeraj, but it's a selective stock basket that I would look at within the pharma space, not the entire pack. Maybe a DV's lab is something which is looking very interesting to me at current levels. One can definitely initiate a fresh long here. Give it some time. I wouldn't look at a day or two. I would look at probably a couple of months or maybe a quarter here. And you can easily see levels of 6,600 or 6,700 on the upside. The second stock that I would look at apart from this is a Lupin. Lupin is also something which is looking very interesting to me. Definitely for a target of 2,400 on the upside, I would look to buy Lupin at current levels, maybe place a stop loss just around 2,000 odd levels. So DV's Lab and Lupin are these two stocks which stand out for me within the pharma space. The rest of the stocks, I would give it some time for them to consolidate and see how the charts develop over a period of 1 week, and then maybe I would be more keen on looking at them.
Okay, so that's the take coming in on pharma, but let's switch focus to telecom because Bharti Airtel is going to likely announce Q4 numbers shortly after market close, and analysts expect to see revenue and EBITDA which is higher QOQ. Soumit joins us again to give us more details on what we can expect with regard to numbers. Soumit.
Well, as Bharti Airtel will be reporting its numbers, Q4 FY25 is expected to be rather muted. Revenues are expected to be high by just 7%. EBITDA growth of around 9% is expected on a sequential basis. Margins are expected to come in at 55.3%, while the net profit is expected to be low by nearly 56% on a sequential basis. But this higher decline in net profit is largely because of one-offs that were there, or in fact exceptional gains that were there in the base quarter, that is the third quarter of FY24. Now, the key mobile business, as the India mobile business, as the key revenue generating business for Bharti Airtel. There, if you look at India mobile, revenues are expected to be higher by just 2%. EBITDA is expected to grow by just 0.6%, while the subscriber base is expected to come in at 36.1 crore as against 35.7 crore in the previous quarter, while the ARPU is largely expected to be flat at 246 as against 245 that the company had reported in the previous quarter. Now, this growth is largely on the impact of the fact that the tariff hike that were taken on July 2024. Now, the impact of this has been wearing off, and hence we are seeing a slowdown in the number in the fourth quarter of FY24. Apart from that, India mobile business revenue growth is the slowest that we are seeing since the fourth quarter of FY23, and this whatever growth, however, the company will report will largely be on the back of subscriber addition. ARPU growth is also limited because of the fact that there were lesser number of days in the fourth quarter as compared to third quarter. There were 2 less days on a sequential basis. Now, if you look at the other segments of Bharti Airtel, enterprise segment will report a steady set of numbers. Margins are expected to be higher for the enterprise segment. Home broadband will benefit on the back of healthy subscriber addition, while DTH business revenue is expected to be muted in the fourth quarter of FY24. Now, given the improvement in cash profile of Bharti Airtel, the street will closely monitor for any dividend announcement that could come in from Bharti Airtel side. So that will be an important thing to track for Bharti Airtel. Apart from that, Airtel Africa had reported a strong set of numbers, but the numbers were reported last week itself. Apart from that, the key things to watch from Bharti Airtel numbers would be the capex outlay for FY26, how are the market share shifting towards the company, and how has been the 5G transition. That will be important to track from Bharti Airtel numbers.
Thanks so much for that, Somit. Aditya Shah, if I can come to you with regard to Bharti Airtel, are you positive with regard to telecom? How best would you play it? Would you play it through a Bharti? Would you play it through an Indus Towers, where today, as Somit fascinatingly suggested, that there's a possible dividend announcement in the pipeline? How best would you play it?
Long-term play, I think both Reliance Jio and Bharti Airtel are going to win this war. Vodafone Idea is going to move away, and I think those are the two best plays. Of course, Indus Towers is there, but a long-term investor should continue to stay invested in Reliance, RIL, and Bharti Airtel. Price hikes are coming. The more important point is price hikes are coming. I was paying 2,500 for a 1-year plan. Now I'm paying 3,300, and this is only going to move up as time goes on because there's no third player per se. So from my perspective, the structural theme of the telecom sector is it's a duopoly now, and those two players will take price hike at will whenever they like. So from my perspective, Bharti Airtel and Vodafone and Reliance Jio are top bets. They will continue to remain a good bet over the next 2 to 3 years.
Okay, Aditya Agarwala, would you play a trade on a Bharti Airtel just on the eve of earnings?
Not really, Harsh. If I purely go by the chart setup, looks a little weak to me right now, maybe for a very brief period of time. The medium to longer term trend still remains intact, which is towards the upward trajectory. Just for a day or two, maybe it can correct for some time. So right now, I won't go ahead and buy Bharti Airtel just ahead of the numbers.
And Aditya Agarwala, your BTST, STBT for the day?
So I've got two recommendations, Harsh. Both are on the buy side. The first one is HAL. We clearly have seen the kind of up move in defense stocks after yesterday's bit of a correction. So HAL for me is a buy at current levels for a target of 5,100. The stop loss at 4,400 on the downside. The second is Bajaj Auto. The two-wheeler space is looking very interesting to me now, both Bajaj and Hero. Going with the Bajaj Auto at current levels, breaking out of a consolidation zone for a target of 8,600, a stop loss at 7,860 on the downside.
I want to quickly take a question with Aditya Shah as well with regard to defense. Aditya, does anything change materially with regard to where defense is concerned, and what and how would you play defense? There are certain software-based companies within defense simulators, etc., and then you have, of course, the core hardware companies and PSUs. How are valuations looking? Just give us your quick thoughts.
Harsh, one of the most important points to keep in mind is defense is a structural story for the next 10, 15, 20 years, and not a story for the next 1 or 2 years per se. So that needs to be kept in mind. Valuations across the sector continue to remain really very expensive because we have now defense-oriented mutual funds per se as well, and people are running behind the defense stocks. So from my perspective, I tend to avoid the entire sector per se, because I feel that the valuations are really very expensive and one cannot invest in let's say, for example, a BEL at about 40 times multiple, 45 times multiple. It is like investing in Asian Paints at 80, 90 times multiple and then saying because the growth is there, let's invest and you will get superior return. That is not possible. If you want to look at companies, you can look at something like a Cochin Shipyard, which is an indigenous ship maker in India. Zen Technologies also will do pretty well over the period of next 2 to 3 years. Their drones will do exceptionally well, and this whole drone war that India and Pakistan really had is going to benefit companies like Zen Technologies per se. But right now, at the moment, really very cautious on these companies, not adding any of these. I believe some of these companies will undergo a time correction, after which they will start to give returns.
Okay. Well, the thing is not all the earnings have been great either, right? And in fact, when we spoke to Dinshaw Irani of Helios earlier in the day, I think he was speaking about how Q4 earnings have been a bit of a disappointment. Hear out his views on that, as well as some additions, views on consumption space.
Fourth quarter has been a fair bit of disappointment. I mean, we were expecting bad numbers, but till now, whatever the numbers have which have come out, if you do some pure statistics on those numbers, it's 60% disappointment. I mean, the 60% of the companies reported have downgraded, the analysts have downgraded the numbers. So it's not looking that great as such. I think the analysts maintained numbers for 4-5% of the companies, and 30-odd% saw upgrades also. So that's why I said we want us to be selective out here. Can't be carried away with what's happening globally, because domestically things going forward look well, but today they're not looking too great. I mean, consumption bit, rural is picking up a bit. Hopefully monsoons are good, so that also will add to that fervor on the consumption front. But in the urban consumption, that's still a bit of lag.
Yep, there is a bit of a lag for sure out there. Actually, Aditya Shah, does FMCG come into the realms of investing at all, or avoid it for the time being? A lot of talk, right, around that uptick in salary and how it will boost consumption, etc., etc.
So the only place where FMCG is doing pretty well, as we discussed, was the clothes theme per se, which is doing pretty well, where companies are reporting revenue growth of about 30 to 50%. Other than that, all companies are reporting single-digit volume growth, and the entire sector is very expensive. You get multiples of 40 to 70 here. So I tend to avoid this sector per se. If there is a turnaround story, one exception here and there, but as a sector per se, I tend to avoid the entire sector.
Forbes has shot up in trade today, a large price movement. I mean, movement is about average daily movement usually is not so much, but there's a sharp rise there. So keep an eye out for this one. J&K Bank, I believe, is up 5% as well. So that's the other one to keep an eye out for. The one that is really surprised me is Allied Blenders. We spoke about it in the morning that the fundraise might help the stock. But look at the surge there, 8.5% for this one. Any of these three names, J&K, Allied Blenders, Eureka Forbes, Aditya Agarwala?
Maybe just an Allied Blenders is something that I could look at. That is one stock which looks like can have more upside, more room on the upside. So maybe for a target of 450, one can look at buying with the stop loss at 370 on the downside.
Aditya Agarwala also wonder what's happening with the Suvain Life. Stock is up 13% in trade.
Absolutely. In fact, it's not only today, definitely it's up on massive volumes. But if you take a look at Harsh, last few trading sessions, stock has been outperforming significantly, and it's a fresh breakout on massive volumes. So I think if you already have it, yes, definitely continue to hold the stock. You can see levels of 190 to about 195 in the near term. If you are looking for a fresh entry, maybe wait it out for tomorrow's opening. If it just maybe slightly opens closer to about 165, then you will get a better entry point. Again, for a target of 190 to about 195 on the upside, you can buy. But definitely, this move that we are witnessing in trade today with volume is likely to continue in the coming trading sessions. A very strong looking chart, without a doubt.
Okay. Aditya Shah, Allied Blenders or any of the liquor play?
So Allied Blenders will not be tracking, so not be able to comment. On the liquor play, again, my topic continues to remain United Spirits with the management change that has happened and the UK trade deal that we have done. United Spirits continues to remain my topic.
Thank you both Adityas for joining us this afternoon. Thank you gentlemen for giving us those views and coming in and speaking with us. Let's quickly look at how the Nifty is settling in at on this Tuesday. A third of the gains that we made yesterday may be shaved off today, and that's essentially the texture of the market. I would look at it as that because we gained a very solid 900 points yesterday. So this bit of cool off likely not as negative, but 1.4% lower on the Nifty 50 index, 350 points shaved off. Let's look at it intraday as well. The Nifty Bank relatively better off, 0.8% odd lower. We're settling in at the day's lows, but we have been flirting at this kind of a level for a while now. So nothing again to be too perturbed about. Let's look at the Nifty Bank as well, and within that pack as well, the private sector banks really pulling this one down. The PSU is relatively okay. Let's look at the constituents as well, and the constituents on that's the picture you get. Look at some of the private sector banks there, 2.5% and 1 to 2.5% odd for those top 5 private sector banks. Let's also look at the heat map on the Nifty 50 and get some color around what's playing out. Defense, of course, is the theme to see and to look out for today. Hero Moto was the other one, strong set of numbers. Cipla also came out with numbers, so those stocks reacting on the back of that. IT down, banks down, so that's where some of the pressure is. Some of the big gainers of yesterday reversing a bit in trade today. The contributors reflect that. Roughly half of the positive points contributed by HDFC, contributing negatively today to the index, and therefore, and similar for Infosys as well. So you're seeing some bit of pressure. Even ICICI Bank to some extent seeing that bit of pullback. But defense is definitely the theme. Sectors very quickly, and defense up top 4% higher in trade. Along with it, the PSU banking index and the Nifty Pharma, which didn't do much yesterday. We've closed for the day. The Nifty IT is down 2.4% after that very strong up move yesterday. Nifty FMCG Auto are some of the other ones which are not doing as well, but broadly down about 1% thereabouts. The Nifty Metal also down just about 1%. But that's how it's largely played out. Let's look at the advanced decline. Let's look at broader markets, because that's where we have the Prime Minister speaking.
भारत माता की इस जयघोष की ताकत अभी अभी दुनिया ने देखी है। भारत माता की जय यह सिर्फ उद्घोष नहीं है, ये देश के हर उस सैनिक की शपथ है जो मां भारती की मान मर्यादा के लिए जान की बाजी लगा देता है। ये देश के हर उस नागरिक की आवाज है जो देश के लिए जीना चाहता है, कुछ कर गुजरना चाहता है। भारत माता की जय मैदान में भी गूंजती है और मिशन में भी। जब भारत के सैनिक मां भारती की जय बोलते हैं तो दुश्मन के कलेजे कांप जाते हैं। जब हमारे ड्रोन दुश्मन के किले की दीवारों को ढहा देते हैं, जब हमारी मिसाइलें सनसनाती हुई निशाने पर पहुंचती हैं, तो दुश्मन को सुनाई देता है भारत माता की जय। जब रात के अंधेरे में भी जब हम सूरज उगा देते हैं तो दुश्मन को दिखाई देता है भारत माता की जय। जब हमारी फौजें न्यूक्लियर ब्लैकमेल की धमकी की हवा निकाल देती हैं तो आकाश से पाताल तक एक ही बात गूंजती है, भारत माता की जय। साथियों, वाकई आप सभी ने कोटि कोटि भारतीयों का सीना चौड़ा कर दिया है। हर भारतीय का माथा गर्व से ऊंचा कर दिया है। आपने इतिहास रच दिया है। और मैं आज सुबह सुबह आपके बीच आया हूं आपके दर्शन करने के लिए। जब वीरों के पैर धरती पर पड़ते हैं तो धरती धन्य हो जाती है। जब वीरों के दर्शन का अवसर मिलता है तो जीवन धन्य हो जाता है। और इसलिए मैं आज सुबह सुबह ही आपके दर्शन करने के लिए यहां पहुंचा। आज से अनेक दशक बाद भी जब भारत के इस पराक्रम की चर्चा होगी तो उसके सबसे प्रमुख अध्याय आप और आपके साथी होंगे। आप सभी वर्तमान के साथ ही देश की आने वाली पीढ़ियों की और उनके लिए भी नई प्रेरणा बन गए हैं। मैं वीरों की इस धरती से आज एयरफोर्स, नेवी और आर्मी के सभी जाबाजों, बीएसएफ के अपने शूरवीरों को सैल्यूट करता हूं।
भारत माता की जय! भारत माता की जय! भारत माता की जय!
आपके पराक्रम की वजह से आज ऑपरेशन सिंदूर की गूंज हर कोने में सुनाई दे रही है। इस पूरे ऑपरेशन के दौरान हर भारतीय आपके साथ खड़ा रहा। हर भारतीय की प्रार्थना आप सभी के साथ रही। आज हर देशवासी अपने सैनिकों, उनके परिवारों के प्रति कृतज्ञ है, उनका ऋणी है। साथियों, ऑपरेशन सिंदूर कोई सामान्य सैन्य अभियान नहीं है। ये भारत की नीति, नियत और निर्णायक क्षमता की त्रिवेणी है। भारत बुद्ध की भी धरती है और गुरु गोविंद सिंह जी की भी धरती है। गुरु गोविंद सिंह जी ने कहा था, 1.25 से एक लड़ाऊं, चिड़ियन ते मैं बात तुड़ाऊं, तबे गुरु गोविंद सिंह नाम कहाऊं। अधर्म के नाश और धर्म की स्थापना के लिए शस्त्र उठाना, ये हमारी परंपरा है। इसलिए जब हमारी बहनों, बेटियों का सिंदूर छीना गया तो हमने आतंकियों के फन को उनके घर में घुस के कुचल दिया।
भारत माता की जय! भारत माता की जय! भारत माता की जय!
वो कायरों की तरह छिप कर आए थे, लेकिन भूल गए उन्होंने जिसे ललकारा है वो हिंद की सेना है। आपने उन्हें सामने से हमला करके मारा। आपने आतंक के तमाम बड़े अड्डों को मिट्टी में मिला दिया। 9 आतंकी ठिकाने बर्बाद हुए। 100 से ज्यादा आतंकियों की मौत हुई। आतंक के आकाओं को अब समझ आ गया है, भारत की ओर नजर उठाने का एक ही अंजाम होगा, तबाही। भारत में निर्दोष लोगों का खून बहाने का एक ही अंजाम होगा, विनाश और महाविनाश। जिस पाकिस्तानी सेना के भरोसे ये आतंकी बैठे थे, भारत की सेना, भारत की एयरफोर्स और भारत की नेवी ने उस पाकिस्तानी सेना को भी धूल चटा दी है।
भारत माता की जय! भारत माता की जय! भारत माता की जय!
आपने पाकिस्तानी फौज को भी बता दिया है, पाकिस्तान में ऐसा कोई ठिकाना नहीं है जहां बैठकर आतंकवादी चैन की सांस ले सके। हम घर में घुसकर मारेंगे और बचने का एक मौका तक नहीं देंगे। और हमारे ड्रोन्स, हमारी मिसाइलें, उनके बारे में तो सोचकर पाकिस्तान को कई दिन तक नींद नहीं आएगी। कौशल दिखलाया चालों में, कौशल दिखलाया चालों में, उड़ गया भयानक भालों में, निर्भीक गया वह ढालों में, सरपट दौड़ा करवालों में। ये पंक्तियां महाराणा प्रताप के प्रसिद्ध घोड़े चेतक पर लिखी गई है, लेकिन ये पंक्तियां आज के आधुनिक भारतीय हथियारों पर भी फिट बैठती है। मेरे वीर साथियों, ऑपरेशन सिंदूर से आपने देश का आत्मबल बढ़ाया है, देश को एकता के सूत्र में बांधा है और आपने भारत की सीमाओं की रक्षा की है। भारत के स्वाभिमान को नई ऊंचाई दी है। साथियों, आपने वो किया जो अभूतपूर्व है, अकल्पनीय है, अद्भुत है। हमारी एयरफोर्स ने पाकिस्तान में इतना डीप आतंक के अड्डों को टारगेट किया, सिर्फ 20-25 मिनट के भीतर सीमा पार लक्ष्यों को भेदना, बिल्कुल पिन पॉइंटेड टारगेट्स को हिट करना, ये सिर्फ एक मॉडर्न टेक्नोलॉजी से लेस प्रोफेशनल फोर्स ही कर सकती है। आपकी स्पीड और प्रिसीजन इस लेवल की थी कि दुश्मन हक्का बक्का रह गया। उसको पता ही नहीं चला कि कब उसका सीना छलनी हो गया। साथियों, हमारा लक्ष्य पाकिस्तान के अंदर टेरर हेडक्वार्टर्स को हिट करने का था, आतंकियों को हिट करने का था। लेकिन पाकिस्तान ने अपने यात्री विमानों को सामने करके जो साजिश की रची, मैं कल्पना कर सकता हूं वो पल कितना कठिन होगा जब सिविलियन एयरक्राफ्ट दिख रहा है। और मुझे गर्व है, आपने बहुत सावधानी से, बहुत सतर्कता से सिविलियन एयरक्राफ्ट को नुकसान किए बिना कमाल करके दिखाया, उसका जवाब दे दिया आपने।
भारत माता की जय! भारत माता की जय! भारत माता की जय!
मैं गर्व के साथ कह सकता हूं कि आप सभी अपने लक्ष्यों पर बिल्कुल खरे उतरे हैं। पाकिस्तान में आतंकी ठिकानों और उनके एयरबेस ही तबाह नहीं हुए, बल्कि उनके नापाक इरादे और उनके दुस्साहस दोनों की हार हुई है। साथियों, ऑपरेशन सिंदूर से बौखलाए दुश्मन ने इस एयरबेस के साथ साथ हमारे अनेक एयरबेस पर हमला करने की कई बार कोशिश की। बार बार उसने हमें टारगेट किया, लेकिन पाक के नापाक इरादे हर बार नाकाम हो गए। पाकिस्तान के ड्रोन, उसके यूएवी, पाकिस्तान के एयरक्राफ्ट और उसकी मिसाइलें हमारे सशक्त एयर डिफेंस के सामने सबके सब ढेर हो गए। मैं देश के सभी एयरबेस से जुड़ी लीडरशिप की, भारतीय वायुसेना के हर एयर वॉरियर की हृदय से सराहना करता हूं। आपने वाकई बहुत शानदार काम किया है। साथियों, आतंक के विरुद्ध भारत की लक्ष्मण रेखा अब एकदम स्पष्ट है। अब फिर कोई टेरर अटैक हुआ तो भारत जवाब देगा, पक्का जवाब देगा। ये हमने सर्जिकल स्ट्राइक के समय देखा है, एयर स्ट्राइक के समय देखा है, और अब तो ऑपरेशन सिंदूर भारत का न्यू नॉर्मल है। और जैसा मैंने कल भी कहा, भारत ने अब 3 सूत्र तय कर दिए हैं। पहला, भारत पर आतंकी हमला हुआ हम अपने तरीके से अपनी शर्तों पर अपने समय पर जवाब देंगे। दूसरा, कोई भी न्यूक्लियर ब्लैकमेल भारत नहीं सहेगा। तीसरा, हम आतंक की सरपरस्त सरकार और आतंक के आकाओं को अलग अलग नहीं देखेंगे। दुनिया भी भारत के इस नए रूप को, इस नई व्यवस्था को समझते हुए ही आगे बढ़ रही है।
भारत माता की
साथियों, ऑपरेशन सिंदूर का एक एक क्षण भारत की सेनाओं के सामर्थ्य की गवाही देता है। इस दौरान हमारी सेनाओं का कोऑर्डिनेशन वाकई में कहूंगा शानदार था। आर्मी हो, नेवी हो या एयरफोर्स, सबका तालमेल बहुत जबरदस्त था। नेवी ने समुद्र पर अपना दबदबा बनाया, सेना ने बॉर्डर पर मजबूती दी और भारतीय वायुसेना ने अटैक भी किया और डिफेंड भी किया। बीएसएफ और दूसरे बलों ने भी अद्भुत क्षमताओं का प्रदर्शन किया है। इंटीग्रेटेड एयर एंड लैंड कॉम्बैट सिस्टम ने शानदार काम किया और यही तो है जॉइंटनेस। ये अब भारतीय सेनाओं के सामर्थ्य की एक मजबूत पहचान बन चुकी है। साथियों, ऑपरेशन सिंदूर में मैन पावर के साथ ही मशीन का कोऑर्डिनेशन भी अद्भुत रहा है। भारत के पारंपरिक एयर डिफेंस सिस्टम हो, जिन्होंने अनेक लड़ाइयां देखी हैं, या फिर आकाश जैसे हमारे मेड इन इंडिया प्लेटफॉर्म हो, इनको S-400 जैसे आधुनिक और सशक्त डिफेंस सिस्टम ने अभूतपूर्व मजबूती दी है। एक मजबूत सुरक्षा कवच भारत की पहचान बन चुकी है। पाकिस्तान की लाख कोशिश के बाद भी हमारे एयरबेस हो या फिर हमारे दूसरे डिफेंस इंफ्रास्ट्रक्चर, इन पर आंच तक नहीं आई और इसका श्रेय आप सभी को जाता है और मुझे गर्व है आप सब पर। बॉर्डर पर तैनात हर सैनिक को जाता है। इस ऑपरेशन से जुड़े हर व्यक्ति को उसका श्रेय जाता है। साथियों, आज हमारे पास नई और कटिंग एज टेक्नोलॉजी का ऐसा सामर्थ्य है जिसका पाकिस्तान मुकाबला नहीं कर सकता। बीते दशक में एयरफोर्स सहित हमारी सभी सेनाओं के पास दुनिया की श्रेष्ठ टेक्नोलॉजी पहुंची है। लेकिन हम सब जानते हैं, नई टेक्नोलॉजी के साथ चुनौतियां भी उतनी ही बड़ी होती हैं। कॉम्प्लिकेटेड और सोफिस्टिकेटेड सिस्टम को मेंटेन करना, उन्हें एफिशिएंसी के साथ ऑपरेट करना, ये एक बहुत बड़ी स्किल है। आपने टेक को टैक्टिक्स से जोड़कर दिखा दिया है। आपने सिद्ध कर दिया है कि आप इस गेम में दुनिया में बेहतरीन है। भारत की वायुसेना अब सिर्फ हथियारों से ही नहीं, डेटा और ड्रोन से भी दुश्मन को छकाने में माहिर हो गई है। साथियों, पाकिस्तान की गुहार के बाद भारत ने सिर्फ अपनी सैन्य कार्रवाई को स्थगित किया है। अगर पाकिस्तान ने फिर से आतंकी गतिविधि या सैन्य दुस्साहस दिखाया तो हम उसका मुंह तोड़ जवाब देंगे। ये जवाब अपनी शर्तों पर, अपने तरीके से देंगे। और इस निर्णय की आधारशिला, इसके पीछे छिपा विश्वास आप सबका धैर्य, शौर्य, साहस और सजगता है। आपको ये हौसला, ये जुनून, ये जज्बा ऐसे ही बरकरार रखना है। हमें लगातार मुस्तैद रहना है, हमें तैयार रहना है, हमें दुश्मन को याद दिलाते रहना है, ये नया भारत है। ये भारत शांति चाहता है, लेकिन अगर मानवता पर हमला होता है तो ये भारत युद्ध के मोर्चे पर दुश्मन को मिट्टी में मिलाना भी अच्छी तरह जानता है। इसी संकल्प के साथ आइए एक बार फिर बोले, भारत माता की, भारत माता की, भारत माता की, वंदे 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 वंदे। बहुत बहुत धन्यवाद।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Nifty Sensex and lower for the day, fall over 1%. Nifty IT is the top losing sector for the day, dragged by Infosys and HCL Technologies. Meanwhile, defense stocks rallied up to 4% after Prime Minister Narendra Modi called for greater military self-reliance following India's launch of Operation Sindoor. India approaches the World Trade Organization with a proposal to impose retaliatory duties against the United States over President Donald Trump's tariffs on steel and aluminium. Prime Minister Narendra Modi visits Adampur Air Base in Punjab to meet soldiers after the ceasefire with Pakistan. He praises the armed force for Operation Sindoor in a powerful address which targeted terror sites in Pakistan and Pakistan-occupied Kashmir. Air India Indigo cancelled flights to multiple cities amid security concerns. Flights to and from Srinagar, Jammu, Leh, Bhuj, Amritsar, Chandigarh, Jodhpur, Jamnagar and Rajkot cancelled for the day. The Supreme Court will decide on the high-stakes case for GST demand on online gaming platforms, fantasy sports operators, casinos and race courses applicable retrospectively from July 2017. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's take a look at how the markets fared today. Backtracking on the gains from yesterday and early today, the Sensex plunged 1,200 points after a historic surge and even the Nifty closed over 1%. The indices were dragged lower by IT majors like Infosys and HCL Technologies. My colleague Harshna joining in with a wrap of all of the action in the market today.
When you talk about the index, down around 1.3 to 1.4%, around a third of the points that we gained yesterday shaved off today. So I would look at it as a two-day, over the course of the last 2 days rather than just on this Tuesday. Yesterday, we gained a very solid near 4%. Today, we've cooled off a bit of that. So some of those gains given away. Within some of the big losers were IT stocks and Infi, TCS, Wipro all making it to that bottom rung of stocks where there was pressure. The Nifty IT index also was down 2+% in trade. Mind you, the gains were 6% yesterday. So net of that, we're still well in the green for the week where IT is also concerned. But that was one pressure pocket. The stocks which did well were within the defense packer. BEL was the top gainer on the Nifty 50 index and the Nifty defense index was up 4% again today. So very strong gains that we are seeing in that pocket continuing. In terms of other stocks, maybe a Cipla was in focus on the back of numbers, 0.5% higher at close. And then you had a couple of other numbers which came through as well. So again, earnings was the key focus area in trade even today. No major reaction, at least on the Nifty 50 with regard to earnings, but in the broader markets there were plenty. Something like a CARE ratings was up 14% on the back of its very, very strong numbers. So that was the other pocket. In terms of specifics, the bank Nifty was down around 0.8%, so we saw a cool off there as well. We also saw a percent shaved off the Nifty auto, the Nifty metals. Those were two pockets where a percent each was shaved off. The Nifty pharma did relatively well. So that was the one sector which again stood out along with the Nifty defense. But we spoke to Dinshaw Irani, especially with regard to the financials and how the earnings have been. Listen into a slice of that.
Fourth quarter has been a fair bit of disappointment. I mean, we were expecting bad numbers, but till now, whatever the numbers have which have come out, if you do some pure statistics on those numbers, it's 60% disappointment. I mean, the 60% of the companies reported have downgraded, the analysts have downgraded the numbers. So it's not looking that great as such. I think the analysts maintained numbers for 4-5% of the companies and 30-odd% saw upgrades also. So that's why I said we want us to be selective out here. Can't be carried away with what's happening globally because domestically things going forward look well, but today they're not looking too great. I mean, consumption bit, rural is picking up a bit. Hopefully monsoons are good, so that also will add to that fervor on the consumption front. But in the urban consumption, that's still a bit of lag.
And a quick update coming in, the Consumer Price Index or CPI-based inflation for the month of April has come out at 3.16% as compared to the estimate of 3.20. Let me quickly bring in my colleague Pallavi now joining me from the studio. Pallavi, this is after it came in at 3.34 in March, the lowest since August 2019 and below the central bank's target of 4%. Over to you.
That's right. It's another positive print that we are continuing to see on the inflation front. Now, like you mentioned, the headline figure has come in at 3.16%. That is broadly in line with expectations according to a median poll of economists by Bloomberg. The estimate we were looking at was 3.2%. So this is very much in line with expectations, and also as expected, the decline continues to be largely from food and specifically from vegetables. So we're continuing to see vegetable prices contract on an annual basis. Vegetable inflation came in at 10.98% for the month. Let's also look at some quick key internals. Food and beverage inflation has come in at 2.14%. Within that, like we've mentioned, vegetables at seeing a contraction of 10.98%. We're also seeing pulses in contraction of 5.2%, spices in contraction 3.4%, meat and fish also seeing a modest contraction on an annual basis. Other important categories like cereals, inflation there grew at 5.4%. Now, clothing and footwear inflation came in at 2.7%, while fuel and light inflation came in at about 2.9%. So, for a quick insight into what to make of these figures, let's quickly go to Madan Sabnavis, Chief Economist at Bank of Baroda. Mr. Sabnavis, thank you so much for taking time out to speak to us today.
Yeah, thanks, Pallavi.
So, So, what are you making of these headline figures? Another positive print, and what are the implications in terms of this print? Also, we are seeing some continuing de-acceleration on the inflation front. What is the projection going forward?
See, Pallavi, if you actually look at the inflation number coming in at 3.2%, it's more or less on expected lines, as you said. And we're going to see these kind of low numbers for the next couple of months too, because we've had very high indices, very high inflation numbers in the comparable periods of last year. So therefore, this sub 4% number is something which is going to continue for the first quarter. And that's probably one of the reasons why, if we look at the forecast which has been made by the RBI for Q1 has also been at the lower side. The issues will only come, I think, in the months of July, August. I think that's a time when we could be expecting to see what's the progress of the monsoon, whether this kind of easy food prices will remain for a longer period of time. And because as we are coming towards the Kharif sowing and the Kharif harvesting, then I think we'll get a clearer picture about the route to be followed by food prices. But as of now, I think it does look like that we will be in this comfortable position of inflation being less than 4%, something which the RBI can take for granted at this point of time.
Okay, all right. So what does that mean in terms of rate cuts? From what the expected rate cut trajectory was a few months earlier on to now, we've actually seen instances of inflation surprising on the downside. Does this mean greater space for the RBI to cut rates and a deeper rate cut cycle than might have been anticipated previously?
See, purely on the basis of these numbers, I think there is a strong case for expecting the RBI to go in for a rate cut. Because if you look at what the RBI has been doing, especially on the liquidity front, they have ensured that liquidity has never been an issue for the banking system. So that's a kind of a precondition which has always been met. But as I told you, the inflation number was expected to be at these low levels. So I don't think it would be altering the course of a decision on rate cuts at this point of time, purely on the basis of inflation. There would be other considerations which you have to keep in mind. One is, of course, the arrival of the monsoon. Now, today we are expecting to come earlier than normal in Kerala. The progress of the monsoon, which we'll get to know in the months of June and July. And combine this with the fact that the entire tariff effect, I think that is something which had also created a bit of disruption in the past. We'll probably get a bit more clarity by the time we enter July, or maybe in August. So to my mind, it's fairly evenly balanced as of now, whether the RBI should be going in for a rate cut or will they be going in for a rate cut in this particular policy. Because we should remember that the RBI has been talking of inflation being 4%. That's the average for the entire year. The first few months will be having low inflation. Subsequently, it'll be going up, moderating, then again going up towards the end of the year. On an average, we're talking of 4%. So if I look at 4% inflation for the year, a real return of 1.5%, something which the RBI studies have also been talking about, I think an ideal repo rate of 5.5% looks fairly meaningful to me right now. And given the fact that we have already moved from 6.5 to 6, I think we could be expecting the terminal rate to be in the region of 5.5%. Now, how exactly or how soon we'll be moving over to 5.5%? I think that's what will depend upon how the MPC members look at it.
Okay, sure. I do have one last quick question for you before we can let you go, Mr. Sabnawis. So, we are very comfortable, at least in the near term, on the inflation front. What is the picture that's emerging on the growth front? We're expecting GDP figures for Q4 shortly from now on, later this month. We did see a little bit of a slowdown, but there are signs of a recovery from that. All in all, what are you making, even from high frequency indicators? And has there been any blip at all in terms of broader economic activity from the evolving situation over the last week, which is now, of course, more diffused?
No, let's split it into two parts. When you're talking of the GDP numbers coming out, we're talking of 24, 25. I think the CSO or the NSO did have an estimate of 6.5%. I think there could be a slight downside, but otherwise we'll be in that particular region. The reason being that corporate profits have not been that buoyant. They've been less impressive than what we thought. So since corporate profits will be going into the value-added concept for certain sectors like manufacturing, there could be a slight downside out there. Now, this side, if we're looking at 25, 26 and whatever we have seen in the month of April, I think the demand side situation, especially when consumption appears to be fairly much on track. And so I think just based on one particular month, it does look like that it may, of course, be too early for one to generalize it for the entire year. We may probably still be on the stable path of growing towards, by growing by around 6.5% in 25, 26 too. This is keeping in mind the fact that there could be certain problems which would come in case the tariff issue is not resolved in the United States, in which case exports get affected, SMEs get affected, there could be a slight downside on there. But on the whole, I think a very stable environment is what we could be expecting, comparable to that of 24-25 in 25-26, based on the indicators which we've seen so far.
All right. Thank you so much, Mr. Sabnavis, for taking time out. Always a pleasure speaking to you. So, Sanjana, once again, inflation, providing quite a sense of comfort, coming in at the lowest we've seen in nearly 6 years. And we're looking at CPI inflation at 3.16% for the month of April.
Right, Pallavi, especially on the past few weeks being quite a bit heavy on the news cycle. So this is some kind of reassuring information coming in. Thank you so much for that update. Let's take a quick look at what's happening on the markets front, because in the wake of Operation Sindoor, India's decisive response to terrorism, the defense sector has garnered heightened interest from investors. Now, this surge in attention likely stems from renewed confidence in the strength and capability of India's armed forces amid these recent geopolitical tensions. Adding to the momentum, we saw Prime Minister Narendra Modi in his address to the nation yesterday, his address to the nation just an hour ago to the Indian Armed Forces, particularly with the Air Force, emphasizing the importance of domestically manufactured defense equipment under the Made in India initiative, further fueling optimism in the sector. Let me quickly bring in my colleague Malika for a closer look at the key developments driving the buzz in defense. Malika, over to you.
Yes, thank you for that, Sanjana. And as you rightly mentioned, there's a lot of interest that's fueling into defense stocks. And let me give you 3 key reasons why we're seeing that interest. Firstly, geopolitical risk boost defense spending, because, in such a scenario, governments spend more money and therefore the demand for defense products increases. Second is robust order book. Now, most of these companies have very strong order book, indicating that they have a solid source of revenue in the future, which is also buying into the kind of investor sentiment that we're seeing. And also current valuations at 50 times their earnings versus their five-year average of 37 times indicates the fact that investors are comfortable paying maybe a premium price for these defense stocks. Now, let me give you a sense of what some of these companies make, which has, sort of brought them to the front line. Starting with Idea Forge. Idea Forge makes drones like Switch UAV, which is used for long distance spying and creating military maps. The second one is Bharat Dynamics. Now, this produces guided missiles and other defense equipment. HAL, this one is amazing as it builds fighter jets and helicopters. Bharat Electronics creates advanced systems like Akash Tir, which also helps the military control and report air defense activities. Zentech also supplies ammunition, bulletproof vests and designs training system for combat practice. We also have DCX Systems, and this one especially rose highly in trade today. It manufactures cable harnesses and electronic parts for defense and aerospace projects across India. Now, also remember that back in 1999, the defense expenditure by the government of India back then was increased by 6%. And as of today, the total defense budget stands at about 6.81 lakh crore rupees, out of which capex, which is basically the money that is used for modernizing equipment and upgrading the defense infrastructure, stands at 1.8 lakh crore rupees. So it would be interesting to see if there would be a division in that value.
Right, Malika, stay with us, because it's not just defense. We're also seeing the IT sector that has been drawing significant attention as analysts and brokerages are reassessing their outlook, particularly in response to the US's advancing trade negotiations with key global partners, whether it's with China, whether it is Donald Trump landing in Saudi Arabia. And we're seeing recent developments, including tariff reductions in the US-China trade, a new trade agreement between the US and the UK, all of this now contributing to a more optimistic view of Indian IT firms. Additionally, we're seeing India's ongoing negotiations with the US for a bilateral trade agreement aiming to enhance market access and reduce these trade barriers, which could further strengthen the IT sector's prospects. Could you provide more details on how analysts are positioning Indian IT stocks in light of all of these developments?
Yes, I think you very well wrapped up the kind of sentiment that the information technology sector is sort of undertaking. Firstly, there was an interesting trend that was observed that as soon as US-China tariff announcement was made, NSE Nifty IT soared about 6.9%, which was the highest since March 5th levels. Now, second, analysts have come out and also upgraded their stance on many of these IT counters. Like, for example, CLSA upgraded IT sector to overweight from underweight, increasing IT weightage in their portfolio. Also, Macquarie sees no sharp slowdown for Indian IT sector in 2025, and this is especially citing as you mentioned, the US, UK and US China trade deal. Third one is, what are the kind of growth drivers and long-term trends that are playing in? Macquarie predicts multi-year tech refresh driven by hardware upgrades. Basically, they're going to undertake multiple cycles of expenditure with regards to upgrading their technology. Many of these companies, that's what Macquarie is saying. And UBS also highlights that Indian IT giants would undertake, cost take-out deals and also outsource their trends, which would play into expanding their gains. Also, UBS was the only brokerage that came out with a cautious note, and they say that the Indian IT space may lose gains due to multiple compression in a weaker macro environment, but they also said that the correction in many large cap IT companies could be an entry point for many investors who want to buy into these. Also, lastly, some top picks as Infosys, TCS and Persistent Systems emerged as a top picks on an average for most of these brokerages.
Right, Malika, thanks so much for that very detailed, comprehensive breakdown of defense and the IT sector, and we look forward to see how both of those stocks and the sector actually performs in the coming days as we see more developments geopolitically. Now, India has adopted a more assertive trade position against the United States, formally notifying the World Trade Organization of proposed retaliatory tariffs on various US goods. This action comes in response to Washington's ongoing duties on Indian steel and aluminium exports. So if implemented, the move could signal a crucial shift in India's trade strategy, particularly as bilateral discussions with the US remain ongoing. Let me quickly go across to my colleague Rishabh, who's going to take us through the details of the WTO statement. Rishabh, over to you.
What we saw coming in from the WTO last night was sort of a shift in stance that India is portraying, especially given the fact that there are ongoing bilateral talks going on with the USA. Despite that, India has chosen the platform of the World Trade Organization to actually register its protest and also file potential retaliatory duties against the US as well. I spoke to a couple of experts. What they had to say was the fact that this is surprising. It comes at a delicate time between India and US relationships. Obviously, the global trade, the global tariff wars, the uncertainty is still very much there. It is also signaling India's tougher stance at the WTO, but it continues to remain within the WTO's rules and regulations as well. What Pankaj Chadha of EEPC, the Engineering Exports Promotion Council, told me was the fact that this move is heartening. It shows that we still have some sort of a voice at global stages, but the situation remains volatile. It remains flexible given the fact that these duties have just been proposed right now. They have not been implemented. The potential date of implementation could be 30 days from now. So around June 8th or June 10th is when we can expect certain duties if the US does not withdraw its counter duties, or if the US does not invite India to the negotiating table with respect to these tariffs. So the next 20 to 30 days, we'll be keeping our eyes peeled on what sort of action the US now takes, given the fact that the ball is now in Washington's court.
Right, remains to be seen how that actually unravels. Let's shift focus to what's happening now on the front of Operation Sindoor, with air travel being disrupted, and that's continuing as major airlines including Air India and Indigo that have cancelled flights to multiple cities citing security concerns. While precautionary blackouts prompted these cancellations, some airlines have resumed operations like SpiceJet in Srinagar. But my colleague Sesa now joining us on the phone line to tell us more about the same. Sesa, if you could give us an update of what airports have reopened, what airlines have resumed operations, which ones have cancelled their flights. Take us through it all.
Right, Sanjana. So, within hours of announcing a progressive resumption of flights at airports that were reopened after being shut for nearly a week due to Operation Sindoor, Air India and Indigo have cancelled their flights scheduled for today to as many as 9 cities, including Srinagar, Jammu, Leh, Chandigarh, Amritsar, among others. Now, overall, what we are learning is that 79 flights were cancelled in total to and from Delhi airport. And flights to these regions were mainly cancelled, even as the airports remain opened. These cancellations were announced mainly to ensure safety after precautionary blackouts were enforced in Amritsar and a few other areas of Punjab following suspected drone activity. In fact, what we have learned is that an Indigo's Delhi-Amritsar flight turned back to the capital midway due to the blackout, last night. However, another important development here is that SpiceJet said that they have resumed scheduled flight to Srinagar today, and they will even restart their Hajj 2025 flights from Srinagar starting tomorrow. However, as other airlines like Indigo and Air India, we don't have an update yet as to when the services will resume for the affected airports, but what they have indicated is that the services will resume only, in a gradual manner.
Sessa, thanks so much for that. We'll continue tracking the latest with regards to air travel disruptions and which airlines will resume operations. Let's take a look at what's happening in the top court today. The Supreme Court is hearing a crucial case on the taxability of online gaming involving a 1.12 lakh crore GST claim that dates back to July 2017. The ruling could have major implications for gaming platforms, fantasy sports, casinos, and even racecourses, particularly on whether games of skill should be taxed differently from games of chance. For more details, my colleague Aishwarya now joining in.
Well, for online gaming companies, the last week was quite crucial. Even this week, some of the cases will be heard in the Supreme Court as far as retrospective GST is concerned, and the other contentious issue, of course, has been the cases clubbed, state government cases that have been clubbed of the states of Tamil Nadu, Karnataka and Telangana, which have attempted in the past to ban online games like poker as well as rummy. Apart from this, of course, the 28% provisional retrospective GST levy on online gaming platforms is one of the other big contentious issues that online gaming companies are looking forward to as well. Now, a little bit of background as far as this case is concerned. It involves a retrospective GST of over 1.12 lakh crore rupees from these online gaming companies, date backs almost to 2017. Apart from that, the operators argue that the game of skill should not be taxed like we do in the case of gambling. So this is something that we must look out for as far as this matter is concerned. We'll keep you posted as and when the proceedings go ahead and bring you the latest.
Thanks, Aishwarya, for that. We'll continue tracking the developments from the Supreme Court. Meanwhile, let's take a look at some of our other stories that are making news around the country. On his last day in office, Chief Justice of India, Sanjeev Khanna, said that public trust that the judiciary has cannot be commanded, but it has to be earned. On his final day in office, Chief Justice of India, Sanjeev Khanna, was given a warm and emotional farewell by colleagues on the bench and the members of the bar, who praised his humility, clarity of thought and unwavering commitment to constitutional values. Schools in Srinagar have reopened after being shut for several days due to heightened hostilities between India and Pakistan along the line of control and the international border. The return to classrooms mark a sign of easing tensions in the region, bringing relief to students and families that have been affected by the recent disruption. Today at the Supreme Court of India, lawyers and advocates came together to honor the unwavering courage and sacrifices of the Indian Army. In a powerful display of solidarity, they stood united in support of the Indian government in Operation Sindoor, reaffirming their commitment to justice and national security. 3 terrorists have been killed in an encounter with security forces in Jammu and Kashmir's Shopian. Another terrorist could be present in the area. The encounter initially began in Kulgam and then shifted to a forest area in Shopian. Security personnel of the army and paramilitary forces have been fighting the terrorists for about 2 hours now. Security forces intercepted the terrorists following an intelligence input. The Indian Met Department has said that the southwest monsoon advanced into parts of South Bay of Bengal, South Andaman Sea, Nicobar Islands and some areas of the North Andaman Sea on Tuesday. Meanwhile, a weather official said there is a possibility of a cyclone brewing in the Bay of Bengal. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to KYC. This is that show where we try and get you actionable insights on each individual company daily. Today we're going to cover Home First. It's an interesting company because one, it's in the housing finance space, domestic facing, and some of these housing financiers are growing at a very, very fast clip. So you want to first off check whether that kind of growth clip is sustainable or not, and that's the first piece what I'd want to know about this company. Can the growth clip sustain? 33% is what they've grown over the last 3 years. Can that kind of a number sustain? Maybe over the next 3 to 5 years is really the question. What helps them stand out? Because credit costs haven't gone up substantially despite that AUM inch up. So you want to understand what helps them stand out, or whether this is only a cycle with regard to credit costs. Can the cost to income fall? Is there scope for that? It's fallen over the last 3 years. Is there scope for further improvement on the cost to income front, which could well aid the return on assets number? What happens when private equity funds choose to exit? Now, mind you, there's a ton of private equity investors within the company. What happens when they decide, well, we want to exit? It could well pressure the counter, and therefore investors need to be mindful of how the private equity investors are choosing to exit. Now, one other piece with very much linked to the return on assets is the top line and spreads. The spread is generally the difference between the lending versus the borrowing rate for an NBFC. This one is seeing a shrink with regard to spreads. So is maintaining spreads a challenge? One thing is margins, the other thing is spreads. Spreads is on an ongoing basis and therefore is not impacted by the capital structure. I will explain this in greater detail, but is maintaining spreads a challenge? And last up is with regard to geographic expansion. They're currently in a limited geography, just about 13 states. As they grow, is there an intent to increase their geographic presence, and therefore does that pose a risk to asset quality? We'll talk about all of this and more, but first off, we'll look at one, what this company does exactly, and we'll try and break it down. And second, we'll look at all the metrics which we always speak about. So let me first start off with about the company. The company was incorporated on the 3rd of February 2010 in Bengaluru. It listed itself on exchanges in 2021. Between those two, converted itself into a public limited company in March of 2018. So that's how the journey has been. Listed in 2021, currently operates to 361 touch points, 155 branches, 13 states and union territories, larger focus on tier 2 and tier 3 cities. That's how they are spread. There you go, tier 2, tier 3 city focus. So that's how they are spread. Now in terms of milestones and journey, again, we'll reboot. Commenced operations in 2010 after National Housing Bank registration that they got. They thereafter secured minority stakes from Bessemer Venture Partners and Tata Capital Growth Fund in each of the years, 2011 and 2013. Thereafter, they turned profitable only in 2014. They established a foothold in the affordable housing finance space. True North acquired a majority stake for over 600 crore with Aether Mauritius, which is a GIC affiliate, joining as a co-investor in the promoter group. They are still within that promoter group and they still on a combined basis own 13% of Home First Finance. Warburg thereafter came in, acquired a 25% stake at 700 crore, and this was largely, of course, all of this was pre-IPO, so something to keep in mind. They signed co-lending partnerships with Union Bank of India in December 2021. They also launched their IPO in 2021. It was a 1154 crore IPO and subscribed 26 times, so plenty of interest. It also opened at a premium of 20% to the issue price. In 2021-22, they signed partnerships, Central Bank of India as well as Union Bank of India. Both of those partnerships coming through, they expanded reach thereafter because they signed these partnerships. The AUM crossed 10,000 crore in May of 2024. That's the other milestone. They raised 280 crore from IFC for green affordable housing finance also in 2024. Thereafter, successfully 1,250 crore rupees raised through a QIP in April. They've boosted their capital and the AUM is currently sitting at 12,700 crore. That's how the journey largely has been. Now, affordable housing finance, it's a fast growing sector, doesn't need too much introduction, so I won't delve into that. But what we will delve into is the metrics, which we always do. Let's first start off with what are the metrics we look for. One, we'll look at the income statement. We'll thereafter look at the balance sheet, the operational metrics and the asset quality. We'll also look at shareholding, valuation, street cred, street coverage, and in the middle of all of this, we'll look at the return ratios as well. So we will delve into how return ratios are also doing, even though that's not the metric we've looked at. Let's look at the income statement to start off. The net interest income has gone up by 29% over the last 3 years. That's the CAGR it's given in terms of the 3-year CAGR. You can look at the numbers both FY24 and 25 which are on your screen. So healthy kind of growth that we've seen on the NII front. We've seen a bit of margin compression, but we will talk about that as part of operational metrics. The growth between FY24 and 25 hasn't been very sharp and there are reasons for that. We will delve into that as well. Provisions, we've just about seen around a 5% 3-year CAGR on the provisions number, so no real concern per se there. And profit after tax has seen a 27% growth when you're looking at the last 3 years. In the last year or so, look at the kind of growth that it's clocked, 25% plus again. So very, very strong growth on the profitability metric as well. Let's look at the journey over the last 3 quarters now. And it's been fairly steady, as you can see. The provisions number is what I want to really highlight. No real inch up. It's been fairly steady. Profit after tax also nearly there. We've seen profit after tax for Q4 FY25 just inch up a marginal bit. And you can see that sequential inch up. It's a very healthy inch up. It's the first time where they've clocked profitability of 100 crore plus, which is in Q4 FY25. So making good progress in that sense. So a clear thumbs up with regard to this metric, just because some of the numbers really impressive in terms of growth. Now let's talk about the balance sheet, because that's the other piece. We've seen good AUM growth, 33%. We did speak about that over the last 3 years. Sustainability of this is the question. Borrowing number is at 41% when you're looking at it in terms of growth, and your capital adequacy continues to remain quite healthy at 33%. So no concerns here. Let's list out the key takeaways from the balance sheet as well, if we can. And the key takeaways from the balance sheet in particular are the healthy AUM growth that we've seen, strong capital adequacy that we are seeing. They have a guidance that their leverage ratio will be maintained at no more than 1:5. So they will not skew the balance sheet, or they will not add borrowing disproportionately. Every time it reaches 1:5, they will do an equity raise in about, not absolutely 1:5. And they've recently undertaken an equity raise of 1,250 crore on the balance sheet. So those are some takeaways for you with regard to balance sheet metrics. Let's look at asset quality now. And thumbs up on the balance sheet. Sorry, let's look at operational metrics now. When you're looking at the operational metrics, we see that margins have slowly crept downwards. So from the 6.4% number, they've come down to 5.2% at this point. Spreads also have seen a similar kind of trajectory, but the difference is lower. Now, in terms of where margins is concerned, very important to understand this. The margin number is linked to the net interest income number. The net interest income number is linked to the interest expenditure number. The interest expenditure number is linked to the borrowing that the company does to do onward lending. Whenever a capital raise comes in, an equity capital raise comes in, you have to borrow less in that particular year, right? Or in the subsequent year as well, because you have adequate capital. If you do not do an equity raise, then you have to do a debt raise to ensure that growth comes in. Now, whenever there is an equity raise, the equity that comes in as capital then goes out and earns you interest income. But there is no interest expenditure linked to this interest income. And therefore, you will see interest expense remain flat, but interest income go up, which means your margins will see a bit of a lift. And that will only be temporary. Your normalized margin will very quickly be reached as that capital gets completely utilized, and you have to thereafter raise debt to ensure that your 1:5 leverage starts to kick in. For the moment, this margin movement is largely because they haven't done an equity raise from FY23 to FY25. FY25 is when they've done the equity raise. So you might likely also start to see a bit of an inch up in terms of margins temporarily. Thereafter, it may be a year or two till the next equity raise that you will see a gradual fall with regard to margins. So that's how the margin trajectory will go. We will quiz them as to what the goal is with regard to margins, but the better number is the spread number. The spread is the absolute difference between what you are lending at versus what you are borrowing at, and therefore that spread number is what is relevant. When we look at the spread number, we'll realize that that has also fallen, and that's where likely the concern is. The ROA number though is fairly steady. At 3.5%, ROA is very healthy. It's come off a little bit from that 3.9%, but that's also because of what I just explained in terms of interest expenditure. The ROA, which is the profitability, is linked to the interest expenditure, and as the interest expenditure has gone up, right, because they have not done any equity raise over the last 2 to 3 years, because the interest expenditure has gone up, you've seen an ROA dilution, and therefore you will see that also as a very, very normalized piece. It's within the realms of the way Home First does its business, and therefore no concerns at all. What you want to though look at is borrowing cost. Between FY23 and FY25, we've seen the repo rate go up and the borrowing cost has inched up. Is there scope for this to come back off? And what is the impact on spreads and margins? That's what you want to really look at, and thereafter assess the impact of that on your ROA and profitability. I hope that this kind of sums up in a nutshell all that's reflecting on your screen. The other piece is the OPEX to assets. OPEX to assets has come gradually down, as you can see. It's a healthy gradual taper. Can this taper continue going forward? It will be the question, because that will also impact your ROA number and your profitability. As your OPEX grows not as fast as income grows, right? If your OPEX is not going to inch up as fast, then you really then you will see an impact of that on profitability. So you will see better profitability on the back of that. That's on the operational metrics. Now let's look at asset quality very quickly. It's largely steady, but it's above the 1% threshold in terms of NPAs. So in that sense, it's a neutral. We've seen other housing financiers clock a lower NPA ratio absolute, but no concerns per se on the asset quality front. Let me just clarify that. Where shareholding is concerned, there are large PE investors which are involved. You look at the promoter holding. Within that promoter holding, there are very large PE investors. There's a True North, there's a GIC, which we spoke about, but there are also others. Even within the DII basket and even within the public basket, there are plenty of investors which are there, which hold chunky holdings, who will eventually want to exit. How does this exit happen will be the question, but for the moment, you're seeing one, marquee investors, which is a positive, but two, you might see them at some point of time sell as their funds expire. Not that they want to sell, but because their funds will expire and they'll require the money to pay out back to the investors. That will actually impact both the shareholding pattern as well as liquidity in the stock, which could impact the stock price performance. So we've given this a neutral therefore. Last couple of pieces. One, you have valuations. When you're looking at the valuation picture, and let's pull it out very, very quickly. There you go. Your price to book, and I've tried to sum this up. Maybe you can take a screenshot of this. What you can actually see is the price to book for Home First versus the 3-year average is at a slight premium. It does an ROA of 3.5%. Let's ignore Canfin for the moment. Let's compare absolute comparables. Aptus 4.24, 4.49, slight discount to 3-year average, and you look at the ROA 7.7%, but this ROA is not sustainable because they have a very, very high amount of equity. They still need to leverage the balance sheet. So again, not the right comparable. Let's look at Aadhar, right? 4.36 price to book, 4 times is the 3-year average price to book, and 4.3% ROA. So the ROA is better, the price to book is largely in line, and the 3-year average, this one is trading at a far sharper premium. Last one is an Avas, and Avas is trading at 3.9 times, 4.2 times is the average, so it's trading at a discount, and 3.2 times, so sharply lower in terms of ROA. So this is your available universe, right? I'm not saying that some of them don't look expensive, but you compare it to a Canfin Homes where your ROA is 2.25%. Your discount to 5-year average is quite sharp, right? And maybe Canfin looks far more attractive in relative terms versus some of the others, and therefore you might want to analyze this a little bit more. But for the moment, we're going to give the valuations which are extremely steep at 4.4 times. Extremely steep, probably the most expensive among all housing financiers. You want to give this a thumbs down, plus it's trading at a premium to 3-year average. So you might want to be cautious with regard to where valuations is concerned. Let's look at Street Cred. Now, in terms of the returns that the stock has given, it's been decent. 2% up last 1 month may not have been very impressive, but you look at the last year or so, and it's been a decent performance from a stock price perspective. 47% up over the last 1 year. So very strong performance. We'll give this a thumbs up as well. And you look at street coverage. When you're looking at the street coverage, 22 buys, 1 hold, 1 sell, 70% upside. Nothing to complain about per se. We'll give this a thumbs up as well. So that's how it all stacks up. Now, the rating parameters, thumbs up on income statement, balance sheet, operational metrics, asset quality. Also, shareholding pattern, you might want to be a little cautious. Valuations, definitely cautious. Street cred, thumbs up. Street coverage, thumbs up. It sums up a 6 out of 8 on our KYC ratings. Not bad at all, but let's quickly go on. Let's listen in to what the management had to say. We spoke with Manoj Viswanathan, who is the Managing Director and CEO of the company earlier. Listening.
This year we ended the year at 12,700 crores of AUM. And we have set a target for ourselves for FY27. That is a kind of a round number of 20,000 is what we have set for ourselves as far as FY27 is concerned. And then a slightly longer term, that is FY30. Our target is around between 35 to 40,000. Depending on how tailwinds are, how the economy is doing, etc. So that is broadly our plan. 20,000 in the next 2 years, FY27, and between 35 to 40,000 crores by FY30.
A 25% odd growth clip be something which is the absolute base that we can expect in terms of growth for Home First?
So yeah, next 2 years we are looking at a 25 to 30% AUM growth. What we had mentioned was that we can grow at about 30%. That is what we mentioned when we listed the company in FY21. And we have been growing at between 30 to 35% in the last 4 years. Now what we are seeing is that the base is obviously elevated. So we are saying that 25 to 30% should be a sustainable growth over the next 3 to 5 years. And for the next 2 years, at least the target is 20,000. So that translates to somewhere between 26, 27 or around 27 to 30% in that range. That is the growth for the next 2 years.
Tell us, there are 3-4 players in this space, in this affordable housing finance, or the smaller both ticket size as well as smaller size in absolute terms on the balance sheet. There are 3-4 players. What sets you apart? What makes you unique? And how does that help you stand out?
So as far as the balance sheet is concerned, I think one thing that sets us apart is the share of housing in the book. So we have 85% of our loans devoted to individual housing loans, which is the highest share amongst the peers that we are talking about. So that is something as far as the balance sheet that sets us apart. In terms of the business model, business process, I think what sets us apart is our you can say dedication, devotion to technology, using technology to facilitate things from day one. So we have been one of the early adopters of the Salesforce platform, centralized underwriting model, AI based or AI ML based underwriting. So these are things that have, that are things that we have kind of built over the years, and which have also led to some financial metrics or results, like, low operating expenses. So if you see our operating expense to assets, it is the lowest amongst the peers that you're talking about. And that is directly a result of our approach to the business, that is using technology, designing the process in such a way that the cost is optimized.
Point taken. And how does that help you going forward? You've given us some bit of color on how it's helping you currently, which is to optimize OPEX. OPEX now at OPEX to assets roughly at 2.7% for viewer perspective in Q4. But how does that help you in terms of numbers going forward? So say maybe a couple of years from now, is there scope for further contraction of this when you get to that 20,000 crore mark in terms of AUM?
It is possible. So by design, the design is that, the cost should keep getting reduced. And, but how much it will reduce from here on, can't really, put a number to it. But of course, because of the way we are designed, the OPEX should keep going down. So our estimate is that every year it should, or every 2 years it should be able to, we should be able to reduce it by about 5 to 10 basis points. So 2.7, so maybe, get it down to about 2.6 in the next couple of years. Because, the reason I'm saying that is that, we are already very, very well optimized on cost, and our OPEX to assets is amongst the lowest, compared to all these peers you're talking about. So we would rather focus on growth at this point of time rather than trying to optimize the cost any further.
And how does the spread move in this reducing interest rate environment? Give us an understanding of that. Do you expect yields to follow?
Yields, continue to remain under pressure. But I think most of the players in this segment, affordable housing segment, understand that there is a certain minimum margin that we have to maintain to keep the business profitable. And so obviously that acts as a moderator. So I think generally speaking, most of the players are looking to maintain a 5% plus kind of a spread on an individual loan. So hopefully that should moderate the yield pressure going forward. Unless something really draconian happens and the operating expenses are really dramatically reduced for across the board for all the players. Then some of that benefit could get passed on to customers and the spread could compress further. But otherwise, I would say that a 5% spread is something that most of the industry players in the segment they accept it as a reasonable spread that needs to be maintained.
Right. You have a fairly good visibility on the glide path with regard to AUM. You've done a 1,250 crore fundraise. How long does that last you for? At what level of AUM will you again look for an equity raise? And how many years ahead are we seeing no equity dilution for?
So we are clearly on track to hit till FY29. So the 1,250 crore raise should keep us, it will basically now, it's a function of leverage, right? So we were already hitting a 5 times leverage, so hence we raised the capital. So it will be again another at least 4 years before we start hitting that 5 times leverage number. So maybe FY29 is when we can start thinking about the next capital raise, but we should be good till then.
And before I talk about credit cost, tell us about both the interest expense part of it, because that will start to climb in relative terms, and your ROAs. So therefore, what is the band of ROA that you'd like to operate in, and does it get better? Does it get slightly trimmed down given that you'll have this capital of equity and debt which will play on the P&L as well?
So we have always articulated that ROA is probably not the right metric because the ROAs tend to fluctuate depending upon the leverage. So when the leverage comes down, like now it would, because we have just raised the capital, the ROAs tend to expand because the NIMs tend to expand because the debt on the balance sheet is proportionately lesser, because of the capital raise. So the NIM tends to expand and the ROA also tends to expand a little bit. So the ROA would, in our mind, the ROA would fluctuate between 3 to 4 depending upon the leverage. So in the years when the capital has just been raised, so the ROA would be closer to 4. And as we kind of head towards the higher leverage of about 5 times, the ROA would tend towards 3. So which is why we are more we anchor ourselves more to the ROE number. And our aim is that we want to, we actually exited with an ROE of 17% last quarter. And our aim is that between capital raises, we should be able to deliver a 16 to 16.5% average ROE for the shareholders. So immediately after capital raise, ROE is likely to shrink to about 13 to 14%. And then again, it will climb back up to about 17 to 17.5%. So on an average, between capital raises, our aim is to deliver a 16 or 16.5% ROE.
Understood. And therefore, so if ROA is not the right metric, is ROE the right metric? What's the right metric? Because both of those will fluctuate. So just trying to get perspective on that.
Yeah, both will fluctuate. But ROE being the final number in terms of return to the shareholder, we kind of want to anchor to that number. So the idea is that average ROE between capital raises, I would say, would be the right metric to track.
Right, so that was the conversation, of course, with the management of Home First Finance. Interesting company. Hope you found this breakdown interesting as well. Completely out of time on this edition from myself and everyone who puts the show together. Packed team, all of them. Thanks so much for watching and stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We talk about everything mutual fund related, personal finance related on this program so that you get actionable insight, so that you can manage your finances, you can manage your investments appropriately. And today I'd like to talk about a pretty far-reaching, wide-ranging subject, which is how to approach your investments in mutual funds if you're just starting out, or if you spend a couple of years trying to find your footing in this slightly complicated space. In fact, what I'd like to talk about is how to uncomplicate your investment strategy. And I've got a special guest to talk about that. He has been consistently giving advice which I think is very useful. Vijay Mantri, investment expert, joining me in studio today. Vijay, thanks so much for taking the time.
My pleasure.
Let me ask that question at the start, which is the first problem that a lot of people face is which mutual fund should I invest in? Because there are so many options that the paradox of choice plays out here. There is paralysis that sets in because you look at a screen and you're blank for a few seconds. How do I decide where to invest?
So I keep saying this all point of time that just like starting your diet or starting your physical activity, what to do is secondary. What you can do consistently is far more important. And for that, you need a helping hand. So if you have a dietitian, if you have a trainer, life becomes that much easier. So my first advice to anybody is to find a good mutual fund distributor or financial advisor who can help in this journey. Suppose you do not want to take that help, then one of the easiest thing to do is to look at flexi cap fund. And even if you are confused about which flexi cap fund to pick, then one of the better strategies to look at Nifty 500 index fund, because that captures top 500 companies of India. You have 70% weightage, approximately that number into large cap, and 15%, 17, 18% into mid cap, and 12, 13%, depend on the of a market structure at that time, you'll get a small cap. So you get flavor of all. So that is the way to start. The first stage is to identify a good advisor, MFD. Second, if you can't do that, don't want to do that, go for flexi cap fund. And even you get confused about which flexi cap fund to choose, go for a Nifty 500 index fund. In my opinion, all these things are secondary. The real test is that how much you allocate in equities and how long you stay invested. A gap between 15% allocation or 30% allocation in equity will be much better in your favor than ability to get the best fund in your portfolio. On that, we don't have any control. What is in our control is that how much we are allocating into equities and how long we would like to stay invested.
And your behavior also in times of periods of uncertainty, because we've gone through a phase, Vijay, where a lot of people, and I heard anecdotal evidence of this, and you would know this, probably clients calling you up during periods when the equity markets were just going lower and lower practically every day, particularly the broader markets. Of course, that picture has dramatically shifted over the course of the last 2 months. So those people that stopped their SIPs, those people that didn't deploy when the chips were down, they have not benefited from the up move that you've seen in the equity markets in India. But just to drive home that point, it's an important point to make that Vijay has made, is that just to get started, to cut your teeth, so to speak, the best way to do it is to take that exposure into equity. You may not see the best outcome in a couple of months, but then eventually, if you're consistent, then you will see it. So assume that you've done that. First, let's talk about the behavioral aspects of investing, because I'm sure that you've gotten calls. How did you deal with those calls?
So luckily for us, we have been a little counterintuitive in the sense that if a fund does very well, or if a sector does very well, or any market factor indices does very well, we generally don't advise our client to put money there. So in September 2024, and even before that, we are very clear that we will not recommend a small and mid cap fund. And investor was like crazy. And I remember in your show, we discussed that if somebody have a 10 years view, then why not a small cap? And I told at that time, I will see their conviction when the small cap goes through correction. At that time, will they add more to their SIP, or they start figuring out taking money out? So just remember one thing. In equities, particularly equity mutual fund, there's no permanent loss of capital. There's a temporary volatility, but it's not a permanent loss of capital. So if you're committing yourself to invest in mutual fund for long term, and if the market goes down, you should invest more, because in Indian equity market, there's always a bullish phase, always a bull market. Why always a bull market? Because how do you calculate your wealth? Number of unit multiplied by NAV is your total wealth. So either there's a bull market in NAV or there's a bull market in units. So if the market goes down, you get more units. And we explain on one of your programs. So I'll give one simple illustration. Suppose the fund's NAV was 10 rupees and it become 8 rupees. The NAV came down by 20%. But on 10 rupees NAV, suppose you're investing 10,000 rupees SIP, you would get 1,000 unit. But at 8 rupees, you'll get 1,250 units. You get 25% more units. So NAV is down 20%, units went up 25%. Now look at the same illustration. Suppose the NAV goes down to 5 rupees. The NAV has come down 50%, but number of units gone up 100%. That's why SIP is one of the beautiful product and one of the most interesting product and one of the best product for the investor. But the problem, Alex, with SIP, it is too simple. Like you're drinking a warm water. What is the best drink you can offer to people? Warm water. But it doesn't have any glamour. You can't put in a social media, had a wonderful time sipping warm water on Goa beaches. It doesn't cut the ice.
It doesn't cut the ice. Okay, that's a good analogy to have. And I like that you've noticed that I'm drinking. It's good for the throat. That's why I drink it. But so therefore, certain investments are good for you, but then you're not attracted to it because it's too simple. I like that. But having said that, what I have noticed, Vijay, is the inability of the investor to benchmark their returns appropriately. Do you think that that's the biggest challenge? Because you've gone through a phase post-COVID where people were saying, oh, 20% returns, what's your portfolio? Mine is doing 22%. And it's tough to talk about the fact that not everybody is going to go through that experience. There's an element of luck involved.
So I think India is a low trust society. So what has happened that either we trust our morning walk uncle or we trust the big brand. We don't trust enough the professional advice given by the people. So if your mutual fund distributor or your advisor tells you to stay invested, put money there, but your morning walk friend tell you that I've invested in a small cap and it has delivered better return, we're tempted to gravitate toward those kind of things. So it is very important that listen to the people who have a deep expertise in this kind of business, because, and please remember, Alex, that everybody come with limited cognitive abilities. You could be great at social relationships, somebody could be great at maintaining their diet, somebody great at managing money, somebody is great at managing family relationship, but not everybody is great at everything. So wherever you are not good, seek help from people to do that. Second part is that what we have witnessed, that Bible says one of the 7 sins is jealousy, envy or jealousy. Now, one of the worst thing we have seen people doing is that they're comparing their return with the return of
their neighbors.
So who's the best mother? Who's the best father? Who's the best spouse? Which is the best country? Which is the best family? What we have. So what is the best return you got in a portfolio? And if you're not happy, seek help, correct it, but immediate past return should not be the benchmark. So how to look at return very honestly? If India's GDP is growing in absolute term at 12 to 14%, that is the kind of compounding you see over decades. You will have a period where in a 5 year, 3 years, return could be 20% plus. If you got 20% return in 5 years, assume that in next 3-5 year return will come down. Ultimately, it will gravitate toward 12 to 14% CAGR over a longer period of time. But the magic of, suppose you compound your wealth at 14.5%, you compound your wealth, you double your wealth every 5 years, and if you continue to do 50 years, you get 1,000 times growth in your portfolio. But for that, you need to wait for 50 years. Here we are looking at in 50 minutes, 50 days, my money doubling. So that is the unfortunate part.
And it's also something that has pitfalls to it. But let's get into the brass tacks right now. You've said that for somebody who is starting out, a flexi cap option is a good option to consider. So the reason I want to ask you this is because you've never been shy of suggesting that thematic and sectoral is or thematic in particular. You say thematic is something that you can look at for alpha generation. Diversified is what you say you should start with, but then you, just like you graduate and you study more and you learn more in order to generate that extra alpha. If you understand what you're investing in, thematic is something to do.
Absolutely, but that you need help, because thematic, sectoral, your timing has to be, exit and entry has to be very good. One of the best time to invest in sectoral fund is when returns are negative, past returns are negative, but invariably people invest when the past returns are very good. That is absolutely wrong way, like we have seen in defense, PSUs, railways and infra we have seen in recent past. One of the best way to participate when the returns are negative. But thematic is a very different story. For instance, look at BFSI. Last time when we spoke about BFSI. Now, in BFSI, earlier it used to be just banks. Now you have public sector bank, private sector bank, you have fintech bank, you have gold finance, you have NBFC. And within NBFC, you have housing finance company, gold finance company, personal loan company. Then you have the entire capital market. You have stock exchanges, RTA, custodian, asset management company, wealth management company, distribution company, rating agency. And then you whole insurance basket in that. So you have health insurance, life insurance, general insurance. So what happened where the money is flowing? Suppose people are not participating in equity market, they keep keeping their money in bank deposit. That is also part of your portfolio. So the kind of bouquet of investment ideas you get. So Nifty 50, Nifty 50 or 50 stock, Nifty 100 have 100 stock, BFSI have more than 100 stock. Similarly, look at consumption. Now, consumption is just not FMCG. Jewelry is a consumption, even medicine is a consumption, travel, tourism is a consumption. Automotive is a consumption, alcohol is a consumption. So a whole basket of ideas where people are putting money. So you can go and, buy those ideas. Similarly, healthcare. Earlier it used to be just drug manufacturing companies. Now you have diagnostic center, you have a contract manufacturing, you have API, you have hospitals, you have all kind of
certain
stuff.
Chemical companies.
Certain chemical companies. So, and in my opinion, healthcare is new FMCG. You may stop eating noodles, but when a diabetes or blood pressure medicine starts, you have to consume it for...
At this juncture, if assume that I'm an investor that is coming to you, Vijay, you've been advising me over a period of time, and I've bought into this idea that you can use thematic tactically. And there's no harm holding this long term in your portfolio, because if you take a broad enough theme, then at one point of time or the other, and we're seeing foreign institutional investors once again start deploy into the Indian equity markets. And where do they go? They effectively often gravitate to the BFSI space, to the banking space in particular. So you've seen that up move in the banking index and individual stocks as well. So portfolios will start looking good. But the advice that you're giving to your investors right now, where would you deploy?
So right now we have been not only right now, but almost 6 months plus we are talking to people to invest in large cap because we believe Nifty 50 is compared to other indices much undervalued. We have been advising our client to look at BFSI segment, and particularly we chose one bank index fund because it has around 85% exposure to private sector bank. So we chose that.
Which one?
ICICI Bank Index Fund.
Okay.
So it has I think 85% exposure to private sector bank, and all of them has done exceedingly well. We have been last almost a year plus we have been talking about healthcare, but on healthcare we are advising investor to invest over a 12 to 24 month STP, and consumption is one theme we are liking it, and we believe that one need to look at putting money into consumption fund for a long term purposes. And all these indices have, all these sector themes have more than 100 stocks to own, and they are real quality companies in the portfolio. So we have been recommending our client, but depend on the risk taking ability of the client, the kind of understanding it demonstrate. When the market goes down, the kind of hit is comfortable taking. We assess those things. But most importantly, what we do is that when a theme or sector, when a theme is not doing too well, that is the time we look at
to double down on it.
So we look at, the starting point has to be, the sector has to be, or the theme has to be completely unloved by the market. Then only we look at, if somebody is like, for instance, in 2020 we started talking about PSUs, and when in 2024, 23, 24 we start taking money out from PSU equity fund, because we thought that enough money is being made and everybody is bullish on PSU. So we said that is not the right time to. But at that time, to ask investor to take money out
is difficult, just like gold right now, right?
Absolutely. Now, if you tell anybody to not to look at gold, they will run you.
But incidentally, we were speaking with Ashish Somaya of White Oak, and his multi-asset fund is one of the schemes, 4 or 5 of them, that have a material exposure to gold,
yeah.
And they've cut it. They've cut it from 25% to about 13% is what he was telling me.
Yes, so it is not only the question of your view on the gold, but you also look at which asset category is more attractive. So from these level, even the gold may go up, nobody knows.
Sure.
But the point is that where do you see more value? Maybe 2 years back you saw more value in the gold, today seeing more value perhaps in Nifty 50 or some other ideas.
Right.
So that's the way.
So we began this conversation talking about diversified funds, and recently, by the way, Parag Parikh has hit 1 lakh crore.
Congratulations to them.
And it's an amazing story.
Absolutely.
And I speak to so many people that are invested in this, and this is one scheme that often gets talked about, not really speaking about this one scheme, but when you talk about these diversified schemes that have reached this scale and size, one of the criticisms that, okay, to be fair, some of these have actually been able to counter that criticism, but let me spell this out anyway. The criticism is that they're unable to generate significant alpha because they're unable to take significant exposure to the smaller companies purely because of the scale and the size that they have. So a 1 lakh crore AUM, if they have to take a 1% exposure of AUM in a particular company, they have to be able to deploy 1,000 crore rupees. And so therefore, from that perspective, how do they do that? Where if the float is not available, they would have to take 10% at the very least in a large small cap. So is that fair criticism?
I do remember fantastic words by Ned Johnson, the founder of Fidelity. He said the star fund manager give their best return when they are becoming a star.
You're right.
So I think that sums up.
But spell this out so that people understand.
We have seen in the market, there are hot ends. There are great fund manager, great fund houses doing well, knocking alpha like 8%, 9%. But when the size increases, I think there's more awareness toward risk. There's more awareness about liquidity. So as you rightly pointed out, at 1 lakh crore fund, even you have to take 1% exposure, it is 1,000 crore.
Yeah.
And if you end up doing that, perhaps you end up buying 5-6% of that small cap stock. It is just not the question of your owning 5-6%, but the question is of liquidity.
Yes.
Because your liability side is completely open, because the client can take money out any day. So we have seen that there are some guys who's able to do a good job even after the size, but very honestly, the odds of continue to generate same kind of alpha with higher AUM history is not in their side, and we have seen the same phenomena in PMSs as well.
Okay.
So we have seen PMSs with lesser AUM generating super return, and because of that, the money comes in. When the money comes in, the same kind of performance is not repeated. And one of the most important thing, Alex, you need to keep in mind that funds returns and investors return are two different things.
Why don't you explain that?
So what happened, I have done a study with a fund house where I was working in 2006-07. I looked at data. So I looked at 10-year return. 10-year CAGR of that fund was 20%. And the investors' return in same fund was 12%. And the reason is that when the fund was small, they had huge investment outperformances. And because of that, they continued to get lots of money. They got money, lots of money. Most of the money come at the peak of the market. So they got lots of money at the peak of the market. No fault of them, because they had outstanding performance. And then the market fell. So what has happened on 1,000 crore, 2,000 crore, 3,000 crore asset, they have outstanding performance. And suddenly in a year, they got, say, 10,000 crore. And then the market fell 50%.
And so therefore, those people that got in at the peak have not had the benefit of
So
that.
Axis Mutual Fund did a wonderful study of comparing return of investor and return of the investor in the same scheme and return of the scheme, and there was a huge difference in both. And this is being done by many companies internationally as well. So one of the best thing to get your return closer to the scheme is to stay invested for the long term.
Okay. And consistency, therefore, is key. The reason we speak about Warren Buffett in such a glowing manner is that the gentleman is 90 plus, and he has had that experience and the gumption to hold on to certain ideas. Of course, he's made his mistakes along the way. Nobody's perfect. But purely by dint of living as long as he has and holding as much as he has, he's made money. Sometimes it's that simple.
No, actually, it is quite a perception battle, because I don't think his holding period is as long as it's been predicted.
No?
Yeah. There's enough material available on social media where you could look at the churn of the portfolio, and according to his own admission, he made most of the money in 12 to 15 stocks.
But isn't that often the case for fund managers? They get that kicker from.
So it's a very different thing when you compare fund manager with Warren Buffett.
Of course, yeah.
Because Warren Buffett doesn't run open-ended scheme. Right. His AUM is fixed.
Yeah.
Okay. He doesn't get inflow. He doesn't get outflow.
Yeah.
It plays a very big role, and he's on the business.
So the need to invest is not there.
Need to invest is not there, and. If anybody want to sell Warren Buffett shares, Berkshire Hathaway share, it doesn't impact the AUM of the organization. So even he underperform for 3, 4, 5, 10 years, he's not bothered. Let that be a open-ended fund manager. Give him the liberty for underperformance 5 years. The money will go away.
Yeah.
So we are not comparing apple and orange.
The reason that I brought up Warren Buffett is that I have rarely met people that don't aspire to have that kind of wealth generation, right? And the argument that a lot of people make is that one of the primary ways, of course, you can be consistent and you take the slow journey to the top. And one great avenue to do that is mutual funds. In your opinion, should people have individual stocks?
I won't recommend, because there's enough studies done. One done by my ex-DWS colleague, Raju, and Ravi Raju. According to him, out of some 5,000 plus stocks on NSE, 50% of money is made in 37 stocks, and almost 100% of the money made in 65 of the stock over a 20-year period. We have enough data to suggest. Even you could look at people who file long-term capital gain return, and you could look at income tax website and figure out We have a 36 lakh, 37 lakh crore of direct stock investing. And you see turnover on the stock exchange of people buying and selling, and then compare how much tax they are paying, long-term capital gain.
It's not there. So therefore the counter argument to somebody saying don't invest in large diversified funds, the blessing for the retail investors, the ability to choose individual stocks and get 100 baggers. The problem is it's not so easy to find a 100 bagger.
One of the surest way to destroy. And for instance, look at Sensex, which came in 1986. They had 30 stocks, and today only 5 survive. Now, in 1986, who told you which 5 stock will survive? Even if you look at Nifty, a few years back, one fund house did a research. Out of total gain of Nifty, 50% of gain came only from 3 stocks.
Yeah.
And if you look at Nifty's data, that fund house gave this data, that Nifty made 180 addition, okay? Out of 180 addition, only 54% was in positive, 46% after coming into Nifty, these stocks lost.
Negative
so
returns,
that is at the Nifty level.
Yeah.
Now assume, and people are not looking at multi-bagger in Nifty, people looking at small cap, micro cap. And there was a study done by, I believe, by Motilal Oswal Group, where out of 2,300 micro and small cap, only 2 made to large cap and 2 made to mega cap. But very funnily, everybody seems to have multi-bagger in the portfolio.
On that note, Vijay, I would invite everybody that's listening in to write to us and tell us what you think about what Vijay has spoken to me about. We've talked about how you should keep things simple, and ultimately, I think that's a good place to start. Vijay, thanks so much for taking the time, for speaking to me. Always a pleasure.
My pleasure.
And that brings us to the end of this edition of Your Money Matters. Let us know, as I said, what you think in the comment section, and do stay tuned. Lots more coming up on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Hello and welcome to NDTV Profit. You're watching Earnings Edge, and with me is the management of Tata Steel, TV Narendran, MD at the company. Mr. Narendran, thank you very much for joining us on NDTV Profit. To begin with, sir, a good set of numbers that came in. Revenues up nearly 4.8%, and you had a net profit which has doubled on a year-to-year basis. Can you take us through the realization picture during the quarter in Q4?
Yeah, thank you, Sajid, for having me on the show. Yeah, Q4 was more about cost takeouts. Revenues were quite flat. The revenues improved significantly in Q4 compared to Q3. But I think we've been doing a lot of work on cost takeouts both in India and in Europe, and some of that played out. And that's a benefit that you see in the numbers for Q4. But overall, the market situation is getting a bit better. In India, the safeguard duties have helped. And in Europe as well, the spreads have improved a bit because the raw material prices have come off, and steel prices are reasonably stable. So we're looking at this trajectory continuing going forward.
Mm-hmm. Sir, during the year you brought in the Kalinganagar new furnace into play, and if you look at the India volumes, it was around 21 million tons, which is higher by 5%. Do you see further jump in volumes in terms of deliveries coming in FY26?
Yeah, in FY26 we are guiding that the volume will be about 1.5 million tons higher. Kalinganagar itself will be about 2 million tons higher, but we have a blast furnace relining coming up in Jamshedpur, which will take out some of the volumes at an overall level. So that's why our guidance is 1.5 million tons more, basically in India, in FY26 over FY25.
And how do you look at the European market, especially the Netherlands market, where you have seen some kind of cost efficiency gains coming in, and also give us a sense of how UK is looking now?
Yeah, so in Europe, you won't see too much of volume growth because we are pretty much peaked on the volumes, maybe a little bit more in Netherlands than you saw this year, because a big jump came in this year compared to last year, where the volumes are significantly higher. Overall, we see the Netherlands numbers continuing to get better because of the transformation actions that we are taking, and there is an improvement in spreads in Europe thanks to some of the quotas imposed by the EU in response to the tariff measures being taken. As far as UK is concerned, we continue to take out costs. We've taken out about 230 million pounds of fixed costs during the last year. We'll take out another 200 million pounds of fixed costs this year. So the markets are not great in UK because UK doesn't have the quotas that Europe has. We're seeing the pressure from the market, but on a cost side, we're taking out a lot. So we're expecting the EBITDA numbers in Netherlands to improve this year compared to last year. And in UK as well, we hope to get into positive EBITDA territory during the year.
Okay, you may not be positive, but in terms of EBITDA, you will be positive in FY26.
Absolutely.
What's happening to the entire revamp which is coming up in the UK? Have you started the work? What kind of investments is going to come in from you?
Yeah, so as we announced last year, it's a 1.25 billion pound project, out of which we're getting a 500 million grant from the UK government. The balance 750 million pounds will be put in by us. So over the last 6 months, we were working on the planning permissions, which we've got. I think by end of June, we will have all the permissions that we seek. We hope to start construction and do the groundbreaking and start construction in July. We've already placed a lot of orders for the equipment supply, and we are on track to get it up and running by FY27.
Sir, how do you look at the entire market as a whole, domestic market and globally? We're seeing a lot of disruption which is coming in with respect to tariff between US, China. Now it's gone for a pause for 90 days. How do you see the entire market dynamics changing? Is it from a pricing point of view and from a volume point of view?
So steel is a global industry. Not only does steel, about 400 million tons of steel go across borders, about 2 billion tons of raw materials for making steel goes across borders. So we are very geopolitically plugged in. Also, all our customers are global industries, automobile, packaging, appliances, so on and so forth, construction, etc. So whatever happens in the world has a big impact on us. So the tariff situation was not very helpful because most of our customers are part of global value chains and uncertainty doesn't help. But now that we are seeing some sort of stabilization on that, settling down of tariffs, signing of bilateral trade deals, I think we expect that the fragility that the market was encountering over the last few months will not be there going forward. So we are positive about it because tariffs also would have had inflationary pressures, which would have put pressure on interest rates, which doesn't help us again because we are a capital intensive industry. So overall, I see the situation improving in the last maybe 2-3 weeks than we felt in the first week of April.
There are two trade deals that are in focus. One is the India-UK trade deal, and the other one is UK-US trade deal. How does this benefit you in any way?
Well, for us, India-UK does not have much of an impact on steel. The UK-US, we sell about 80 to 100,000 tons of steel from the UK to the US. So that had a little bit of doubt about it, but that's gone off with this. It's not yet a formal trade deal. I think it's some sort of an agreement between the UK and the US, and that's beneficial to us. Again, more importantly, bringing down the import duties on automobile exports from UK to US is helpful for us indirectly because we sell to the auto industry in the UK as well. So overall, like I said, lower tariffs is, or stability in tariffs is good for our business.
Sir, in FY25, you did a capex of nearly 16,000 crores. Is there a guidance that you have for FY26 and 27?
It will be in that range. It will be about 15,000 crore plus. It will be 15,200, 15,300 crores.
And where are you going to put in that capex in?
80% of that will be in India because we will be completing the Kalinganagar expansion. We have a electric arc furnace coming up in Ludhiana, which should also get ready during the year. and then the other sustenance capex. In India, also the investments that we are making in mining, because mining, particularly iron ore mining, continues to grow to feed our growing steel business.
What would be the total capacity once the entire capex is through in India?
In India, will be about 25 million tons with the Kalinganagar expansion included. And then after that, next year, it will move to 26 million because we'll have the Ludhiana plant up next year. I mean, by the end of this financial year.
In one of the statements, you had mentioned that you're investing nearly $2.5 billion in T Steel as a measure to infuse capital into some of the step-down subsidiaries. Can you give us a detail about where all this investment is going through?
No, I think that was maybe miscommunicated or misrepresented. Basically, what we're doing is onshoring some of the offshore debt that we have.
Okay.
So we're putting in money as equity and bringing back the debt. So there's no increase in leverage because of that. It is just a rebalancing of the way we have our debts, and we want to get more and more debt into India because that's where the cash flows are. It helps from that point of view.
And so, where is the debt going to be replacing? Which are the companies where you're going to replace some? Is it some of the European operations that you will definitely see some of the debt replacement?
No, not. It's more in the holding. The T Steel Holding is a company in Singapore through which we had made a lot of the investments. So we are just basically replacing the debt lying there with equity that we are putting in from here and carrying debt in the Indian balance sheet.
How do you see the debt picture playing out? Because your net debt was somewhere around 82,600 crores at the end of FY25. What is the kind of timeline and trajectory that you have to bring down this?
So even if you look at the last 6 months, end of September, we were at 88,000 crores net debt. So we brought it down to 82,000 crores in the last 6 months, and we'll continue to bring it down during this year. I don't want to give you a specific number, but clearly we are today at a net debt to EBITDA of about 3.2, and we've always said that we want to be close to 2.5 or better. So we want to move towards that. I'm not saying we'll reach that this year, but let's wait and see. We are working towards that.
You had mentioned in various calls that you're looking at a savings of roughly around 11,500 crores, 4,000 crores coming from India, 3,000 from UK, and 4,500 crores coming from Netherlands. Where are we on that? Are we on track to meet that kind of savings which you had articulated?
Yeah, a lot of actions in all geographies are going on. Like I said, we've already taken out 230 million pounds of fixed costs in UK last year. We'll take out another 200 million pounds. So that itself is more than 2,000 crores, right, out of the 3,000 crores. In Netherlands, we announced a 500 million euro transformation plan. So that's where the 4,000 crores is coming from. And we have multiple initiatives to support that. And India also, we have a lot of cost takeouts planned because we continue to drive efficiency and excellence across all our operations. So I think it's big numbers, but we are quite confident we are there.
You had articulated for FY26. Will that happen in FY26 or it may spill over to next financial year as well?
No, I think it's for FY26. I don't want to give up in April or May. I think we have the next 11 months. We will certainly chase those numbers and deliver it.
My final question to you, sir. Your adjusted EBITDA per ton was around 8,121, a marginal decline versus year on year. How do you see the EBITDA per ton, moving from here? Means, do you see prices to remain at the same level, or there is some firmness which will come in?
So if you look at our Q4 numbers itself, the EBITDA per ton is much better. This 8,100 is more reflective of the full year, right? So as the European business moves from negative EBITDA to positive EBITDA, it will no longer be a drag on the India business. If you look at our consolidated numbers, the consolidated EBITDA is lower than the standalone EBITDA, right? Europe has had negative EBITDA, actually because of UK. Last year, in FY24, it was because of Netherlands and UK. In FY25, it is only because of UK. Hopefully, in FY26, we should have a consolidated positive EBITDA from Europe. And we are looking forward, certainly, to UK also breaking even on its own.
Mr. Narendran, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
Thank you, Sajid.
Thank you.
US President Donald Trump has pharmaceutical industry in his crosshairs. He's been threatening pharma tariffs for quite a few days now, and last evening announced through an executive order that pharma prices in the United States will be brought down drastically. Now, just a couple of lines of context. In the United States, high drug prices is a huge political issue. It is a problem that the citizens of that country face. And if you do a peer-to-peer comparison on specific drugs, yes, people in the United States pay several times more than other people around the world for those drugs. Now, what Donald Trump is saying is that he's going to have a most favored nation kind of a situation where people in the US will pay the same rate as the lowest rate paid globally for that particular drug. We've seen that impact on Indian pharmaceutical stocks in the last couple of days, a bit of a pullback on Tuesday's trade, but concern there that especially companies that have a bulk of their revenue coming in from exports to the United States will be impacted. Now, what exactly is the extent of impact? To speak on this, I'm joined now by Chairperson of the Biocon Group, Kiran Mazumdar-Shaw. Kiran, thank you so much for speaking with us. Always a pleasure to have you on. How did you decode what President Trump was trying to say?
If you recall, Tamanna, reference pricing was something
occupied Indian territory by Pakistan. और people like Manish, आपके लिए मैं हिंदी में रूपांतर कर दे रहा हूँ. हमारा लंबे अरसे से यही राष्ट्रीय पक्ष रहा है कि भारतीय केंद्र शासित प्रदेश जम्मू और कश्मीर से संबंधित किसी भी मुद्दे को भारत और पाकिस्तान को द्विपक्षीय तरीके से ही हल करना है. इस रीति में कोई बदलाव नहीं हुआ है. जैसा कि आप जानते हैं, लंबित मामला केवल पाकिस्तान द्वारा अवैध रूप से कब्जा किए गए भारतीय क्षेत्र को खाली करने का है. Siddhant, you had another question regarding ceasefire and what sort of role other countries played, etc. See, the specific date, time and wording of the understanding was worked out between the DGMOs of the two countries at their phone call on 10th May 2025, commencing at 15:35 hours. The Foreign Secretary had made a statement in this regard, as you would be aware. The request for this call was received by MEA from the Pakistani High Commission at 12:37 hours. The Pakistani side had initial difficulties connecting the hotline due to connecting to the Indian side due to technical difficulties. The timing was then decided based on the availability of the Indian DGMO at 15:35 hours. You will of course appreciate that early on 10th morning, we had mounted an extremely effective attack on key Pakistani Air Force bases. That was the reason they were now willing to stop firing and military action. Let me be clear, it was the force of Indian arms that compelled Pakistan to stop its firing. As regards conversations with other nations, the message from India was clear and consistent, and exactly the same message that we were conveying from public platforms was the one conveyed in private conversations. It was that India was responding to the 22nd April terrorist attack by targeting the terrorist infrastructure. However, if the Pakistani armed forces fire, Indian armed forces will fire back. If Pakistan stops, India will also stop. This was also the message that was conveyed to the Pakistani side at the time of the commencement of Operation Sindoor, which was not heeded to by the Pakistani side at that time. It is natural that many foreign leaders who heard this from us would have shared it with their Pakistani interlocutors. Jessica, you had a question on IWT. The other day you saw that after the CCS decision, this Indus Water Treaty has been put in abeyance. I would also like to take you back a little. The IWT, the Indus Water Treaty, was concluded in the spirit of goodwill and friendship as specified in the preamble of the treaty. However, Pakistan has held these principles in abeyance by its promotion of cross-border terrorism for several decades now. Now, as per CCS decision that I referred to of 23rd April, India will keep the treaty in abeyance until Pakistan credibly and irrevocably abjures its support for cross-border terrorism. Please also note that climate change, demographic shifts, and technological changes have created new realities on ground as well. Kandirmi had a question regarding trade matters. From the time of Operation Sindoor, commenced on 7th May, till the understanding on cessation of firing and military action on 10th May, there were conversations between Indian and US leaders on the evolving military situation. The issue of trade did not come up in any of these discussions. Siddhant, you had a question on the latest statement issued by the Pakistan Foreign Office. We have seen the statement made by the Pakistani side that a nation which has nurtured terrorism on an industrial scale should think that it can escape the consequences is fooling itself. The terrorist infrastructure sites that India destroyed were responsible not only for the deaths of Indians, but of many other innocents around the world. There is now a new normal. The sooner Pakistan gets it, the better it is. Shall we take more questions? Aditya?
Mr. Jaiswal, I have two quick questions. One, that some of the Indian diplomats who have given interviews abroad have said that India has electronic intercepts and gathered intelligence linking to Pahalgam attackers to the handlers, and they have been planning more attacks. So have you given any kind of this evidence to the foreign attaches and diplomats that were briefed today, and in the context of ambassadors also that were briefed earlier? And yeah, that's about it.
Megha?
Good evening, sir. Megha from NewsX. My question is that India, it's being reported, is going to be sending a team to the UNSC 1267 Sanctions Committee. The meeting is going to be held later in the week, and the purpose for it is to declare the TRF as a globally designated terrorist organization. If you could shed more light into this.
Okay. Rishabh?
Spokesperson, good evening. Rishabh from Times. Now, I have just two questions here. Pakistan Foreign Minister Ishaq Dar has given an interview to CNN, and where he has claimed success and suggested that India was keen to have the ceasefire. Your comments on that? Also, there are a lot of buzz on social media as well as in various international media about nuclear leakage in Pakistan. Can you shed some light on that as well?
Manas?
This is Manas from PTI. US President Donald Trump, again, he claimed yesterday that he stopped a nuclear conflict between India and Pakistan. And he stopped escalation and saved millions of lives through by reaching out to both capitals. He even said that in fact he pressured India and Pakistan to just come forward for the cessation of hostilities, saying that if you don't do, then I will stop trade with both the countries. So can you please clarify whether he just reached out to us and asked us to stop? You have been maintaining that in fact the resolution was arrived at by the two DGMOs, but have you just protested with the US side for making these claims which we consider are baseless?
Okay, let me take these questions. First, Aditya, your question. You know, we have had several rounds of briefings, and in these briefings we have also shared with you the kind of linkage we see between the perpetrators of the attack of Pahalgam, in particular the Resistance Front. Foreign Secretary in his statement also made very clear the kind of evidence that we see, and investigation is going on in this particular matter. You would have seen that TRF had taken responsibility, and then second time again, second day, twice they had taken responsibility, and thereafter possibly at the behest of their handlers they rolled it back. But TRF is one organization which is a front of the Lashkar-e-Taiba, and you would understand and perhaps be in the knowledge of it that we have been pursuing listing of TRF in the United Nations, by the United Nations Security Council, by the Sanctions Committee, UNSC 1267 Sanctions Committee. I'm not privy to what was shared 2 hours back, but for sure we'll update you on as to how the investigation progresses in this matter. Mega on UNSC 1267 Sanctions Committee. Yes, over the last 2 years or so, 23, 24, we have been sharing information with the United Nations Security Council, the monitoring team of the Sanctions Committee, as to why the terrorist TRF, which is the Front for Lashkar-e-Taiba, should be listed as a terrorist entity. We will be also, in few days' time, we will be sharing more details in this regard, and hopefully Security Council 1267 monitoring team will take strong note of what we present, what we file, and take due action against that is required. Rishabh, on your question regarding the interview that the Pak Foreign Minister gave. In the last week, as a result of Operation Sindoor, Pakistan has seen its terror centers in Bahawalpur, Murudke, Muzaffarabad, and other places destroyed. You have been informed of it in several of the briefings that we've had. Thereafter, its military capabilities were significantly degraded by us, and key air bases effectively put out of action. If the Pakistani FM wishes to project these as achievement, obviously he is welcome to do so. Where India is concerned, our stand was very clear and consistent from the start. We would target terrorist infrastructure operating out of Pakistan. If the Pakistani military stayed out, there would be no problem. If they fired on us, we would respond suitably. Till the night of 9th May, Pakistan was threatening India with a massive assault. Once their attempt failed on 10th May morning, and they received a devastating Indian counter response, their tune changed, and their DGMO eventually reached out to us. I just referred to the timings, etc., as to when they reached out. In essence, India's position remained the same. Pakistan's position changed on 10th May morning after its air bases were effectively put out of action. All you have to do is to look at who called who to negotiate the terms of the cessation of firing. By the way, we are living in a day and age where you have satellite pictures available commercially. I urge you to look at the satellite pictures of the sites which Pakistan says or claims to have attacked in India. Contrast it with the sites and places which we successfully targeted and destroyed. That will give you a clear answer. Claiming victory is an old habit. 1975 की बात यही थी, 71 की बात यही रही, 1999 करगिल वॉर में भी यही राग आलापा. तो पाकिस्तान का तो पुराना ये उनका ढोल बजाने का है, जो रवैया है, आलापने का रवैया है, ढोल बहुत पुराना है. परस्त हो जाओ लेकिन ढोल बजाओ. Rishabh, you also had a question regarding on that. I think there are 2-3 things there. There's talk of some. We saw some social media post about Egyptian, American aircraft, etc. But those questions are for them to answer, not for us. But on the nuclear, we in the defense briefing, if you remember, our side made things very clear as to what was the target, etc. As far as your particular question, I think the Pak foreign minister also has made some comments on that. Manas, about nuclear issue that you pointed out. See, the military action from our side was entirely in the conventional domain. This was also made very clear in the defense briefing yesterday. There were some questions also which were asked. There were some reports, however, that Pakistan National Command Authority will meet on 10th May, which we saw, but this was later denied by them. Pakistan FM has himself denied the nuclear angle on record. So, Rishabh, that also answers your question. As you know, India has a firm stance that it will not give in to nuclear blackmail or allow cross-border terrorism to be conducted invoking it. In conversations with various countries, we have also cautioned that their subscribing to such scenarios could hurt them in their own region. Can we take more questions? Okay.
Good evening, sir. Hedda Maheshwari from Sputnik, sir. Just a clarification. Secretary Marco Rubio tweeted that India and Pakistan had agreed to ceasefire as well as start talks on a broad range of issues at a neutral site. So would it be possible to get a clarification on this if we agreed to that? And sir, the second question is about India-US trade talks. India has formally notified the WTO proposing retaliatory tariffs against select US imports over Washington's tariffs on steel and aluminum imports. Would it be possible to get a clarification on this? And does it affect India's negotiating position vis-a-vis the bilateral trade agreement? Thank you.
Okay, Smita.
Smita Sharma here. I mean, the US State Department actually in the press statement of 10th May, it was in bold and headline that mentioned US brokered ceasefire between India and Pakistan. I'm just trying to understand if New Delhi actually rejected it outrightly, raised it with Washington DC then, that this framing was incorrect, or is it only now that India is making it clear that there was no US role in it? And just a quick question on whether there's any update on PK Sahu, the BSF constable, who has been in Pakistan captivity for more than 20 days now. Or he's been arrested there because he never been crossed.
Suhasini.
Mr. Jaiswal, this is Suhasini Heather from The Hindu. In continuation to Smita's question about whether India has raised with the US these clearly what you are calling false statements made by US President Donald Trump, that India did not broker, the US did not broker a ceasefire, that trade was not discussed. These are all things that have been said now on the record camera. So have you raised this at any level? And similarly, yesterday at the MOD briefing, we heard them speak about the Chinese hardware support to Pakistan. I wanted to ask if this is something that is going to be taken up with China in terms of India and China's own bilateral relationship. So both of them, are these two things going to have any impact on India's relations with either the US or China?
Neeraj.
Sir, Neeraj, who News 18 सर नीरज हूँ न्यूज़ 18 इंडिया से। आपने कहा कि कई अमेरिकी नेताओं की बात मिलिट्री जो कार्रवाई चल रही थी भारत की उस दौरान बातचीत हुई। प्रधानमंत्री नरेंद्र मोदी से किस अमेरिकी नेता की बातचीत हुई? क्योंकि मीडिया रिपोर्ट में आया है कि अमेरिकी उपराष्ट्रपति JD वांस ने उनसे बातचीत भी किया और ये भी अनुरोध किया था कि वो अपनी मिलिट्री कार्रवाई को थोड़ा कम करें, डीएस्केलेट करें। और दूसरा सवाल यह है कि जब भारत ऑपरेशन सिंदूर में चल रहा था पाकिस्तान के खिलाफ, आतंकवाद के खिलाफ माफ़ कीजिएगा, तो बांग्लादेश में अवामी लीग पर बैन लगा दिया वहाँ की सरकार ने। भारत इसको कैसे देख रहा?
Okay, first regarding your question about Secretary Rubio's comments, on that I've already spoken. I've told you how the understanding between India and Pakistan was bilaterally reached and what was the conversation that we had with other countries. On trade matters, I do understand that there is a proposal which has been made in Geneva. It has been made very recently, so I don't have further details on that, but for sure we'll update you with the matter as we progress with those negotiations. Smita, again, I have already answered those questions of yours when I talked about, the question of ceasefire as to who decided, what were the terms, when it happened, etc. So I would urge you to look at those comments of mine. I've told you that we have conveyed our position. I conveyed our position here on record, so I will request you to look at that. On the matter of PK Sahu, I don't have an update, so possibly we'll get you an update, but these are matters which pertain to the Ministry of Defense and they are looking into it. Again, Suhasini, on ceasefire, I've made India's position very clear, where we stand. So I would urge you to look at my comments. On the other question that you had, and possibly it had come up in the conversation or the press conference yesterday, there we have, I would say that we have obviously taken note of this. I direct your attention to the comments in the defense briefing about the extent of their effectiveness or otherwise. नीरज, आपके दो सवाल। प्रधानमंत्री की बात अमेरिका के उपराष्ट्रपति JD वांस से हुई थी और उस दरमियान जो बातचीत हुई थी दोनों नेताओं के बीच में, उससे आपको अवगत भी कराया गया है। जहाँ तक अवामी लीग की बात है, the ban on the Awami League without due process is a concerning development. As a democracy, India is naturally concerned at curtailment of democratic freedoms and shrinking political space. We strongly support the early holding of free, fair and inclusive elections in Bangladesh. जो अवामी लीग पे बैन लगा है वो एक चिंता का विषय है। एक जो लोकतांत्रिक प्रणाली में एक तरीका होता है सब काम करने का, वो ड्यू प्रोसेस को दरकिनार कर किया गया है। एक लोकतंत्र के रूप में भारत जो वहाँ पर लोकतांत्रिक आज़ादी को रोका जा रहा है और जो वहाँ पर राजनीतिक गतिविधियों के लिए जो दायरा है वो कम हो रहा है, इसको लेके हम लोग चिंतित हैं। और साथ में हमारा ये मानना है, हमारा ये आह्वान है कि बांग्लादेश में जल्द से जल्द एक निष्पक्ष और समावेशी चुनाव कराया जाए। Can we then go? Manish.
सर, मैं मनीष झा हूँ, TV9 भारतवर्ष से। पिछले दिनों हमने एक और कैरेक्टर देखा, वो था तुर्की का रोल। जिस तरीके से टर्की के ड्रोन पाकिस्तान ने इस्तेमाल किए, इसके अलावा टर्की ने लगातार इस मामले में पाकिस्तान का सपोर्ट किया। जब हम आतंकवाद के खिलाफ लड़ाई लड़ रहे हैं और टर्की उस समय पाकिस्तान के साथ है, जबकि आपको याद होगा 9/11 के टाइम में अमेरिका का डायलॉग था कि अगर आप हमारे साथ नहीं हैं तो आप आतंकियों के साथ हैं। तो टर्की के मामले में भारत की अब नीति क्या रहने वाली है?
देखिए, जो सवाल का जवाब दे दिया गया उसको ना पूछे, कोई नया सवाल हो तो बताएं। येशी।
This is Yeshi Seli from Business India. Are there any leads of the terrorists who attacked on the 22nd of April? And 3 terrorists were neutralized in Shopian today. Do they have any links with the terror attack of the 22nd? And in addition, when are the next DGMO talks likely to be?
एक मिनट। बताइए।
सर, ब्रह्म प्रकाश हूँ न्यूज़ इंडिया से। मेरा सवाल है कि जिस तरह से ऑपरेशन सिंदूर के दौरान जो हमारे मित्र देशों की भूमिका रही, उसको लेकर खासतौर से अमेरिका की भूमिका ये देखा गया है कि भारत और पाकिस्तान को एक ही तराजू में बराबर तौला गया है, ये माना जा रहा है। क्या जिस तरह से भारत कहता रहा है, अमेरिका कहता रहा है कि दोनों क्लोज पार्टनर है, क्या भारत की डिप्लोमेसी को एक तरह से अमेरिका की तरफ से झटका लगा है? भारत इस पर दोबारा विचार करेगा? क्योंकि जिस तरह से रुख रहा है अमेरिका का, ये माना जा रहा है, सीधे शब्दों में कहें कि अमेरिका ने धोखा दिया इस पूरे मामले में। क्या कहना है?
मधुरेंद्र।
सर, मधुरेंद्र, मैं न्यूज़ नेशन से। यह स्पष्ट है कि चीन और तुर्की के हथियार भारत के खिलाफ इस्तेमाल किए गए, और इसी संदर्भ में मैं जानना चाहता हूं कि डिफेंस इंटेलिजेंस एजेंसी की जो आज ब्रीफिंग हुई है, क्या उसमें डिफेंस अटैचे चीन के और तुर्की के बुलाए गए थे? क्या बुलाए जाने पर उन्होंने अटेंड किया? दूसरा सवाल मेरा यह है कि हमने एक ट्रेंड क्रिएट किया है कि एनी एक्ट ऑफ टेरर विल बी एक्ट ऑफ वॉर। तो क्या उसको डिफाइन कर सकते हैं कि क्या आगे होने वाला कोई भी भारत पर पाकिस्तान की तरफ से या पाकिस्तान प्रायोजित आतंक की तरफ से हमला सीधे तौर पर कार्रवाई के तौर पे पाकिस्तान पर वॉर के तौर पे देखा जाएगा? हम सीधे युद्ध थोपेंगे या युद्ध करेंगे पाकिस्तान से?
मनीष जी, पहले तुर्की को लेके काफ़ी सारे सवाल थे। देखिए, सुहासिनी के सवाल के जवाब में मैंने बताया था कि हमारा क्या नज़रिया है, और तुर्की को लेके और चीन के लेके उनके जो वेपन्स वगैरह को लेके जो डिफेंस की ब्रीफिंग में भी खुलासा किया गया। तो मैं कहूँगा कि आप जो वहाँ पर बताया गया बात, उस पर ध्यान केंद्रित करें। जहाँ तक हम लोग का सवाल है, हम लोगों ने बताया कि हम लोगों ने इन गतिविधियों को नोट किया है, और साथ ही में जो कमेंट्स डिफेंस ब्रीफिंग में दिया गया था इन चीज़ों के बारे में, उस पर मैं आपका ध्यान आकर्षित कराना चाहता हूँ। और साथ ही साथ उन्होंने इसकी इफ़ेक्टिवनेस जो कितना पुरजोर रहा उसके बारे में या नहीं रहा उसके बारे में उन्होंने बात किया था। Yeshi, the investigations are on, so we'll have to wait for the progress. Obviously, when we make progress, we'll keep you updated. DGMO talks, I understand, had happened yesterday, and many of you were informed of the developments and the discussion that had happened. The rest, as and when the next DGMO level talks happen, you will be kept informed of it. ब्रह्म प्रकाश जी, आपने जो बात की, हाइफिनेशन की बात की, कि एक तरीके से भारत पाकिस्तान दोनों साथ में बंध गए, एक हाइफिनेशन हो गया, तो उस पर हम लोग का यह मानना है कि इट इज़ क्वाइट द रिवर्स. देयर इज़ widespread understanding in the world that Indian tourists were the victims of terror at Pahalgam, and that the epicenter of terrorism is across the border in Pakistan. A number of foreign leaders, बहुत सारे विदेशी जो नेतागण हैं, उनसे जो हमारी बातचीत हुई, उसमें उन्होंने माना कि भारत को अपने को डिफेंड करने का उसका हक है, और अपने लोगों को बचाने का, उसकी सुरक्षा का प्रदान करने का उनको हक है. मैं आपका ध्यान UN सिक्योरिटी काउंसिल का जो रेजोल्यूशन है, प्रेस स्टेटमेंट UN सिक्योरिटी काउंसिल ने 25 अप्रैल को जो अपनाया था, उस पर मैं ध्यान दिलाना चाहूँगा. वो प्रेस स्टेटमेंट बड़ा क्लियरली ये बताता है, मैं कोट कर रहा हूँ, देयर इज़ नीड टू अपहोल्ड परपरेटर्स organizers, financiers, and sponsors of this reprehensible act of terrorism accountable and bring them to justice. It stressed that those responsible for this killing should be held accountable. तो इससे आप जो हाइफिनेशन की बात कर रहे हैं ना, उसके पूरे ही विपरीत लोगों ने माना कि एक देश है जो आतंकवाद को बढ़ावा देता है, इंडस्ट्रियल स्केल पर आतंकवाद पैदा करता है और उनके खिलाफ सख्त से सख्त कार्रवाई होनी चाहिए।
अमेरिका ने भारत को धोखा दिया इस पूरे मामले में।
अमेरिका, जहाँ तक अमेरिका और अन्य देशों के बारे में हम लोगों ने अपना पक्ष आपके सामने रखा है। वी हैव श्रीधर, सॉरी, एक मिनट, ये इनका मधुरेंद्र का सवाल रह गया था। मधुरेंद्र, देखिए, तुर्की और चीन के अस्त्र के बारे में हमने अभी जवाब दे दिया है आपको, और जहाँ तक एक्ट ऑफ टेरर की बात है, हमारे तरफ से हमारे लीडरशिप के लेवल पे कहा जा रहा है कि क्रॉस बॉर्डर टेररिज्म का जहाँ सवाल है, हमारा ज़ीरो टॉलरेंस रहेगा। जब भी कोई इस प्रकार का घटना होता है तो हम उसका पुरजोर जवाब देंगे। उस डिफेंस अटैचे को बुलाया गया, उसकी मीटिंग हुई थी, उन्हें बुलाया गया था। कौन कौन वहाँ आए थे इसके बारे में मेरी संज्ञान नहीं है, मैं आपको इसके बारे में अवगत कराऊंगा। क्या मैंने कहा ना कि हमारे जो अभी प्रधानमंत्री के भाषण में आपने देखा होगा किस प्रकार का बयान था क्रॉस बॉर्डर टेररिज्म को लेके, और आतंकवाद से लड़ने के लिए जो हमारा प्रण है, जो हमारा नीति है, उसके बारे में खुलासा किया गया था, वो नीति रहेगा।
So, Sridhar from the Asian Age and Deccan Chronicle. 3 months back, when PM Modi visited the US, there was a joint statement in which the US specifically called out these Pakistan-based terror organizations. And, there was a widespread satisfaction in India at that point of time. But strangely, there was absolutely no reference to terror or Pakistan, that Pakistan needs to dismantle this terrorist infrastructure in the statements of President Trump. I mean, it was as if, two siblings are fighting and, the US has stepped in to end it. There was absolutely no reference to Pakistan sponsoring terrorism. Are you a bit shocked at that why there has been such a dramatic change in the past 3 months? And a small question, could we have a list of the civilian casualties in Operation Sindoor? We have got some figures from the military side on the military casualties. What about the civilian casualties? Are you going to reveal that? Thank you, sir.
Rita?
Vinita from the Asian Deccan Chronicle. Randirji, we have reached a ceasefire situation, but why are we seeing firing at the border and drone activities? Airlines had to start their function, but again shut down at 5 airports yesterday night. Just an idea that is everything okay at the borders, or are we still fighting a battle there?
Geeta.
Geeta Mohan from India Today. Just wanted to know again about the dehyphenation and hyphenation question. India invested diplomatically for years in the dehyphenation of India-Pakistan, not just with the world, but particularly with the United States of America, and we've seen them dehyphenate. And now we're seeing President Trump hyphenate India-Pakistan, speak of them in the same breath, talk about them being great countries that US wants to do trade with. Is India raising this matter with the United States of America, reminding them of 9/11 and Osama bin Laden?
Okay, Reza.
Reza from Hindustan Times. Just a quick question on President Putin's offer for direct talks with Ukraine. Do we have a position on that?
Okay. So you talked about fight against terrorism. You saw what the UN Security Council came up with a statement. The UN Security Council consists of 5 permanent members and 10 non-permanent members. It came out with a very strong condemnation. The United States is part of that. Our partnership with the United States as far as security, defense continues. It will continue to be, continue to grow and continue to deepen. Vinita, you had a question about drones, etc. These are questions that you will have to, when the MOD briefing happens, possibly they will give you. These are questions to be answered by people who deal with it. I don't have any particular update on it. Geeta, on the hyphenation part, see, I've already made it clear. Our understanding is that instead of being hyphenated, quite the reverse is happening, because people are realizing that here is a country which is running a factory of terrorism, and they need to be suitably taken to task. The conversation that we have had with leaders across the world, with countries, they have all stood with India. There was very strong condemnation from leaders across the world, countries across the world, and they also realize that India has the right to respond, to take action for protecting its people. Sorry, I have already answered your question. On Reza, on your question regarding the direct talks, we welcome the direct talks that have been announced between Russia and Ukraine. Talks present an opportunity for both parties to address their concerns through dialogue and diplomacy. India has consistently advocated the need for sincere and practical engagement between Russia and Ukraine to ensure early and abiding peace. With that, ladies and gentlemen, we come to the close of this press briefing. Thank you very much.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind
Welcome, you're watching The Big Question. I'm Tamanna Inamdar. After days of uncertainty, meltdown in global markets, investor sentiment dampening and fears of global recession and slowdown looming large, it looks like truce has been called in Trump's tariff war. At least for now. Both USA and China have agreed to lower tariffs for a 90-day period, effectively hitting a pause in their escalating trade war. While US tariffs have dropped from 145% to 30%, China has slashed tariffs from 125% to 10%. That's a whopping 115% drop in tariffs by both sides. The resolution comes about after trade talks in Geneva by representatives of both sides. President Donald Trump too praised the deal and said that the US intention was not to hurt China.
The talks in Geneva were very friendly. The relationship is very good. We're not looking to hurt China. China was being hurt very badly. They were closing up factories. They were having a lot of unrest. And they were very happy to be able to do something with us. And the relationship is very, very good. I'll speak to President Xi maybe at the end of the week. We have some other things we're doing. But one of the biggest things that we're doing, and I don't know if people realize this, but we made a great deal with China, great trade deal. But it was a much bigger deal originally, and then they canceled it right in the last day. Some of you faces I remember were there when that happened. I remember you. And we had a deal where they opened up their country to trade with the United States. And they took that away at the last moment, and then I canceled the whole thing. And then 6 months later, we ended up doing a smaller deal, but it was a big deal. It was $50 billion worth of product that they were going to purchase from our farmers, et cetera.
Okay, the move is significant as the duties that Trump slapped on China effectively established a trade embargo with one of America's largest suppliers. Both countries form the world's largest economies. China is also the biggest contributor to USA's over $1 trillion deficit. Remember, the US goods trade deficit with China was $295.4 billion in 2024. The relief was evident for US markets. Wall Street indices rallied. The S&P 500 closed at its highest level since the 3rd of March, and Nasdaq recorded its highest close since Feb 28th. Now, as to why both countries have chosen to press pause in this tariff war, of course, Trump tariffs were hurting the domestic economy's consumers. America's top retailers like Walmart, IKEA, who have significant imports from China, warned of supply chains being hit and store shelves becoming empty. The U.S. economy contracted in the first quarter of 2025 amidst concerns of a U.S. recession. This, coupled with rising prices of essentials, heightened the odds of the U.S. facing a stagflation. So economic stagnation plus high inflation. That's what stagflation is. As for China, in April, China's manufacturing activity fell more than expected to a 16-month low, threatening millions of jobs. So there were clear warning signs for both sides. In fact, China is not the only country that Trump has moved in for a thaw. Just last week, the USA and UK signed a trade deal which saw the US reducing or removing tariffs on some key exports like cars, steel and aluminum. Meanwhile, just this morning, India has proposed a counter duty on US products in the WTO over US tariffs on steel and aluminum. So the question is, what are we seeing right now? Is Trump's trade war truly over, or is this only the first episode? To speak on this, I'm joined today by Dr. Arup Raha, Chief Economist, APAC, Oxford Economics, Deepak Chinoy, Founder and CEO of Capital Mind, and of course, Jim Rogers, veteran international investor. Welcome to all of you, and thank you so much for speaking with us today. You know, what we're seeing when we report a 115% drop in tariffs reminds me of sometimes when we go shopping and we're told you have a huge discount on what you're buying. But the fact is that the original price was first hiked up, and then you got that big discount on the face of it. So 115% needs to be seen in that context. Jim Rogers, is the trade war truly over?
No, Tamala, the situation with Mr. Trump is, next week he'll watch something on TV and change his mind. Somebody like Margaret Thatcher, we at least knew what she would think and how she would change her mind. Mr. Trump, it depends on what if he watches NDTV, he's going to change his mind and he'll have a different view. It makes it very difficult for people like you and people like me.
Okay, so he could change his mind. For now, Dr. Arup Raha, what is the extent of relief you see? Because now the next step is even this 30% tariff that US is imposing on China, 20% of it is linked to fentanyl, etc. There can be a further drawdown with China being able to convince the US that no, we're not sending in fentanyl, and so bring it back to a 10 and 10?
Thank you very much for having me, and please call me Arup. Dr. Raha, I don't quite answer well too.
Okay.
So, just in simple terms, the US has changed its mind many times on how they are going about it. Fentanyl is one of the stories that finally came about. I don't think that is really the clincher here. Mr. Trump has always seen tariffs as a legitimate economic instrument because he views imbalances or deficits run by the US as that the US is somehow being cheated, that it's something, and not realizing that it's really a function of the savings investment gap in the US. I think this story isn't over yet. I think you're going to get a fair amount that's going to play out. But it's a good sign that actually they have come down on tariffs. I think there's been a recognition, at least on the US side, that tariffs are a tax paid by the US consumer or producer or whoever imports in the products. And hopefully it'll sort itself out. Markets seem to be quite happy about it.
Okay, markets seem to be quite happy about it. Deepak, how are you seeing it? Is this going to be, at the end of the day, people saying that, look, the Trump madness works? If the end result, whatever it looks like, is better than when Trump took over and launched this trade war, it would seem that he's made his point.
Well, I think you can paint anything as a victory, but honestly, I think it's the US that kind of had to blink because while China is hurting, China can take a lot more pain, I think, than the US can. Also because they're an autocratic economy, I don't think the instances of pain will be allowed to be magnified more than their government wants to. Well, America's relatively more free economy has greater indications of that these things will become in the forefront and will hurt effectively the politics as well. I don't think this was a victory really. It was more like, oh my God, we have to do something fast, otherwise everything's going to hell and back. And things kind of had to be brought in very quickly. China's tariffs on America are almost like a joke because China doesn't import quite that much, and it does have other sources to import from, even if it needed to diversify. But I feel here this is just the beginning. Every country, and in the end, this comes down to fiscal. We're all talking of trade. Right? America is the world's largest service exporter. there are no tariffs on American services, or America is not charging tariffs on services because they don't want the world to charge services on tariffs on their services. So it's a one-sided game here on merchandise, and we're not talking services. So I think the trade barriers and trade wars are just starting. We're going to see a lot more of this. And I don't think America.
So interesting perspective. Deepak says we're just seeing the beginning. Deepak, how did you see the announcement of what India has done in the World Trade Organization? That announcement that came in this morning on reciprocal tariffs on certain products in steel and aluminum, etc.
Well, it's steel and aluminum, so I don't think, I mean, it's like we've imposed tariffs on steel and aluminum in different ways. There was a point at which even with a free trade agreement with South Korea, we imposed tariffs on South Korean steel because it was like an anti-dumping. It was something called a safeguard duty that said you have to import at a minimum of, I think, some $600 or something per ton or something like that. Even if you take it from a free trade country with which we have a free trade agreement. So India likes to do this primarily because our steel industries are a big employer, and B, they're also such a huge borrower from the banking system. So we don't want to see the steel bankruptcies that we saw in the 2010s again. But we're not imposing tariffs on the stuff that we really import, which is chips and laptops and things like that, which eventually come from the US. A large amount of the money that we see spent even by Indian startups goes to Google and Facebook and all that stuff. And I think, our tariff measure is more like, listen, we've got to do something, but I don't think this is meaningful.
I just want to put into context something else that Trump said yesterday. I'm just going to continue that point with Deepak and then come to the others for their view. When he was talking about China and this entire deal, Donald Trump started referencing India, Pakistan and the ceasefire, which was a bit strange. Let me just play out that comment first and then we'll come to a discussion around it.
My administration helped broker a full and immediate ceasefire, I think a permanent one, between India and Pakistan, ending a dangerous conflict of two nations with lots of nuclear weapons. And we helped also with trade. I said, come on, we're going to do a lot of trade with you guys. Let's stop it. Let's stop it. If you stop it, we're doing trade. If you don't stop it, we're not going to do any trade. People have never really used trade the way I used it, that I can tell you. And all of a sudden they said, I think we're going to stop. And they have. And they did it for a lot of reasons, but trade is a big one. We're going to do a lot of trade with Pakistan. We're going to do a lot of trade with India.
So, this didn't sit too well. Because I can understand trade as a tool for negotiation in the context of trade. But when you talk about trade as a leverage for a national security matter, and one which is as grave as what we have seen in the last 36 hours, Deepak, what does that tell us? What kind of a deal can anyone make with the United States?
You can't. You could never do it. In the 1960s, when there was a famine in India, America tried to put conditions on exporting wheat to our country, saying that, listen, unless you open up this and do that, we're not going to allow you to get wheat, even though there's a famine and there's a problem in India. So it's always been like these things are interlinked. So we should not expect that anybody is our friend over here, right? So that's why we started the green revolution in India, and now India has surplus wheat and all that stuff. So it just proves you have to be self-sufficient. We don't do meaningful amount of trade with America. Of course, I mean, services we do, but merchandise, we're relatively small as a country. Pakistan is almost hilarious in terms of trade volumes. The amount they raised from the IMF with whatever they did yesterday was $1 billion. I mean, our startups raise more than that. So it's pretty much like, it's a very uneven game here. To hyphenate both our countries is almost like, I don't know what to say. But, politics is politics. You've got to play it.
But that's the thing, the politics of trade. How seriously can you take it? We're still waiting for the bilateral trade agreement with the US and India, which is why, Jim, let me come to, and full circle this. We've talked about US, China. We've seen US, UK. As far as US and India is concerned, this episode has kind of soured that conversation, or there's more that we can wait and see?
But Taman, I will just say that if you're looking for consistency from the Washington, you're in the wrong business. They don't know how to be consistent because they don't have their own consistent guiding principles. They do what they feel like that morning, or what their constituents call them and tell them. Mr. Trump wants votes. That's the most important for him. And if he sees on NDTV that, people aren't voting for him, he will change his mind.
Okay, now having said that, you made that, you're consistent in your view, at least I would say that, Jim. But then as an investor, as a veteran investor, how do you navigate this? Now, when you see the kind of surge we saw on Wall Street, you'll see them in many global markets. Do you now take a position that this will continue, or do you hedge your bets? How do you navigate what's happening?
Well, I personally have a lot of cash, US dollar cash, in the United States because the market's been going up for the longest in American history. And I know that Washington doesn't really know what it wants. They want to get rich. Well, everybody wants to get rich. So I don't see any consistency for me as an investor yet.
So no consistency as an investor. Arup, from the point of view of economic impact, more bilaterals, more one-on-one conversations, and do you see major trading partners now looking for conversations which don't necessarily have the United States in the middle of it?
That would be a natural effect of this, right? I mean, given, as Jim's very rightly pointed out, that it's not just Trump's policies, it's that he keeps changing his mind, there's a certain unpredictability, there's a fair amount there, and you really don't want to expose yourself to that. At the same time, the US is the world's largest market, so you can't also ignore it. But I think people, you've already started seeing it in terms of their neighbors, Canada, Mexico, starting to look for other alternatives, right, trying to strike trade deals elsewhere. And I think you're going to see a fair amount of it, that the people will try and lower their dependency on the US markets. That was what I was saying. But there's more to this, because one is the trade element to it. The other is the uncertainty that's been there and the effect that's having in terms of decision making, etc. And I think that's going to be the more lasting effect of what's happened on the trade side, rather than the actual trade friction. It's the uncertainty around it.
How would you look at the impact of that uncertainty, question to Arup again, on the US economy and on the global economy?
Well, the uncertainties, a few things are happening, right? People are not striking long-term contracts the way they used to. Even if you look at trade deals, they're typically struck, say, around the beginning of April, and they last for a year. Right now, it's pretty much being, we'll just see what happens, that kind of thing. The larger impact, though, is really going to be on investment, fixed asset investment. Are you really going to build a factory when you're unsure of what's going to happen? So you are looking at a downturn in growth no matter what. He could strike all tariffs down tomorrow, but the fact is that people are uncertain. They don't know what's going to happen, what kind of policies are going to come out from the US, and that is going to affect medium-term decisions. And I think that's going to be the larger effect of growth over the next couple of years, larger effect on growth for the next couple of years.
In terms of the Indian economy, and just to follow up for Arup over there, what do you see as the impact going forward? We don't have a bilateral trade agreement yet. If China is right now at 30% and India is at 27%, then the advantage that we were celebrating has now pretty much disappeared. Say we look at a base 10% and China comes down to a 10%, then that advantage disappears as well, isn't it?
And Deepak brought this point out. To be honest, we are really not competing with China. It's a different basket. They have different levels of competitiveness. So even if China's share goes down, which it has been, but you're seeing rather that a Vietnam is benefiting, a Korea is benefiting, etc. So we are not really benefiting. Our trade, the overlap between what we export and what China exports is very tiny. So it's not really a gain from us. I think the main gain that we will have if this thing works out is not the gain from striking a deal at the expense of China, but I think risk premium should come down if you strike a deal, which would bring some stability into the markets, and help decision making. I think that's the larger impact right now.
Having said that, Deepak, I mean, it was just very recently that we were all celebrating Apple saying that they're going to move a bulk of their manufacturing from China to India. So that did happen in the context of all of these trade conversations. And I understand completely it's not in the same realm right now. But as a growing power, India is being pitted as an alternative down the line, isn't it?
At some point, yes, but we're like a mosquito compared to an elephant in terms of the scale and size of what China does compared to what we do. So yeah, we can say we're big, but I don't think we are in terms of the numbers, in terms of capacity, in terms of investments. It will take us a decade to get there. So, I mean, I'm cognizant of the fact that we want to be more into manufacturing, but I think at best we can manufacture more for India. Compared to trying to manufacture for the whole world, we just don't have that depth right now, and it takes a lot to build something. It's difficult to build a Silicon Valley somewhere else, and it's difficult to build a China somewhere else, and that's because they've all nurtured their particular industries for so long that the ecosystem is really, really well entrenched there. So I don't think it's easy for me to say we'll benefit and try to compete in any meaningful way with China. Some things help, yes. An iPhone factory, which is run by Chinese people in India, is an alternative, yes. But is it really diversifying away from China? Not meaningfully, other than the fact that geographically you're located in India. So I would say to some extent, maybe, but let's not rejoice too early.
No, fair enough. But, the advantage India was not necessarily on manufacturing competitiveness or prowess. It is because India is seen as a more trusted source, right? So whether it's pharmaceuticals, and then you have the laws that the United States is mulling right now, where they don't want to be in China for some very, very core products. Maybe that's the context of the iPhone manufacturing shifting, etc. Are you saying that advantage now disappears after what Trump has said yesterday, where he's saying that, she is my friend, etc.? Deepak, the question to you.
Yeah, no, I don't think that's going to vanish, because if you see what has happened so far, the only thing that you know is you can't trust what Trump will actually say tomorrow. So it's possible that these whole tariff things come back, and therefore, having a dependence on one country for any manufacturer would be a problem. So they might want to diversify away and say, well, we got to have another facility somewhere else. We might depend on China for X, but we'll have another Y quantity coming in from another country. It could be Vietnam, Korea, India, or any of the other sources. So yeah, so there will be this fear that continues. I don't think equalizing tariffs or saying that this is a trade deal is done will suffice anymore, because people have realized that the situation is volatile, and we've got somebody who is as volatile as a president of the US. So you are going to have you're going to have to say that, listen, tomorrow if something else comes up, we're going to have to diversify. So I think this is true for India as well. We are not trusted any more than for convenience. We are, in the process, we are just another country that's external to the US. And at some extent, if we became very big, then there would be a problem on the same lines of thinking as they have for China today.
Do you agree with that, Jim? That equivalence still remains? And what do you make of the tone and tenor of what Trump is saying? He's suddenly very, very friendly when he's talking about the Chinese premier, as opposed to what he was saying a few days ago.
I will say that one of the things that has happened in the last several weeks is that, to me, India has become much more reliable. Delhi, for the first time in my investing life, understands economics. I understand that prosperity is good. And if you ask me, I really want to invest in India now in a more permanent way, because somebody now understands economics in Delhi. And I've been investing in India for decades. They never understood economics before, but something has happened. I hope I'm right. India is going to be much more exciting if that's the correct assessment.
So how much of your cash that you're sitting on are you putting in India, Jim?
I have zero in India right now, but if you'll get the market to go down, Tamana, I'll invest a lot there. So when you hang up, please do your best to get the market, the Indian market, to go down. Tell them Tamana sent me.
Yeah, no, I don't think there's any such magic powers, and no one here wants the market to go down at all. But in terms of impact, Deepak, since, we speak equities constantly, in terms of impact, do you think that the US-China trade euphoria is done and dusted? It's a half-a-day event for the Indian markets, because we saw that big bump up yesterday. And today, of course, a day of consolidation. But there's a lot more to come through this, isn't it? Because the trade war fears went on for weeks and impacted several sectors.
Well, not meaningfully. The market was like down less than 10%. So I think, there's some stocks which would have fallen more. But honestly, this is not as big an impact overall than a lot of other events that have happened. In fact, the market fell more when foreign investors pulled out last year than they did with this entire tariff thing, and including the geopolitical situation that happened. So I don't think this is a meaningful response by markets, as long as the Indian economy is doing well. And we are so inward facing compared to depending on exports, that our local economy matters a lot more for our markets than what's happening perhaps geographically worldwide as well. I would say that the true impact of whatever is happening is probably going to be visible only in the later half of this year, as all of these things crystallize and develop. Equity markets, there are parts of which are significantly overvalued, there are parts of which have a long way to go. But I think the contours will change as they always do. Once in a decade, there will be a shift to something else. It may be IT that was ruling the first decade of this century, and then it was FMCG perhaps in the second, and then now it may be the turn for manufacturing and defense and domestic consumption. So I think, we will see some of those contours or changes take place. But I won't place too much hope on, resolution through trade. I think this is going to be a very volatile year for politics. The trade war has just started, so expect a lot more of it, not less.
So what I'm hearing from our panelists, and the question that we posed today is the trade war over? Deepak Shenoy says it's just starting. Jim Rogers saying that anything can happen at any minute. Arup, what are you saying to that core question of is the trade war over?
It's a mix of what both of them are saying, that it's not over and anything can happen at any time. I think Jim's nailed it. I mean, it's not Trump's policies per se that matter. It's the unpredictability of his policies that are largely to have a bigger impact. So that's where I am.
It's a bit like the pause that we're seeing on the line of control right now. Everyone's ready for what happens next. But it's a pause for now. Maybe it's a pause in the trade war more than anything else. Thank you so much, Jim, Deepak, and of course, Arup, for joining us on the show today. And to all of our viewers, thank you for tuning in. Give us feedback on the show. We're waiting to hear from you. Tell us what you want us to cover.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Start with how you are looking at this quarter with the demerger still in play.
Yeah, thank you for having me. And actually, if you see the Raymond Limited, which is demerging its real estate business, and from tomorrow that would be ex real estate, the Raymond Limited. And I think if you look at the performance of our real estate business, it has come out very, very strong. We have delivered more than 2,300 crores of sales, 500 crores of EBITDA. And if you see the JDA, we have been able to put together another close to 7,000 crore of JDAs in this quarter. So overall, our JDA numbers reaches to 15,000 crores. So the portfolio which Raymond Realty has is around 40,000 crores, which will get executed over the next 5 to 7, 8 years. I think that way Raymond Realty is on a very, very strong wicket, executing its plan very well. And that is the need we thought is most appropriate, that one should get the Raymond Realty listed on its own, pure play business. And as your colleague pointed out, that for every shareholder who is holding one share of Raymond Limited will get one share incrementally of Raymond Realty. And we had done the demerger of the Raymond Lifestyle last year. In September, Raymond Lifestyle got listed, where the shares, for every 5 shares of Raymond Limited people were holding, they got 4 shares of Raymond Lifestyle. So that's where you have, as a group, 3 listed companies, pure play businesses, Raymond Realty with real estate business.
Let's do it this way then, Mr. Agarwal. Let's look at the individual verticals one by one, because that would give most clarity to our viewers on how these individual businesses are performing. And of course, they will then going forward have an opportunity to have participation in each of them as 3 listed verticals. Let's talk about Raymond Lifestyle first, because the quarter is showing pain. Now, take us through that. Is this a demand depression that you're seeing? Do you see that continuing? What has not worked for Raymond Lifestyle this quarter?
Sure. So look, Raymond Lifestyle, if we all know, in India for last 18 months or so, the consumption has been weak across sectors. And that has been clearly reflected in the Raymond Lifestyle performance for the entire year. And especially in this quarter, we were impacted by the ransomware, which impacted our operations almost to the tune of 24, 25 days. And which is almost like a 1/3 of the quarter was really impacted. But we were able to recover back a lot of sales, and we expect some of the sales to be recovered back in the 25-26. Second, the good aspect is that we are seeing a slight recovery in the demand, as we saw the secondaries in the various sectors, be it the wedding and so on, have seen a little recovery. However, our dealers, franchisees were a bit anxious to buy the products at this juncture, and they were feeling let the inventories come down and then they would start buying. If I look at the bookings, which we just started, we have seen a decent number to come in, but it is little too premature to say that the whole year we will have a strong demand coming on our way. But as we saw in the budget, there was this 1 lakh crore which was distributed, which was given the tax possibility for the people. So that will go typically in consumption. And we see there is a slight uptake with the interest rates going down, inflation coming under the control, people will go out and start spending. So we see definitely 25-26 a better year compared to 24-25. It was an exceptional year where the demand was very, very weak.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching Ask Profit on NDTV Profit, and I'm your host Himakshi Bahugna.
And I'm your host Malika Mishra, and along the next 1 hour of the show, we will together be taking up all your queries. So don't forget to call us on the numbers flashing on your screen anytime now, and also you can write to us on WhatsApp, both the numbers of which are available to you. And therefore, pick up your phones immediately and call us with all your stock related queries. Today, we're being joined by We will soon be joined by Lancelot Dikuna. He's a CIO of Value X Wealth, who will be joining in on the fundamentals. But meanwhile, we have Gaurav Sharma with us. He's the Associate VP and Head of Research, Equity, Commodity and Currency from Global Capital, joining in on the technicals. Welcome, Gaurav. Thank you so much for joining in. Let's dive straight into our first query. Keshav from Coimbatore has written to us asking whether this is the right time to enter IndusInd Bank. Now, IndusInd Bank, particularly speaking, has continued to sort of trade with the downward momentum, especially after, discrepancies were found in its, derivatives trading, and a lot of headwinds has been observed for the stock, which has also dampened its near-term outlook. What is your sense of IndusInd Bank, and how does the technical chart look like now?
Still, this stock is not out of the woods. There is a lot of volatility here. Yes, we did see a bounce back that came in from 650 and it reached, went past 850 odd levels. Again, it is heading southwards. So I don't really think that it is a good time to even, look at it from a trading perspective, because these kind of moves are likely to continue. It is better to avoid this stock and look at the four top picks: HDFC, ICICI, Kotak and Axis from the private sector banking space.
Understood. Thanks for that view, Gaurav. And viewers, I'm sorry that I'm having a bad throat today, so please bear with me. And we have a query, WhatsApp query written to us from Udaipur. So Lachi is holding 200 shares of EPL at 221 rupees, and she's looking for a long. She hasn't mentioned the time horizon, so I'd like to take Gaurav's view on it for the short term. Gaurav, EPL currently it's trading at 232 and was up in trade today over 0.5% as well. But what's your outlook on the counter? Are you positive?
From a short-term perspective, a little decline here is a good buying opportunity. Since the viewer is already holding the stock, I would advise that he should go on holding it, take a stop at 210 and look for targets close to 250 to 260. There he should consider booking some profit, 60 to 70% of his position.
Understood. And now we have Ramachandra calling us from Guntur. Hi Ramachandra, good evening.
Good evening, madam.
Please ask your question.
My query regarding Swiggy.
Okay.
I bought 1,000 shares today at the rate of 310 rupees. Can I add other more shares to tomorrow or day after tomorrow for only a time?
Understood.
Today
For?
For 1 year.
Okay, for a year. Okay, got it.
Today is a yearly low today. That's why I purchased.
Understood. Got it. Gaurav, Swiggy is such an interesting stock to talk about. But just before that, for the benefit of our viewers, Ramachandra from Guntur currently holds 1,000 shares of Swiggy at 310 rupees a piece. And he is asking whether it would be a good idea to continue holding these 1,000 shares that he bought very recently, in fact today, for the next 1 year per se. Now, a lot of fundamental factors have been disturbing the performance of the stock, and the most recent being the fact that the stock plunged to about its 52-week low, especially after lock-in period expired, and there was a dampening in the shareholding. How do you I wouldn't say fundamentally, but technically also view the stock, because if the fundamental story is sort of weak, how could it be possible for the technicals for the stock to look good? So do you see strength in the technical story of Swiggy or not?
Not at all. I don't see any strength in the stock coming in anytime soon. The viewer has rightly mentioned it has touched a new low today itself, and it has just been hitting lower lows.
A network issue with Gaurav Sharma's video, but I think we have Lancelot right with us. Okay. Yes. Hi Lancelot, thanks for finally joining us. We were actually talking about Swiggy, and it would be interesting to know what you think about it, because it's there's been a lot of concern lately. Number one, it comes from a very competitive space. There are projections about how long, it would be able to burn its cash for. And then also there was the lock-in period expiring very recently and the stock plunging to its 52-week low. Give us your sense of what you're picking up on Swiggy and how does the stock look like to you?
So I think, there are two parts to Swiggy's business. One is the regular food delivery business, and the other is the quick delivery services for groceries, etc., which is the Instamart business. And that is a space where there is seeing increased competitive intensity because several people, apart from Zomato, there is Reliance Fresh, there is the Tatas who've come in, and everyone's attacking that space because they are seeing a greater margin. A greater market as far as growth is concerned. So the question is that in order to dominate that market, most of these companies will have to deploy a large amount of cash. And Swiggy's ability to generate that kind of cash is still in question mark because now that it's listed, it will have to sell shares, additional equity if it wants to raise this equity. And the bottom line, that is whether you can see profits in the near term, is very, very difficult to see. Maybe it may happen after 3 to 4 years. So for a listed company to try and raise this kind of capital, which is totally long-term capital, becomes extremely difficult, and hence without cash, I think Swiggy's business will struggle, and the existing food delivery business will keep subsidizing, or the burn will continue, and it will be extremely difficult going forward. So it's not yet an investment case at this point of time until you see the source of money available and the quantum of money required freely available. It will be a very difficult task to consider it as an investment option.
Understood. Thanks for that view, Mr. Lancelot. Now we have a caller joining us from Andhra Pradesh. Hi, Ishwar. Good evening.
Yeah, hi, good evening.
How can I help you on the show today, Ishwar?
Yeah, I have purchased 3,000 shares of Jyoti Labs Limited at 370.
Understood. Yeah.
Yeah, actually I purchased it with short-term intention, but due to the results, it badly affected in last 2 days trading.
Yeah.
So I want to know what action I need to take, and also there is a US and India trade deal. This is going to happen on May 17, right? Is this trade deal going to affect anything on this FMG sector or on this particular company?
Understood. Mr. Lancelot, I'll direct this question to you. Ishwar is holding Jyoti Labs shares, stocks, and he's bought 3,000 shares and is sitting on a loss of, over 1 lakh rupees there. So amid the US-India bilateral trade, discussions about to happen. So, what's your outlook towards the counter? I'm sorry, I have a very bad throat today. So what's your outlook on the counter and what suggestion do you have for Ishwar there?
So I think, given the outlook for the company being rather difficult, they are going to see very challenging times going forward. And the existing, the business environment is also looking a bit difficult. So I think one should not take a long-term view in terms of trying to add to the stock at these levels, because there is no clarity as to what is going to be the future earnings of this company over the next 12 months to 24 months and how that can be impacted. So it's best to either look at booking your losses and exiting and moving the capital that you have to different stocks, or you can either leave it there and maybe review the decision after a year, after 6 months or a year, and in which case you can see whether the outlook for the company has changed and then whether it might make sense to add. But at this juncture, it is not really sensible to add to the stock given the challenges that the company is facing.
Okay, understood. And now we have Nilay calling in from Patna. Hi Nilay, good evening.
Good evening. I would like to know about Aether Industries.
Okay.
It's office open today for non-retail, and for tomorrow it's for retail. Whether is it worth applying at this price?
Okay, got it. Mr. Lancelot, I'll first come to you on Aether Industries and then we'll also discuss the technicals about the stock. But Aether Industries hails from the Indian chemical manufacturing space. And what is your sense of Aether Industries? Do you think, I know it's too early to comment because we don't have a lot of information and also past performance to compare it to, but do you think it will be able to make a strong footing for itself in the chemical industry?
So, Aether Industries is one of the, different kind of chemical companies because they do a lot of contract research manufacturing, and we've seen that space grow in the medical or the healthcare space where pharma companies, outsource the contract research manufacturing, and then thereafter, when it builds to scale, they take over this manufacturing overseas. So Aether is following a similar model as far as the space is concerned in terms of chemicals and specialty chemicals. So it takes over new chemicals that are being designed. It creates a pilot plant, gets the proof of concept, does then contract manufacturing for a while till scale is built, and thereafter, transfers the technology to the company who has actually paid for the whole setup. So while the business model looks good, it involves a lot of capital expenditure upfront. And, at this point in time, given the state of the, global market for specialty chemicals, there could be a lot of unknown surprises coming in on that space. And this is probably the second time which Aether has raised money on a private placement basis. Earlier, a couple of years ago, it also raised cash on a private placement basis. And the fundamentals still look, a little expensive, considering that they are going to be global challenges. So I would not suggest that one should invest at this point in time. Wait for, maybe a further dip in the stock price till it reaches a reasonable valuation, because once the fresh equity is issued, you could see some amount of selling, bring the price down, and then maybe at lower levels, it could offer an interesting opportunity to invest in.
Understood. Thanks for that view, Mr. Lancelot. Now we are joined by a caller from Cochin. Hi, Tanya. Good evening.
Good evening.
Yeah, how can I help you?
Wanted to know about Intellect Design. I purchased around 121 shares, I think at 815 average price. So I wanted to know if how its revenue and profit growth is it overvalued or undervalued, and is it like a midterm or a long-term stock to hold?
Understood. So, Mr. Lancelot, again, I'll come to you on this one. Is Intellect Design a company, that Tanya is holding shares of? Do you advise Tanya to hold it for midterm or short term, or it's a long-term bet? So what's your outlook on the counter? Because currently she bought it at 815. Currently the stock is trading at 913. So what suggestion do you have there?
So, Intellect Design is a product company and it invests in the product. So whenever it makes investment in the product, it seeks to license out its product to various users. So the license fees, the moment they increase beyond a level, or the clients using the platform or the product keeps increasing, then you will start hitting a threshold where beyond which every incremental license you sell actually adds to the bottom line. So one has to look at the investment phase in Intellect Design and how much more cash is needed to be invested over the next couple of years, and what kind of license fees or income from their products being used by others can be generated. The space keeps on changing very quickly, so it's very difficult because technology changes happen at a rapid pace. So it's very difficult for a company to sustain it on a long-term basis, and hence one needs to be a little cautious at when you are investing in this product type of companies. So if the products do not sell, then the entire investment could actually drag the company's financial performance down dramatically, and then you could be in for a severe re-rating. So if you are looking at it from a short-term perspective, since you are in profits, I think the best option is to take some profit off the table and probably wait whenever there is an opportunity to buy it at an attractive valuation. You can look at adding to the stock.
Right. Thanks for that view, Mr. Lancelot. And Gaurav, I'd also like to come to you, talking about the levels. So, are these the elevated levels, or what suggestion do you have for an investor who wants to accumulate the counter, let's say for short term?
I will not suggest to accumulate this stock at the moment since she's already holding it. Some more rooms is still left. This stock is likely to test 1,000 levels shortly. So she should consider some booking around those levels. No fresh entry is suggested. If they are looking for a fresh entry, it is better to wait for a dip to around 825 odd levels. Then she may consider.
Okay, so no fresh entry suggested with regards to Intellect Design. And now we have Shiv Kumar calling in from Bengaluru. Hi, Shiv Kumar.
Hello.
Hi, please tell us your question.
Hi, good evening.
Good evening.
See, I hold LIC India 32 shares at the average price of 902 rupees.
Okay.
But even after holding for a very long time, it's not showing any movement. Neither it is giving me any of the profit. So should I switch on to some other sector or some other shares in the financial segment itself? I don't know what is the fundamental default that LIC is having, that no, it's not even moving apart right from the range of 750 to 810, 820 rupees. That's it.
Okay, I understand the concern. Gaurav, I'd like to come to you on this one. LIC is, a business leader per se in, the kind of insurance it offers, and it's definitely a leading player in the insurance space in India, and it has been for a very long time. But the stock momentum per se has been very stagnant, or if I could zoom out and say that since July 2024, the stock price has seen a lot of fall, a substantial amount of fall that would concern any investor who's invested in LIC. In the case of Shiv Kumar, he currently holds 32 shares of LIC at 902 rupees a piece. And since it has been so range bound and restricted in terms of its movement, what would your technical advice to Shiv Kumar on LIC be?
First thing I want to tell Mr. Kumar that LIC was moving in line with markets prior to the recent decline that we have seen from its top that was around in the month of August last year, trading somewhat around close to 1200 odd levels. It slipped to levels close to 700. Now it is on a recovery phase, currently above 825 odd levels. Some more upside is quite possible. I think a lot of pain he has already seen it, a lot of consolidation has already happened, and now there is good room for a reasonable up move towards 950 and even 1000 levels in a month or two. So it is better to hold on to his position as of now.
Understood. Thanks for that view, Gaurav. And with that, we have a caller joining us from Chennai. Hi, Sanju. Good evening.
Hi, good evening. This is regarding Axis Bank.
Yeah.
I got it around 300 shares 6 months back.
Okay.
It fell down sharply, and then it is above my purchase level. So I don't know whether it will hold on and move up. So I'm just concerned whether I should exit now and then re-enter at a lower level. If at all, it will not fall.
Okay, Sanju, and are you a short-term investor? When you initially invested in the counter, were you planning to hold it for long-term or short-term only?
Short-term.
Short-term. Okay, so you in short-term, you have made a profit of 13,000 there. So congratulations on that. And I'll get your query answered. Gaurav, what's your advice to Sanju? Should he book his profits at the current levels, or do you advise him to stay invested for 3 to 4 months or 6 months down the line so that he can make more profits there?
He should stay invested. These are good levels for the stock. I see it heading towards 1250, 1300 zone in the next 2 to 4 months time frame.
Okay, understood. And now we have Suhas. He is calling us from Bengaluru. Hi, Suhas.
Hey.
Please ask your question.
Yeah, I hold 10 stocks of Tata Technologies at the rate 666.
Okay.
I would like to know the medium-term view on this stock.
Sure, sure. And since when do you hold these shares of Tata Technologies?
I think I just bought less than a month ago during the down when the market was down.
Okay, so then there definitely must be a rationale behind purchasing them quite recently, right? What was that reason for you?
I know, like after IPO, the stock went up almost 1400 and seen significant correction. And this comes from Tata Group. Business-wise and all, it's like solid. And I think they provide some kind of technology to automobile, and with JLR doing well, I hope this might be a good, company yielding results in the near future. So that was my rationale. Yeah.
Okay, thank you so much for explaining that to us, Suhas. And let's see what our experts have to say about your investment in Tata Technologies. Lancelot, I would like to take this question to you first. Suhas from Bengaluru currently holds 10 shares of Tata Technology at 666 rupees a piece. The stock has, although risen to about 700 odd levels, which has given him a meager profit. But it is interesting to see, number one, the stock has fallen about 20% year to date. And second, there has been a mixed bag of views coming in from brokerages, especially with regards to Indian IT, where for the longest time in recent past, Indian IT was a pain point, and now it has gone back to being the focus again, especially with US doing trades with different countries and easing on tariffs. My question to you is, do you think Tata Technologies would be a beneficiary of maybe the kind of gradual, slow, patient tailwind we are projecting for the IT industry? Or do you think the kind of correction the stock has seen, it will continue to see for a longer period of time?
So, if you look at the valuation of Tata Technologies and its earnings, it's trading at about 42 times earnings. So that is an expensive valuation for an IT company. If you look at Infosys, it trades at 24, 25 times. And if you look at the other TCS, they're also at in the mid 20s. So when you look at you are paying a premium for the company, and if you look at the profitability, it's not that growth is going to be so rapid that it justifies the additional premium that you're paying. So while in the short and medium term, it is very unlikely that you're going to see re-rating of the stock. There was a lot of interest in the company at the time of the IPO, and the IPOs generally are priced to perfection because many people, investors are looking to offload based on the merchant bankers, pitch as to what this company can generate. And so definitely, you are paying a higher price multiple for this stock. So it will take a while for valuations to become reasonable. And at that point in time, maybe one can look at accumulating it from a long-term perspective. But from a short and medium-term perspective, one cannot expect great returns in the short and medium term unless performance of the company suddenly dramatically changes, which is very unlikely given the current global scenario.
That's very interesting, Mr. Lancelot. Gaurav, I'd like to quickly, talk about the technical charts, especially because for anyone who is maybe perhaps going ahead and accumulating shares of Tata Technologies, what would your stop loss at this given point of time be? Because the chart itself, the 1 year chart, is dark red in color right now.
Yes, rightly mentioned. If we purely have to look at charts, it is very negative. When you talk about a stop loss point, so it is 640. 640 should be the stop loss. Since the viewer has purchased it at a very, very fine level, which is the point when it just started its up move, the recent up move I'm talking about. So I expect it to extend it a little further till 740, 750 zone. So he should consider exiting and booking profit in his position around that mark.
Understood. Thanks for that view. With that, we have a caller joining us from Bengaluru. Hi, Shankar. Good evening. Shankar, are you there on the phone line? Yes.
Hi, ma'am. Good evening.
Good evening. Please go ahead with your query, Shankar.
Ma'am, JK Papers stock.
Okay.
500 quantity, average price 360. Profit 40,000. Sorry, 15,000 loss, ma'am. Seller word, ma'am.
Okay. And are you a short-term investor, Shankar?
Short term, 9 months, ma'am.
9 months, understood. So, Gaurav, currently the stock is trading at 332 and Shankar is sitting on a loss of over 13,000, nearly 14,000 there. So, so how is the stock performing relative to its moving averages?
It is trading below its medium and long-term moving averages, that is 100 and 200 period exponential moving average. Some bounce in the past couple of days was seen where it went up from 300 to currently around 330, 335 odd levels. A little extension to this bounce can be witnessed in coming sessions, and I think that should be the time when the viewer should consider exiting the position, as overall the formation is not at all upbeat, and the stock is more likely to take a downturn after a slight rise from these levels.
Okay, noted. And now we have Arihant calling in from Bengaluru. Hi, Arihant. Arihant? Okay, I think he's listening to television right now. No issues. Arihant basically, Arihant basically had called us to know about Infibeam. He currently holds 1,130 shares of Infibeam at 27.86 rupees a piece. The stock has dropped down to 18 odd levels. Now, I don't know what exactly his query was, but Gaurav, I'll come back to you on this one. The stock is now trading around its 15-day moving average and has seen a bit of pain recently, a sharp correction as well. What's your sense of Infibeam?
On charts, it is just not good. Completely off track, not able to perform in over an year actually. And the consolidation, some bit of consolidation is here, but I really doubt whether it will be able to hold or not. He should utilize any bounce towards 19, 19.25 to actually book his position.
Okay, got it. And viewers, we'll have to slip into a short break, but keep sending in your queries on WhatsApp as well as call us on the numbers available to you. We will be right back on Ask Profit only on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered
Welcome back. You're watching Ask Profit only on NDTV Profit, a show that answers all your stock-related doubts. Today we're being joined by Lancelot on the fundamentals and Gaurav Sharma on the technicals. So do pick up your phone and call us on the numbers available to you. Let's talk to our first caller waiting for us right after this very short break. Rani is joining in from Chennai. Hi Rani, good evening.
Hello. I wanted to know about V-Guard.
Okay.
How is it compared to its competitors, any in the same sector, any potential risk? And its PE ratio looks a little high, so I just wanted to know which levels to enter at. And also, if possible, I was also comparing it with Wonderla. Wonderla is also owned by the same management, Chicklapalli, so I wanted to know if they are aware which is a better stock among the two to consider for long term.
Very interesting. Mr. Lancelot, I will direct this question to you straight away. Rani from Chennai wants to know how you view V-Guard Industries, and she also spoke about Wonderla because it is, they share a common management. But let's talk about V-Guard first, because she did point out the high PE ratio that it trades at. Do you think that is discomforting, and what else stands out for you in the stock?
So, I think V-Guard is expensively, valued at this point in time, but and one needs to be a little bit, cautious when entering a lot of these, electronic equipment stocks, because there has been, they basically sell, consumer durables like electric water heaters, solar heaters, kitchen appliances, etc., and various small domestic appliances.